Hello, bankers. A very good evening to all of you. Welcome back. So, guys, from this particular session onwards, we are going to start with our AFM Module A, right? So, when it comes to Module A, Unit 1, so nature and purpose of accounting. Basically, it is all about the introduction of accounting. Then we have historical perspective, new accounting system, then origin of accounting principles, accounting standards in India, then Indian accounting standards. Okay. Then we have GAAP and IFRS, GAAP versus IFRS, okay, transfer pricing. So all subtopics are bit important, and you have to make your basic understanding around these particular one, right? So like when we basically talk about these important areas, so sometime we'll see the question around what is accounting and all, okay, accounting process and all, and sometime around these two subtopic, 1 marks question, okay. Accounting standard, this is the most important part. Every time you'll see two questions based on accounting standards. Sometimes they'll ask you to match the following. Okay. One side there will be accounting standards, and another side their definition and all. So you have to match those particular one or their name. And sometimes they'll give you like a single statement based question like property plant आपका property plants equipments, which is accounting standard 10. So the further bifurcation of that particular one and all. Okay. Then we have Indian accounting standards. They never ask any question around this particular one, but we'll have an overview around this particular one also. Then IFRS versus GAAP. This is again a very important point, right? So these are some areas which you have to have worked very carefully, and that is definitely going to help you in your upcoming examination, right? So we will start with the basic accounting. So when it comes to accounting, when you study finance, you have to like your perspective should be as an investor, right? So if you are investing some money, so how to maximize the return. But when you are studying accountancy, your perspective should be like a businessman. Let's say you are running some business, and there are lots of activities in that particular business on daily basis, so you cannot memorize all those particular entries and all. So for that particular sake, we have to do bookkeeping, and bookkeeping, which is part of the accounting. You have to record those particular transactions in a chronological order, so you can easily interpret those particular one, and whenever it is required, so you can easily access those particular ones. So simply saying, it is a language of business. Okay. When it comes to accountancy, it is language of business, and the entire process which we are going to cover in with these two modules, module A and module B. It start with the recording things, recording in the form of journal entries. Okay. Then we have classifying. We classify each and every individual accounts, okay, with the help of ledger accounts. Okay. Then after ledger, we prepare trial balance, which is also known as summary of all the ledger accounts, right? Their final balances. For trial balance, we have three major methods. We have gross, we have net, or we have compound method. Okay. So then after the summary, we report things in the form of like in case of a joint stock company, we have first we prepare trading accounts, then we prepare profit and loss account, then balance sheet, and then cash flow statement. When it comes to the final accounts, it includes three accounts. Your profit and loss account, with the help of profit or loss account, you will get to know about the net profit or net losses out of those sale and purchase activities during that accounting period. Then we have your balance sheet, which is also known as position statement, asset equal to liabilities plus owner's equity. Then third one is your cash flow statement, inflow and outflow of cash. So where you have to prepare those particular one in three different ways. That first one is operating activities, financing activities, and the final one is investing activities. Okay. So four stages: recording, then we have classifying, summarizing, and reporting. The final one is interpretations. Interpretation is something where we are using those particular data for decision making, right? It can be internal purpose for the business, or external stakeholders like shareholders or investors. They can also use those particular financial models and all, right? So when it comes to interpretation, it involve managerial accounting, or it can be part of cost accounting also. And investors, they also use those particular one in the form of ratio analysis and all, right? So that is interpretation. So these are the 5 stages of your accounting which we are going to study or understand with the help of these 2 modules, right? So first one is recording. I hope you guys are aware about this particular one. So recording, in the term of like, first what we'll understand, yeah, with the coming sessions and all, we generally do the journal entries, and journal entries are basically in chronological in order, basically time date wise and time wise, right? So let's say we did some sale, we did some purchase, we did some income or expenses, so all these we have to record in this particular one with the help of journal entries, okay? Then after these particular one, we create we classify them, all these particular journal entries, in the form of ledger. Like, ledger is basically, it is individual accounts for all the journal entries. Let's say we have sales ledger, we have purchase ledger, we have capital account ledger, we have let's say any XYZ, ABC, XYZ bank, or any other one also, right? So for each and every individual account, we have a separate ledger. So we can define the or we can check the current status with that particular party. Then after this, the final balances of ledger, we generally move to the trial balance. So we generally summarize things in the form of trial balance. When it comes to trial balance, it is like particulars, the name of the ledger folio. Then we have debit balance and credit balance, and their balance should be equal. If these are equal, that means you have achieved the arithmetical accuracy, right? So this is the one. So it is the kind of trial balance is simply, it is a kind of summary of your all the ledger accounts. Then reporting, in case of a joint account, like in case of a joint stock company, we have 3 major accounts, mandatory accounts. One is your profit and loss account. So profit and loss account, which will help you to find out the um, find like the net profit or losses occur during that particular accounting period. Then with after this, we create a balance sheet. So balance sheet is all about your assets, the position of asset or the changes in assets, liabilities, and equity. Then final one, we have cash flow statement. When it comes to cash flow statements, we have to it is inflow and outflow of cash flow. So we have operating activities, financing activities, and investing activities, right? Inflow and outflow from these 3 different categories and all. And then finally, interpretation, it is basically how you are using that particular data. See, interpretation is all about key, like let's say as a layman, if we have to invest in some company shares, there are 3,000 companies which are listed in Indian stock market, right? More than that. So if you want to know like in which company I should invest, so for that one, you have, that means your uses is market prospect about those particular companies. So you'll use some financial modeling like ratio analysis. So if you want to check the market perspective about those particular companies, so you'll use like ratios like earning per share, EPS, price to earning ratio. If you're dividend oriented investor, if you want to invest for long term, so you'll check the DPS and others one, right? So, and even for internal purpose, like for managerial accounting, we use liquidity ratios, solvency ratios, or turnover ratios and others. They generally part of this particular one. And even apart from that also, we have so many different financial models which we use in. But we'll stick to our course content only, and we'll talk around those particular ones. Okay. So this is the entire journey which we guys are going to deal with, and with the help of these 2 modules. Okay. In one module itself, till here you'll get a basic ideas about the accounting things and all. And when it comes to these reporting and interpretations, some part will be in your module B, especially that company account 1 and 2, and balance sheet and final accounts of a banking company, or preparation of final accounts, cash flow statement. So these all are part of your module B, right? So this is the entire things which we are going to cover one by one, right? Now, today's session is all about the basic introduction of accounting. So now I hope you guys will be able to interpret this particular one. So when it comes to accounting, it is an art of recording, classifying, and summarizing in a significant manner and in term of money transactions and event which are in part of at least financial character. At least financial character means we only record things which has a financial character. That means there is a concept called money measurement concept. So anything which can be measured into money, that will be part of your books, even that amount is very low or very high, right? But anything which does not have any which we cannot measure in money, or which does not have any financial character, like health of proprietors or businessman or manager, that you are not going to account in your books, right? So that is the word. So simply saying, it is a language of business, how your business is doing, and the entire activities or every transaction which is related to that particular business. Simply saying, systematic classification with the help of journal entries and all, that is also known as bookkeeping, recording things and all. So in term of money and financial character, summarizing in term of trial balance and balance sheet, interpretation of the financial transaction. Accounting is an art of recording, classifying, summarizing transaction. Accounting record all the transaction in term of money. Accounting record only the transaction which has financial character. Accounting also interpret the financial data. So this is something, the basic summary which we have discussed so far, right? I hope this is clear. So let's say you are running some business. Let's assume you are doing some business called XYZ Limited. So in a daily basis, there are so many transactions. You did some purchase, you did some utility expenses and all, and you did some sale. So these are the kind of transactions. So you have to record them first on a chronological orders. Take a date wise, amount wise, right? So let's say on 1st of July we did these many transactions. 2nd July we did these, which will have some sort of inflow and outflow of cash. So you'll record only those transactions which has a money characteristics or a financial characteristics, which can be measured into money and all, right? Next one. So feature of accounting, it is systematic recording and summarizing. Accounting involve recording, classifying, and summarizing. Recording with the help of your journal entries, classifying with the help of ledger accounts, and summarizing with the help of trial balance. So this way you'll remember all these particular one. And journal entry, we have a different unit. Journal entry and ledger. Some trial balance, we have a different units. BRS, we have a different units. So these are the broader topics. You're just getting an idea around these particular one, right? So business transaction in a orderly and systematic manner. It represent the data from like trial balance. So trial balance, then we have profit and loss account, we have a balance sheet, and we have your cash flow statement. These are the units, the entire units and all. So with the help of trial balance, we generally prepare your trading accounts, or we directly prepare profit and loss account in case of banking company. Okay. Balance sheet, where with the help of basically when it comes into a profit and loss account, you'll get to know about the net profit or losses. Balance sheet, it is a position statement, the total assets of the company, their liabilities, outside liability, and owner's contribution. Cash flow statement, inflow and outflow of cash. These are the features. First one, monetary measurements. Only transaction expressed in monetary terms are recorded, and non-monetary events such as internal dispute are excluded unless they result in a financial impact. So first unit will take bit, it is bit lengthy. Reason being, I just want to build your basic understanding. We are going to study all these particular terminologies or topics in details in the coming in our coming units and all. But if you have a basic idea around these particular things now, you will be easily understand things, and you'll not have any sort of fear around these particular one. Okay? And we'll do lots of practice. You do not have to worry about that particular one. So we will be in safe hand, right? So financial nature transaction only, this we have understood. I hope now everyone can relate this one. Interpretation of financial data, which is accounting also interpret financial data, assisting stakeholders in making informed decision. For example, bank may use balance sheet to evaluate the credit worthiness of different companies or the borrowers. So that is the basic meaning of this. Now, purpose of accountancy, why we create these particular records and all. So what is the logic behind this particular one? Because see, if like let's say in our case we are running some XYZ limited, so if you'll have proper records and like it is some, in some ways it is mandatory by law also, but apart from that also, like you'll get to know the exact profit or the exact cost of your running, like cost of running business or the other thing also, right? So you can make right decision for your businesses. So these can be like you'll have systematic record of all monetary transactions of your business to ascertain a result of operation, how what we are doing. Okay? Ascertainment of result of business means this you'll get to know with the help of profit and loss account. Okay? So whatever transaction we have did during that particular accounting period means you're equal to financial year, April to March. Okay? So whatever sales and purchase or the other activities we have done during that particular period, what is the outcome? What profit, like we have generated profit or loss during that particular period. Then we have ascertainment of financial position. Financial position means your balance sheet. It is equal to your balance sheet. Okay? So what impact that like that particular transactions or whatever. Let's say if you have generated some profit, so how that profit will change your overall equation. If you have made some losses, so how that loss will get adjusted in your balance sheet and all. Okay? And after that particular one, what is the overall or the current standing or position of your business, total assets, total liabilities and total equity. Then we have rational decision making. Accordingly, like which segment we should continue or we should invest more in that particular segment, or which segments or product we should withdraw, or which segment requires some sort of attention so we can leverage from that particular segment and all. To satisfy requirement of law and useful in many other aspects. Yeah, law is like Companies Act 2013, according, or like for banks it is BR Act 1949. So it is mandatory as per Companies Act 2013, section 227 and 228, sorry, 228 and 229. So according to these particular one, you have to have, if you are running some joint stock company, so you have to prepare your final accounts, means profit and loss account, your balance sheet and cash flow statement. For banking company, as per section 29 of Banking Regulation Act 1949, you have to prepare your final accounts, which include your profit and loss account, your balance sheet and your cash flow statement. So you cannot ignore these particular points. So it is mandatory by law. Why it is mandatory? Because you'll have these many benefits which are associated with this one, and investor and stakeholders, they can make sound decision about your overall business and all, right? So that is the same thing which is explained in this particular one in detail. Now I'm not going to explain this particular one again and again. Okay? So a few things, if you want to like if you want to have a detailed study also, okay, you'll not require more than that data, that I'll make sure. But these things which we have discussed in detail, like systematic records, this we have discussed so many times. Ascertainment of result from operations. Okay. So the outcome of your business, basically, how your business is doing, you are generating profit or losses. Financial position, your balance sheet. Financial rational decision making, like whether to manufacture or buy products, setting the selling price, okay? And we have offering discount on a special to special customers and all, okay? And even legal requirements also. So that is also, I have provided some sort of detailed things, so you can, like if you want to have some additional studies and all, so you can go through those particular one. And this content is 100% aligned with your Macmillan book. And one good news for all of you guys, so I'm working on the book also, okay? So ebooks, and that will be part of your subscription itself, okay? I'm not going to charge anything extra for that one, okay? So I'll be providing these particular books in your subscription, so you can go for those particular one, where you'll see each and everything coverage, and you do not have to buy any book from any other sources, right? So now we have different views on accounting, or the overall evolution of accounting, okay? When it, like, initially it was kind of a stewardship accounting. So that is something ki there are some person who is generally taking care about the overall transactions of business. So if it is required, like it was mostly in registered form and all. Okay. So earlier, the beginning of that time, it was not a legal things and all. So like, let's say if you are running some business, some small business, kirana shop and all, okay, which is not comes under the GST and other things, let's suppose. Okay. So still we manage some sort of register, ki how much purchase we are doing, how much sale we are doing and all. So that was something kind of a stewardship accounting. Earlier, this is the kind of the beginning of the accounting periods and all, right? So originate from the practice of stewardship, managing property from property for wealthy individual. So there is one person who is taking care about your financial. Okay. So like from what sources you are getting money, and in what sources you are allocating those particular, or you are investing or spending that particular money. So like it is a kind of a PA, personal assistance, or it can be a, like in modern businesses we have CA on other, those who generally take care about your finances and all, right? So involve maintaining accurate record of business transaction, known today as bookkeeping. Okay. So that time it was in the form of this. Emerged with the adoption of double entry bookkeeping in Italy during the 15th century, later spread across the Europe. Focus on recording of the assets, debt and transaction to maintain in accountability and transparency for business owners. So this is the like kind of a beginning of the accounting era or the accounting things, where one person, like let's say there is a wealthy family, there is a rich family, they have very good finances and all. Okay. So there is one person who is generally taking care about their who is generally going to record their all inflows and outflows and all. Okay, that is the one. So this was kind of a beginning for the accounting. Then we entered into a financial accounting, the another part. Financial accounting, which is basically now we have defined rules, laws. Okay, so where, like let's say if you are running some company, so you have to have record those particular one, right? So like we have accounting standards, we have Indian accounting standards. Okay. And financial accounting, it is mostly used by the external stakeholders. It can be used by internal as well. Okay. So like managerial accounting, we generally use financing and cost accounting, okay, to make the decision and all, along with the ratio analysis and all. So financing accounting evolved with the rise in joint stock companies that allow public participation through the shareholding. So let's say we are running this XYZ company that got listed in stock exchange, or let's say it is a public company where we have like let's say 50 members are part of that particular business, and out of 50 actually 2 or 3% are running that particular one, others they have invested their money in that particular business. So the remaining 48%, they also need some sort of information about the business. Only 2% actually dealing with, so they know the reality. For the remaining 48, we have financial accounting, so they can access these particular records or reports, and based on that particular one they can make their decision, or they can be aware about the overall how that particular business is doing, right? So limit shareholders liability to the value of their share, require companies to disclose financial performance like profit and loss, balance sheet position and others, aim to provide reliable sufficient information to shareholders and investor for a rational decision making, has a legal and social functions to ensure transparency and help mobilize public savings into investment. So this is something which is generally part of this particular one, right? So now, like let's say that XYZ company got listed in stock exchange. If some investor they want to purchase that particular company shares, so they'll use the financial accounting. Okay? After analyzing their shares through ratio analysis, EPS, DPS, or P ratio and others. If let's say you are a core member of that owner of that particular business, but you are not actively dealing with that particular one, you have invested your money through the venture capital and others, so you also ask for the reports like how this particular business is doing, where we have allocated amounts or investments, what is our current inventory, what is our how we are accounting depreciation on assets and all. So they can have some sort of transparency about that particular business. And even the business itself, they can also use these particular one to make the fair decision making, right? Then after that, we have cost accounting. This we are going to study. So financial accounting, which is like accounting standards, Indian accounting standards, all these are generally part of your financial accounting. Now the another one is cost accounting. It is generally used for the internal purpose. Like financial accounting, mostly it is used by the external stakeholders, but when it comes to the cost accounting, it is used by the the internal like the business itself. Take a manager, they generally use this particular one for the decision making, right? So when it comes to cost accounting, how to decide the cost of a product, right? So things like break even points, margin of safety, contribution. We have the other aspect like standard costing, marginal costing. All these particular one, they are generally get derived through this particular one, right? So this is something which is used by the managers to decide the break-even point of the business, or to get to know about the break-even point of the business, or to decide the selling price of that particular business, or while we are manufacturing any product which, like let's say our overall cost is 100 rupees, if we have to minimize this particular one, so which factors where we can work and all these kind of decision making, they are generally taken under this one. So emerged during the industrial revolution in England to support the managerial decision making, focus on analyzing, controlling production costs, help industrial managers make decisions based on scientific cost data and efficiency. Now, when it comes to the financial accounting, that is mandatory in nature by law. But when it comes to cost accounting, you do not have to disclose, or you do not have to publish your cost accounting, how you are managing your cost and all on your website. But in case of financing accounting, you have to have disclosed. Okay, we have 29 accounting standards, 3 are alternative, overall 32. Okay, so 29 like how you are showing like how you are accounting depreciation. So you have to disclose that particular one in your note to accounts or in your profit and loss account. How you are creating your, how, like by which method you are using or you are accounting depreciation, you have to disclose in your note to accounts. But it is something how this is something for the internal purpose. Managers, they use this particular one to achieve the efficient costing in their businesses itself. Okay, so this is not something which is anybody is going to ask or force you to disclose that particular one. No, right? So now management accounting. When it comes to management accounting, it is a combination of your cost accounting, your financial accountings, or the other financial modelings like ratio analysis. On management accounting, which is again for the internal purpose. So where managers are using data from your or reports from your cost accounting and financial accountings, and they are interpreting that those particular data, and they are making decision for the future of that particular business, right? So let's say we are running some company. So like what is the current status of your profit and loss account, and what is your balance sheet, and how we are achieving those particular number, how we can achieve increase those particular numbers by utilizing our overall cost, what is by increasing, by decreasing our break even points, by increasing our sales and all. So these kind of decisioning we use managerial accounting, right? Cost accounting and managerial accounting, we will be studying these particular one in detail in your module D, right? So and there is no accounting standards, or there is no managerial accounting standard. We do have financial accounting standards. They are generally known as Indian accounting standards or accounting standards. We do have cost accounting standards, but we do not have any standards for the, standards means principle for the management accounting, right? So management accounting emerged in 20th century to aid managerial decision making using detailed accounting information. It is a forward looking and often include cost accounting and budgeting. Unlike financial accounting, it is not bound by legal standards or generally accepted accounting principles, offering more flexibility. It focus on preparation and presentation of internal report to assist planning, policy making, and operational decisioning. Okay? It provides relevant and timely data to managers to help them achieve business goals. The emphasis of future decision, okay, and it is tool to strategic planning. Internal report generated are not subject to legal constraint and all. So this is all about your management accounting. Now, one question you can face, like which of the following statement is correct or incorrect about the cost accounting versus management accounting. But this question will be for your module D. For sure, you guys are going to face this question. And in module D, they have explained cost accounting and management accounting in detail, because we do have one dedicated units for this particular one. Okay? And another one is, so you do not have to take any sort of tension for this one, because you guys are going to study all these particular one in detail in your upcoming sessions and all, right? So now new accounting system, sometimes they ask half marks question around these particular value accounting, fair value accounting and all. Okay. So first one is value accounting. Value, when it comes to value accounting, most of the time you'll see this question for half marks. And so it is something like, let's say as an individual, if I'm part of that XYZ Limited, so what is my contribution to that particular business? So that is something like every resource allocated to that particular business. So what is the contribution of that particular individual in overall revenue generation? Let's say if we are having 100 crore rupees of revenue, what is my contribution in that 100, out of that 100 crore rupees? What is the other contribution, that machine contribution? What is the office contributions and others? So that is value accounting. Even it also account the intangible things, how intangibles like goodwill, trademarks and all, they are contributing to the business and all, right? So this is something which is part of the modern accounting system and all, right? So value accounting focus on evaluating and capturing individual contribution, which is tangible or intangible, to a product. Each contributor's input is measured usually as a percentage. So ensure fair revenue distribution among contributors based on their share input. Okay, examples like workers picking tea leaves are rewarded based on their individual contribution. Okay, useful for determining fair revenue sharings and tracking contribution value and all. So this is something which is generally part of this particular one, right? Understood, guys? Now, fair value accounting. So consider the current market value of assets and liabilities when it comes to fair value. Fair value is, let's say there is an asset as per the book value. Book value, we purchase that asset for 10 lakh. There is depreciation of 2 lakh. Okay, let's say the current book value is 8 lakh. This is book value method. While you compute the valuation, or while you do the valuation of that particular asset based on fair value. So let's say in market, the prices of that particular asset is 5 lakh only. Okay? So 5 lakh minus that depreciation, right? So that, let's say it comes to 4.50 lakh. So the fair value of that particular asset is 4 lakh. So, or 4.5 lakh. So there is a huge difference, or it may increase or decrease. Okay? So like as per your book value, the value is different. As per your fair value, there is another valuations. Okay? So it usually decrease in case of machine and all, but it usually increase in case of intangible assets and all, and even your goodwill and all, right? So fair value of asset price can fetch in the market under current conditions. So fair value liability amount it would take to settle under current conditions if we settle those particular one. So measurement is independent of whether the holder intend to keep or sell the liability or assets, unless multiple approaches like market approach, income approach, cost approaches are there. So market prices, or how it is generating cash flows, income approach and cost approach. So also called current value accounting, but it has limited acceptance due to high cost, time delays, lack of reliable data and concern about the accuracy, right? So it has very limited, and very few companies for their decision making, or like for any sort of merger and acquisitions and all. So at that time we generally use the fair accounting, fair value accounting. Usually for your for a going concern concept, or for a normal business conditions and all, we do not use fair value things and all. Fair value mostly get used in case of any sort of acquisition, mergers, amalgamation and all, right? Otherwise, because it is very hard, or it is very tough to account every time you have to link with your prices. Like let's say if let's say you own some commodities or some assets whose prices are very volatile in the market. So every day you have to adjust your value and all. It is not feasible for businesses, right? So this is something which is linked with this particular one. All right. So accountancy versus bookkeeping. I hope now it is clear. So when it comes to accountancy, it is a broader term. So accountancy, which include recording, classifying, summarizing, reporting, interpretation. But when it comes to bookkeeping, bookkeeping is a part of accounting, that recording things. Okay? So like in term of journal entries and ledger. So that portion is generally known as your bookkeeping. So bookkeeping is merely recording the business transaction in book and ledgers, means journal and ledgers. Accountancy is a broader concept, compilation of accounts in such a way so one can in a position to understand the state of affair of that particular business. So bookkeeping, you can say it is part of accounting, or it is part of the initial journey of accounting, that recording and classifying. Rest, the accountancy, it has a the entire things: recording, classifying, summarizing, reporting, and interpretations. That is the only difference, right? Chalo, let's move forward, guys. Now we'll come to the another part of this particular topic. So first part is all about the basic introduction. Why accounting is generally known as language of business. So it is basically, if you are doing accounting, if you are doing any business, so there are lots many transactions and you cannot memorize all the transactions. For that sake, we have accountancy. It is by legal also, and even you have so many benefits associated with this particular thing. So that stewardship is where one person who is accounting the overall inflow outflow of that family, that wealthy family. Then later on we come up with the financial accounting, where we have some defined rules and regulations, concept, conventions, accounting standards. You have to follow those particular one while you prepare books for any account, any businesses, right? So you'll get to know the fair value, or sorry, not fair value, you'll get to know the outcome of that particular business, what net profit or losses we are generating, and how that profit or losses making an impact on your overall position, means balance sheet. And if you want to check the overall cash flow, what from which sources we are generating cash, which sources we are having inflows and outflows, so for that sake we have cash flow statements. This is then cost accounting for the internal purpose. So how we are how we can utilize our assets or the other resources in a maximum way. Okay? So how we can keep our break even points at a lower side, how we can sell more and more products, how we can produce products at a lower cost so we can sell maximum number of product in the market. Managerial accounting, management of that particular business, they are using cost and financial accounting along with some ratios to make futuristic decision about that particular business, which segment we should continue, or in on which segment we should invest more money, or which segment we should withdraw, and all these kind of decision with the help of managerial accounting. Now the another part is accounting standards, very important one. So you can expect questions based on accounting standards as the trend they are following. Okay. Accounting, like see how you'll understand this particular one. When it comes to accounting standards, now it is something. Let's say there are three businesses. Business X. There are three form of businesses. One is business X, company Y, and company Z. These are the three different businesses. As of now, company X is using method A to report or to present their books and all. Okay? So company X, they are using a method called A to prepare their final accounts. Make it simple. Okay? Company Y, they are using a method B to prepare their books or final reports. Company Z, they are using method C to prepare their books. If I'll ask one question, ki you have to compare all these three accounts, three companies, and you have to make decision ki which company is best where we can invest our money. So you won't be able to decide ki which one is best, because all the companies, they are using different methods and all, right? So how you'll get to know their data is fair or not, right? So for that sake, for this uniformity, so like what government did or what aapka body regulatory bodies did, they come up with some defined rule. Okay? They come up with some methods or principles. Okay? They are generally known as accounting standards or Indian accounting standards. Okay? So usually we have GAAP, generally accepted accounting standards, principles, GAAP, and broadly uses IFRS, ठीक है? International Financial आपका reporting standard, International Financial Reporting Standards. Worldwide, most of the countries use this one, and this is used in US. Okay? This is majorly in US. Sorry, US, and rest use your GAAP. Sorry, IFRS, right? And these Indian accounting standards are aligned with the this one only, right? So now what we generally did. So now all the three companies, company X, company Y, and company Z, all the companies are using same methods while they are accounting or preparing their book. So now it will be very easy for a person to make that like to make any decision about these particular one, okay, which one is doing good or which one is not doing good, right? So if your decision making is around the short term, so you'll use liquidity ratios, or if it is around the long term, so you'll use solvency ratios or market perspectives, and others different tools are there. So based on, so now because we know, because all the three companies, they are using a similar or uniform rules and regulation while they are preparing their books. So then you can come to some sort of conclusion that this is good and this is the best option and this is the second best and all, and we'll go for this one. This kind of decision can be made through this one. So that is something came from these accounting standards. Okay? So accounting standards will help in this particular manner. So how you will, like, let's say how you'll maintain your inventory. So for that one we have defined rule. So you have to have used these particular one only. How you'll account the depreciation. So you have limited methods. These are the method, you can opt anyone, and which method you are using you have to disclose in note to accounts. If you are making any change, so that you have to disclose in all. So that is something which generally comes through these particular one, right? So every functioning body that operate need a defined guidelines, so as to maintain the procedures and the standard for the operations of its own business. The rule make the policies common for organization that operate in a simpler fit. It is as simple as that. If you are doing something, to do something, let's say if we are preparing for JAIIB examination, so to prepare for this kind of certification, we do have some sort of guidelines. Like you have a defined syllabus, you have the question format, you have the type of questions and all, and you have 4 subjects. So these are kind of some guiding principles which you have to follow during your preparation. Simply, while you're preparing books for your any XYZ company, or you are preparing your final accounts for any XYZ company, you have to follow these particular standards, so that like investors, they'll show some sort of confidence in your book, and they can, like, if they want to invest, it will be easy to easy for the investor to compare among the multiple companies and all, right? So accounting standard in India, when it comes to, so we have one body which is known as ICAI. I hope you guys heard about this one. The Institute of Chartered Accountants of India, which established a board. That board is generally known as ASB, Accounting Standard Board, in on 21st April 1977. Objective to formulate accounting standard for harmonizing diverse accounting practices in India. Okay, like if you are running some business in India, listed or unlisted company, so while you prepare your final accounts, you have to follow these particular common standards or common or uniform rules while you make your or prepare your books or final reports, right? So ASB identify broad areas needing standard and set priorities. Study group assist ASB with consultation involving government, industry, and other stakeholders. An exposure draft of the proposed standard is prepared and shared for public and member feedback. Feedback is incorporated and revised draft is finalized. ICAI's council review and issue the final standards in consultation with ASB. So this is the entire process. So whenever we come up with any new standard or these existing 29 accounting standards or the Indian accounting standards, so this is the procedures. Okay? So this way we generally create, or if we do some sort of amendments and others, so for that one, this is the entire sequence. Very simple. Compliance and enforcement again. So mandatory accounting standards must be followed by ICAI members. Non-compliance lead to professional misconduct. Okay? So mandatory means those 29 accounting standards. If you are a listed company in India, so you have to have follow accounting standard, and there should be adherence of 29 accounting standard. Last three are optional, but these are the one. Okay? Like how you'll, let's say if you are a business, if you are doing business where your inventory is continuously interchangeable, that means you can use only FIFO and weighted average method to account your inventories. You cannot use LIFO method as per this particular one, accounting standard 2. So this kind of things. You can, for depreciation, you will have only Indian accounting standard. You can use only three methods. Either you can go for straight line method, written down value method, or unit of production method. There are lots many methods by which you can account your depreciation, but you have restriction, you can use out of these three any one, right? So that is the one. If you are changing any method in between the accounting period, you have to disclose the material fact also. So that is something which comes from here. SEBI and Companies Act 2013 require audit reports to mention non-compliances. Section 134 subsection 5 of Companies Act 2013 mandate companies board to ensure compliance with accounting standards also. So this is something which is generally part of this particular one. Okay? So regulatory oversight, we have NFRA, that is National Advisory Committee on Accounting Standards, which was formed in 2001, was replaced by the National Financial Reporting Authority, NFRA, sorry. So NFRA under section 132 of Companies Act 2013. NFRA is an independent regulatory body or SRO, self-regulatory organization, effective from 1st October 2018, responsible for enforcement and framing up accounting and auditing regulations. Please do remember this particular one. So earlier we have NACAS, which get replaced by NFRA. Right now we have NFRA since 2018 onwards, which is responsible for enforcement and framing of accounting and auditing regulations. ICAI must now consult with NFRA for recommendations on accounting standards. NFRA's creation may curtail some power of ICAI as it acts as an external audit regulators. So this is something which is generally part of this. These all are static. So here we have a list, accounting standards. So as I said, we have 31 accountings, 29 aapka. So these are the accounting standard which is part of this one. Now the question is, you do not have to do any sort of rectification. Most of the time you will see accounting, like whenever they ask accounting standards, mostly they limit themselves around a few accounting standards. These are accounting standard 1, accounting standard 3, accounting standard 5, 2, also sorry, 2, 3, 5. Then we have accounting standard 10, we have accounting standard 14, accounting standard 15, accounting standard 19, accounting standard 20, and accounting standard 25. Most of the time, 90% time, you'll get question based on these one. Why these particular one get asked again and again? The reason or the logic behind this particular one is because when you'll go through all the units of AFM, you'll see there are dedicated units around these particular ones. So that's why they again and again ask question around this one, right? So accounting standard 1, which is all about your disclosure of accounting policies. It should be mentioned somewhere. Yes, disclosure of accounting policies. So this is something like by which methods you are preparing your books and all. So you have to disclose those particular ones. Okay? Accounting standard 2, inventory valuation. Accounting standard 3, which is all about your cash flow statements. Okay? Accounting standard 5, prior period item. Property, plants, equipments, accounting standard 10. 14, mergers, amalgamation accounting. 15, that is EPS, no, sorry, employee benefits. 19, lease. 20, EPS, and 25, interim reports. So these are the accounting standard. Now, what type of question you will see? Sometime, let's say last to last year, they asked one question around last year only, not last to last year. The question was around the lease agreements. Now, lease finance, you have a dedicated units in your curriculum. This merger acquisition, you have a dedicated units in your RBWMs. Okay? So most sometimes they also interlink this one. And apart from this, like interim reports, it will come again and again. Property, plants, equipments, when you study the costing or the other part also, final reports, it will come again and again. In a cash flow statement, you have a dedicated units. Inventories, which is part of this, as well as the final reports. Disclosure, you have dedicated units in module B. So others, these are the part one. Okay, so you will see two type of question sometime. Like they asked one question around the merger and acquisition last year. The question was around, okay, they have explained the accounting standards. Okay, that's the accounting standard which deal with the merger and acquisition, by which the overall the distribution of assets and liabilities after that merger and everything which is get defined under this one. So now the question is, you have to fill that gap. So that gap is this. Like that's cash, like as per the accounting standard 3, the cash flow statements are further divided among how many parts? These kind of for half marker question. Sometime they'll enter in deep, they'll give you something like this. Let's say one side they have given these. In my session, in my shift, there was a 2 marks question, something like this. Let's say this is accounting standard 2, this is 3, this is 10, and this is 19. Now here they have mentioned about these particular one, and you have to match them correctly and you have to find out the right options. For 2 marks we got this particular one, right? Most of the time you'll see this type of question in your examination, right? So in your book they have given things in detail, but I'll not suggest keep, because it is very tough to memorize all these particular one, right? So you just have to stick to some areas, and with anything which is part of your further studies and all, that is very important. And you do not have to worry about that one also. When you'll study the lease or when you'll study the cash flow statement, you'll again see, as per the accounting standard 3, this is the definition. As per Indian accounting standard, this is the definition of cash flow, or this is the definition of others. So you do not have to waste your time here. You'll get things in your coming one, right? So, and we will do practice, lots of practice around these, all these. So you will be able to memorize this. Okay. So let's have a quick look. So accounting standard 1, disclosure of accounting policies, by which methods you are using or the other things you have to publish on website and all. Accounting standard 2, valuation of inventories, where if you study this particular one, where goods are interchangeable, you can only use FIFO and weighted average method. You cannot use LIFO method. Accounting standard 3, which is all about cash flow statement, and as per accounting standard 3 and Indian accounting standard 7, while you prepare your cash flow statement is very simple, inflow and outflow of cash. But these two accounting standard, they made it complex, right? So you have to further divide all these transactions among 3 different parts: operating activities, financing activities, and investing activities. Operating activities, which include core revenue generating activities; financing activities, which will impact your liability and assets, liability and equity, sorry; and investing activities, like investment in like inflow from sale of property, plants, equipments, or any investment, or your purchase of property, plants, investment in others, right? So accounting standard 4, which is contingencies and event occurring after the balance sheet date. Accounting standard 5, prior period item. So prior period items and changes, it is something, let's say we have like there is a machine or there is an asset whose value is 10 lakh as per the accounting year 2024-25. In 25, in next accounting period, let's say we are selling that particular business or the machine itself or the asset itself. When we sold that particular one, as per 24-25, it was 10 lakh, but when we actually sold it, we sold it for 12 lakh. That means you have to fix the prior period. So you have to add that particular one or adjust that particular. It can be deficit side or surplus side. So that is something which is generally part of this one. Accounting standard 7, construction contract. 9, revenue recognition. 10, property, plants, equipments. 11, effect of change in foreign exchange. This will also get asked sometime. Accounting standard 12, accounting for government grants. 13, accounting for investment. 14, accounting for amalgamation, mergers. 15, employee benefits. 16, borrowing costs. 17, segment reporting. 18, related party disclosures. Apart from this, 19, lease. 20, earning per share. 21, consolidated financial statement. 22, accounting for tax. This also get asked so many times. Tax on income, because module D. Right. 23, accounting for investment in associates. 24, discontinuing operations. 25, interim financial report. 26, intangible assets. 27, financial reporting of interest in joint ventures. 28, impairment of asset. 29, provisions, contingent liabilities and contingent asset. This is also part of your module D, right? So you'll get all these particular one in your coming session also, right? So that is the best way to remember this one. If you go for any sort of rectification in all now, it will take your huge time, like lots of time. But there is no point to spending that particular. In worst to worst cases, let's say there are 2 questions. Out of 2 questions, you miss 1 question. Okay? You won't be able to recall that particular one. So that is not a big loss, because during that particular period, let's say you spend 5 hours to memorize all these particular one, and you skip that. As of now, you use that 5 hours in some other. In 5 hours, you can study 2-3 topics, small topic, where you can score 5 to 6 marks instead of losing this 1 marks. And that I'll make sure ki I'll come up with lots of practice that you will be able to. You will be able 90% time you will be able to answer these particular questions, right? And during the exam week, we have some special sort tricks and others for these one. Right now, it is no point to involve in that particular one. So accounting standard 1. So this is something, there are some important accounting standards where you have to do, like as it is mentioned, sorry. So accounting, when it comes to accounting standard 1, so all significant policies adopted in preparation of the final financial statement should be disclosed with method, which tool you are using and everything. Any changes in accounting policies which has material effect. Material effect means which have made some money effect and all. So you have to disclose those particular one. Accounting standard 2 deal with the determination of value at which inventories are carried. Average cost or FIFO methods are permitted in case where goods are interchangeable. LIFO is not allowed. FIFO, first in, first out, and LIFO, last in, first out. Again, module D, while we do the costing and others, we will be discussing all these particular one in detail. Accounting standard 3, cash flow statement, and you have to prepare operating activities, investing activities, and financing activities. 5, deal with treatment of prior period item and extraordinary items. 10, property, plants, equipments. So let's say if we purchase some machinery, let's say our plant is located in Delhi and we purchase some machinery in Mumbai, and the purchase cost is supposed at 10 lakh, freight is supposed at 50,000, warehousing is supposed at 5,000, and transportation is okay, freight and transportation we have included. Test run is supposed at 5,000. Okay? So while you account this particular machinery in your book or in your balance sheet as an asset, so you have to add all these particular cost. The machine will cost you 10 lakh 50, 55, 10 lakh 60,000. So while you account your book, your cost will be 10.60 lakh, right? So these are the, which is like any other taxes also, okay? Any non-refundable taxes and all. So these will be part of your books. So when it comes to cost of property, plants, equipments, or any assets, tangible or intangible, so you have to add these particular one. Apart from that, you do not have, like let's say after some time, the value, the machine value, the day you purchase it was 10 lakh, after 5 days it become 15 lakh by any reason. So in your books it will be 10 lakh only, right? 10 lakh plus these particular, you will not add that 15 lakh plus that this, no. right? So you have to stick to purchase cost. While you come to the concepts and convention, so there is one concept which is called money measurement concept, and we have cost concept. So combination of these two, where we will be discussing this, and historical cost also, right? So accounting of fixed assets, property, plants, equipment, this. So like purchase price, import duty, taxable, direct cost to bringing the asset in its working condition. If any discount, so you have to minus this particular one, right? 15, accounting of retirement employee benefits, like by which methods. Let's say if there is a company who is showing we have given 10 crore rupees employee benefit to our employees. So by which methods you are accounting that particular one? By which way you reach to 15 crores? So you have to disclose that particular one also, right? 20, earning per share, EPS. How we calculate EPS? EPS is net profit after tax minus dividend. Profit after tax minus dividend divided by weighted number of shares. Okay. Accounting standard 25, which is interim reporting. Interim reporting means condensed balance sheet, means your summary of balance sheet. Let's say we have to present our final accounts or disclose our or publish our final accounts on annual basis. But in case of a listed company, they have to come up with on quarterly basis also. Okay? So you have to disclose. Like I hope everybody is aware about this one. Your bank also, they generally come up with their quarterly result. Those quarterly results are your interim reports, right? So you have to provide a summary of your balance sheet, summary of your profit and loss account, cash flow statement, and your note to accounts. By which way or in which format you are going to disclose them, that is generally given in accounting standard 25. Understood? So this is all about accounting standards. Now we have Indian accounting standards also, and we are working on these particular one, and even there are some guidelines around Indian accounting standard also, so that you have to take care, right? So Indian accounting standards, Indian accounting standards. So Indian accounting standard are accounting standards which is aligned with your IFRS, as I earlier told you. It is International Financial Reporting Standard. Mostly, apart from US, in US we have GAAP. Otherwise, in rest of the world, majorly economies, countries, they generally use IFRS, right? So, introduced to make Indian financial statement globally comparable and to attract global investors. So, what challenges we face? That accounting standard, I gave you a story of company X, Y, and Z. They are using different methods. Now, we are as an Indian company, we are using different method, and some other country they are using different method. So now, if they want to compare with our company, because while we'll present our reports, they have prepared in a different way. So that's why we are aligning our Indian accounting standards with IFRS. We are building these particular one on the basis of IFRS. So investors, they can easily relate the data or compare or interpret, so they can make their decision about these particular their investments and all, right? So Indian accounting standards are named and numbered similar to IFRS, but with additions and deletions to suit the Indian legal and economic environment. Issuing regulatory authorities when it comes to this one. Okay. So we have ICAI recommend the standards to NFRA, National Financing Reporting Authority, which became active from 2018 as a regulatory body for accounting and audits. Final notification of standard is done by Ministry of Corporate Affairs. 41 Indian accounting standards have been notified. 2 have been withdrawn. That means we have 39 right now. In case of conflict between Indian accounting standards and any Indian act, the act will be prevailed, right? So we'll give preference to the act, not to the Indian accounting standard. This statement is important. Please do remember this one, right? So this is the one. So which set of accounting standards to follow? This statement or this slide is very important. Static in nature. Currently 2 set we have taken. Accounting standards by ICAI, traditional Indian standards. Indian accounting standards notified by MCA and aligned with IFRS. So companies required to follow Indian accounting standards as per MCA notification, February 16, 2015. Companies whose equity or debt securities are listed or about to listed on Indian or foreign stock exchanges first. Unlisted companies with a net worth of 250 crores and above. Okay? Any company whose net worth, unlisted company, if it is a listed, it is mandatory they have to adopt this one. If they are unlisted and their net worth is 250 crores and above, they have to use these one. Holding subsidiary and joint venture and associate companies of these two, right? If there is a listed company like let's say Reliance, and their subsidiary is Jio, Reliance Jio, or Reliance Capital. So they have to use these particular. If there is an unlisted company, they also have some one subsidiary whose net worth is 50 crore. They also have to use the Indian accounting standards, right? So this is something which is very, very important one. And please do cross check this one. I guess there is no update. I'll also check this particular one once, right? Roadmap for implementation of Indian accounting standard, completely theoretical. You can go for this particular one. Please go through this one once, huh? The entire journey, how we build this. So Ministry of Corporate Affairs issued a roadmap on 18th of January 2016 for implementing Indian accounting standards. Schedule commercial bank, insurer and insurance companies, NBFCs. Implementation timelines was Indian accounting standard based on financial statements were to be prepared according to the starting from April 1st, 2018 with a comparative of 1st April 2017. Regulatory requirements bank for like RBI and for insurance it is IRDA as we have the regulators and all here. RBI circular mandated all scheduled commercial bank to comply with Indian accounting standard for a specified period. Prohibit early adoption of Indian accounting standard by bank. RBI committed to issuing guidelines clarification as needed. Legislative banking regulation we have same आपका earlier also and this also simply. This is something very important one. This get asked. I have seen this particular one in so many times. So please do remember this. 3 stages approaches for measuring expected credit loss. So bank, this is expected credit loss, ECL. This get asked so many times. Please do remember this. So bank are required to measure expected credit loss on financial instruments using 3 stage model based on change in credit risk since initial recognition. First, stage 1, which is 1 month to 12 months ECL, applies to assets non-credit impaired and with no significant increase in credit risk since recognition. ECL is based on the probability of default within the next 12 months. Again, there is a probability of default within next 12 months. Stage 1, 12-month ECL. Sorry. Stage 1, 12-month ECL, which is there is a probability of default within 12 months. So not credit impact and no significant increase in credit risk. Stage 2, lifetime ECL, non credit impact. So applied when there is a significant increase in credit risk since recognition, but asset is not yet credit impaired, means there is a probability, the probability of default is increasing, but there is no default by the borrower, right? So that is the one. A lifetime ECL, expected credit loss over the full life of the asset, is recognized. Stage 3, lifetime ECL, credit impaired, means the investors start defaulting the value. So apply when the asset become credit impaired due to events affecting future cash flows. A lifetime ECL is recognized. Interest revenue is calculated using original effective interest rate. Stage 1 and 2, gross carrying amount. Stage 3, written down amounts. Right? So this get asked so many times. Please do remember this particular one. This will help you in your upcoming examination, right? So list of accounting standards, Indian accounting standards, sorry. So please have a look around this particular one. Alright guys. So when it comes to the Indian accounting standards, list of Indian accounting standard, again, in my experience, in last 4 to 5 years, they never touch this particular portion, but it is given in your curriculum. Okay? They might ask some basic question similar to match the following or some core areas, which is part of your further curriculum and all. So from like those are a bit important. So we have to work around those, right? So we have first time adoption of Indian accounting standard. share-based payment, business combination, insurance contract, non-assets holdings. Then we have exploration for the evaluation of mineral resources, financial instruments, operating segments, financial instrument, consolidated financial statements, joint agreements like disclosure of interest in other entities, fair value measurements, regulatory deferrals, revenue from contracts and customers, leases. Then we have presentation. These are the similar one. Presentations of financial statement. Then we have inventories, statement of cash flow statement, accounting policies, changes in accounting estimates and errors, event after the reporting period, income tax, property, plants, equipments, employee benefits, and accounting for government grants and disclosure of government assistance. Okay, so these are the Indian accounting standards. Remaining, the effect of changes in foreign exchange rate, borrowing costs, related party disclosures, separate financial statements, investment in associates, financial reporting, hyperinflationary economies, financial instruments, presentations, earning per share, interim financial report, impairment of assets, provision, contingent liabilities, assets, intangible assets, investment property and agriculture. Now see, if you'll start with this from here to the next remaining all these, they are similar to your accounting standards, but we have some additions also. So that's why they are given in the front itself, so that you have to remember. You do not have to do any sort of ratification, but we'll do some sort of practice. We'll add these particular thing in practice. With that one, you will be able to mark your answers, right? Now, the final thing, that is US GAAP versus IFRS. One question you can expect, and like many times they have asked this particular one, the differences or the correct or incorrect statement between GAAP and IFRS, right? So GAAP, which is usually they are registered with the US SEC, the Securities Exchange Council, and they are applicable in US only, mostly in US and nearby countries. But in most of the world, we have IFRS. They have kind of a, like most of the economies, they use or they have aligned their accounting standards with IFRS. So we can have some sort of uniformity in the while we generally prepare our final accounts and all, right? So GAAP, I found this particular one which have the major information about the GAAP on internet. So meaning आपका US GAAP are set of rule in place in meant for the corporate accounting and financial reporting in US. This reporting method is mandatory for all public companies in the United States. Private companies can use, that is optional for them, right? So it helps accurate disclosure of financial statements, reduce confusion in minds, similar things like we are using the other one and all, right? You do not have to remember all these particular 10 key principles. Again, this is also not part of your curriculum, but just you can just make an understanding. Principle of consistency. Then we have permanence of methods. Then we have sincerity, non compensations, regulatory and prudence. We have continuity, materiality, utmost of good faith, and periodicity. So these are the basic three principles, generally accepted industry principles regulated by FASB. Then we have basic accounting principle and regulations. In your book also, this is the summary from your book. So generally accepted accounting principles of US, commonly known as US GAAP. So you refer to a set of commonly followed, it is kind of it is similar to your Indian accounting standard. Like for Indian businesses, we have prepared those particular one. Similarly, in US, you have US GAAP. So statement followed by accounting rules used for the preparing financial statement in US, especially for publicly traded and many private companies also they have this one for the transparency and consistency in financial reporting. Authority and regulation, the principle are not directly set by the government, but it is a result of joint efforts by the businesses and government. They are adopted by the US Securities and Exchange Commission, SEC. Although not legally mandatory, publicly traded companies must follow GAAP as per SEC requirements, right? So similar to India also. GAAP versus IFRS. SEC is considering transitioning from GAAP to IFRS, but progress is slow due to significant differences between these two. Legal system influences and different standard. Basic objectives, these are the same similar things. Everywhere you'll get these all particular things in a same manner, so in a simple way, right? IFRS, International Financial Reporting Standards. So IFRS is a set of accounting standards developed by IASB, which is International Accounting Standard Board. Please do remember this one, IASB. IFRS provide a global framework for how public companies should prepare and disclose their financial statements. Because this is something, their agenda from beginning was global, right? So let's say if we have to compare companies from the different countries, because every country they have their different regulators, and every regulators they have their different set of guidelines and all. So if we want to create some sort of uniformity, like we have places like Gift City, that IFSCA and all. So this is something which we generally trying to achieve through these particular one. IFRS is a set of globally accepted accounting standard designed to make company accounts understandable, comparable, and reliable across countries. Really, origin in others. Please do remember this. So, on April 1st, 2001, the International Accounting Standard Board, like in India, we have ASB Accounting Standard Board under ICAI. So here we have IASB. Currently, there are 41 international accounting standards and 17 IFRS. Governing body is your International Accounting Standard Board is independent, which is the foundation is laid by the IFRS. Objective again similar one, right? Now this is given in your book, so which is very important one. You have to go through this. The earlier one also. This is the summary of from your book itself. The comparison part. Most of the time, or like whenever you expect any question from this particular one, so this is something which is the most important part. Like if they'll ask question, it will be for 1 marks or 2 marks, right? Well, it comes to the comparison one. So GAAP, we have GAAP and we have IFRS first. Generally accepted accounting definition, we all know, right? So purpose of framework, US GAAP framework has no provision for expressly require management to consider the framework in the absence of standard or interruptions for any issue. Here, company management is expressly required to consider the framework if there is no standard or interpretations for an issue. Then underlying assumptions, going concern assumptions is not well adopted in US GAAP. So when IFRS give prominence to underlying assumptions such as accrual basis accounting and going concerns. So these are the core one, but going concern is not part of the GAAP. So going concern is like a business is, we always used to say this, business is a going concern. That means you cannot decide the life of that particular business. So as transaction will happen, you have to account those particular one, and you cannot fix the life of that particular business. It will be run for 10 years or 15 years, or it can be go for 1,000 years, right? GAAP, we have GAAP. So objective of financial statements in general, broad focus on to provide broad focus to provide relevant information to a wide range of stakeholders, provide separate objectives for business and non-business entities, broad focus to provide relevant information to wide range of stakeholders, provide the same for your business and non-business entities. Qualitative characteristics, revenue, reliability, comparability, and understandability. GAAP establishes a hierarchy of these characteristics: relevance and reliability and primary qualities. Comparability is secondary, and understandability is treated as under specific one. Please do remember relevance and reliability at primary, then comparability is secondary, and then understandability comes at the end. Relevance, reliability, comparability, and understandability. The IASB framework state that its decision cannot be based upon specific circumstances of individual users. In GAP, we are using first relevance and reliability. Then we are coming to this based on that particular we are making judgment. They are saying that there is like you cannot make judgment based on relevance and reliability only. You have to use all these one. Definition of an asset. US GAAP framework define an asset as future economic benefit. IFRS defined as asset as a resource from which future income benefit will flow to the companies. Both almost similar. Fixed asset such as a property, plants, equipments are valued using the cost model, the historical value of the assets less the depreciation. IFRS, the revaluation models, which is based on the fair value of the on the date of evaluation less the subsequent accumulated depreciation and impairment losses, right? How we are basically accounting the value of a fixed asset. Here we are using this method, basically the fair value. We are using value using the cost model, cost methods, the purchase cost including everything minus depreciation. Here we are doing revaluations, fair value minus depreciation and any other losses. Inventory valuation, we can use LIFO, FIFO or weighted average. Here as per IFRS, we can use FIFO or weighted average only. LIFO is not allowed as per this particular one. Intangibles in GAP acquire intangible assets like research and development, advertising cost are recognized at fair value. They are not recognized if asset will have a future economic benefit and has measure reliability as well, right? So this is the basic differences between your GAP and IFRS. You can expect one question for 1 marks or 2 marks, right? So whenever they'll ask the comparison, for sure it will be for 1 marks most of the time. And sometime like the question is complex, so they can ask for 2 marks also. Summary. So a role of accounting. Now, like what is accounting? It is a language of business. So accounting is a vital service activity in business concerned with the collection, recording, evaluation and communication of financial results. It helps track profits, assets and liabilities systematically to support business decision. Functions of accountancy: they record, prepare financial statements, interpret financial data and decision making, support legal compliances. Importance of accountancy: it follow a set of concept, conventions and principles, ensuring consistency in systematic recordings in a transaction. With a rise of management accounting, its role has shifted from just recording to aiding a strategic decisions. Accounting standards, set of principles. Accounting standards, we have accounting standard boards which generally comes under Institute of Chartered Accountants of India. ICAI has issued 29 mandatory and 3 non-mandatory accounting standards to date, right? So this is all about your overall summary things and all, right? Now as I told you, like first unit will take bit like we have spent around 1 hour 30 minutes. I hope you enjoy this particular one. You learn a lot of things. When it comes to basic accountancy procedure, it involves concepts of accountancy. Then we have going concern, concepts like money measurement concept, cost concepts and others. Going concern entity, we have dual aspect of dual entry system, a double entry system. Every debit has corresponding credit. Principle of conservatism, revenue recognition and realizations, accrual versus cash basis accounting. So these are the major subtopics which are generally part of this one. So downside 2 marks. Sometime you can also face for 3 marks question based on this particular one also. So very important one, right? When it comes to concepts and conventions of accountancy, basically these are rules, or you can say these are the principles of accountancy. While you prepare your books, while you do the journal entries, so you have to follow some methods, some concepts while you prepare your final reports, those final reports should be the follow should some sort of conventions or the core principles, they are generally known as this. Okay? So concepts and conventions, like here is we have the entire things. Okay? So at the recording stage, we generally follow the concepts like cost concept, we have money measurement concept, business entity concept, realization concept, dual aspect of accountancy, and historical record concept. These are the concepts at this time of recording. So like while you prepare your while you do the journal entries or ledger or your trial balance and all, so you have to take care around these particular things while you prepare your final reports. So the final report, they should reflect these particular conventions. So like we have going concern, we have matching concept, we have accounting period concept, convention of conservatism, convention of full disclosure, materiality, and consistency, right? So this is at the reporting stage, means while you preparing your final accounts, means while you're preparing your profit and loss account, balance sheet, and cash flow statement. So in this particular session, or this entire session is around these many terminologies. So first we will be discussing around the concepts, then we will discuss the conventions, then we'll come to the cash basis accrual accounting. Basically we follow accrual basis of accountancy, where we do some sort of, like, let's say in case of loan, you have given loan to some customers, so we do accounting on these days, in the future also you will get the AMI. But when that loan become non-performing asset, so you have to shift from accrual to cash basis. As you will receive the money, then only you will account that particular transaction itself. So let's start the session with the concepts of accountancy. So when it comes to the concepts of accountancy, these are some core concepts of accountancy. While you prepare your final accounts, you have to take care around these things. So first one is money measurement concept. I hope you guys remember this particular one. So anything which can be measured into money, or anything or any transaction which has financial character, that will be part of your books. That means you are going to record that particular one through journal entries. Anything which does not have financial character, or which cannot be measured into money, like as I gave you an example of health of proprietors or managers, or inflation deflation, so you do not have to account that particular one. The another one is business entity concept, very important concept again. So business entity concept, which generally separate businesses from their owners or proprietors, right? So money contributed by owner is liability on the firm, right? The third, then we have cost concept. We do not account assets on their future cost or their market cost. We account on purchase cost, including the test run, freight, non-refundable taxes and all. Realization concept is something, if things like, let's say if you are starting some XYZ business, so until things get realized, that means there is a movement from seller to buyers. Let's say you sell something, you did some sale to some ABC companies, that sale happened, then only you will record that particular one. You do not account the expectations and all. Going concern, business is the going concern. So that means business, like you do not like, it means business, you cannot account things for a fixed time duration, like 1 year, 10 year, 15 years. As transaction will happen, accordingly you have to record things. The final one is dual aspect of accountancy, or dual aspect concept, which is every debit has a corresponding equal credit. That means for every transaction will have two entries, where one account will get debited and another account will get credited with the same value. Let's decode all these particular one by one. So first one is business entity concept. So you have to build your strong understanding around this particular one, because very important. Okay. So let's assume there is a person called Mr. X, who started a business called XYZ Limited. Let's say he started this particular one with 5 crore rupees. So this 5 crore rupees is liability on this business. Okay, this is generally liability. This is liability on this particular firm. Okay. So business entity concept, also known as entity concept, which generally separate owners, or which generally separate businesses from their owners. It draw a line between these two. Every transactions which will happen in this particular business, they'll be accounted in the name of XYZ Limited or in the name of this business entity, not in the name of proprietors, owners, or shareholders. Understood? So basically, simply saying, when it comes to the business entity concept, it is, as per this particular concept, business is a separate economic unit. It is an artificial person. It is it can, why it is called person, it can enter into contract, it can be sued, they can sue someone, and it has its own identity, and that identity is given by law. Law is, it can be Companies Act, LLP, or any other act, right? BR Act and all. So they generally comes under this. So anything that business is doing, that will be accounted in this name. Even the money contributed by owner, that is given, that is generally categorized as liability. When you will prepare the balance sheet of this particular company, so this liability will be accounted as, yeah, let's say this is liability side. So this 5 crore rupees, which is generally known as capital, it is also known as a risk capital, it will be accounted at liability side. It is owner's money, it is equity, right? And asset side, it is your cash, day one, it is 5 crore rupees. So something like this, right? Even let's say after some time, this Mr. X, if he withdraws some money from this particular business, so that will be accounted as drawing. So that is the logic behind this. So while you do the accounting, you have to be very careful. You have to account, or you have to do entries in the name of business itself, not in the name of proprietors. So the concept separate the entity of proprietors from the business transaction. Capital contributed by owners is liability for the business, because business is different from owners. Any money withdrawn by proprietor is drawing. All entries are kept in the point of view of business, not in the form of owners. An enterprise is economic unit which separate from the owners. It is a separate economic unit which is, it is an artificial person which is created by law itself. Okay? So there are some pointers which given in your book itself, so you can have more confidence on these. Any money withdrawn by the proprietors treated as drawing. This we have discussed. Profit is liability, while loss is an asset. So you have to remember these small pointers. Why profit is liability? Let's say if you are generating some profit, so that will be come to the that liability side in owner's equity. It will be part of retained earnings, right? Financial performance of entity is ascertained by recording the business revenues and expenses, useful at time of liquidation for determining payout to the various shareholders, like equity shareholders, proprietors, or debtors, and others, right? So business entity concept or entity concept, this concept separate the entity of the proprietors from the business transaction. The capital contributed by the owner is liability for the business, because businesses which is an artificial person is different from the owners itself. Understood? First one. Second one, money measurement concept. So this we have discussed yesterday also. So when it comes to money measurement concept, while you record the transaction, you are going to record only transaction which has financial character, right? So that means anything which can be measured into money, that will be part of your books. Anything which cannot be measured into money, that is not going to part of your books. As simple as that, right? So every transaction is measured in term of money, like sales, production, wages in this. Health of proprietor or manager is not taken into the books, although it has an important or great impact on the businesses, because it does not have financial characters, right? Inflation or deflation not included in the value of an asset itself. Understood? So again, we'll go through this one. So health of proprietor or manager is not taking, same line. We do not include inflation and deflation in the value of any asset. Let's say the value of that asset is book value is 10 lakh, you are not going to adjust the inflation, or that means you are not going to depreciate the value of that particular asset for the inflation adjustment and all, right? All accounting transactions are recorded in quantitative terms for easy comparison of performance between firms. So, money measurement concept. Every transaction that is recorded in books of accounts must be measured in terms of money. All transactions are converted into a common form, which is money. Example like sales, production, and others are this one, right? Next concept, guys, cost concept. When it comes to the concept, you have to apply accounting standard 10 also. Okay? That purchase cost plus non-refundable taxes, test run, and others. So, like let's say if we have purchase of machinery worth rupees 10 lakh, now after 10 days the value of that machine in the market is become 15 lakh. You are not going to increase the value in your books because you have spent only 10 lakh rupees for that particular machine. It will remain 10 lakh. Okay? So annual basis you have to account the depreciation, and accordingly you have to manage your book or maintain your book. In case of that fair value accounting, we do these kind of things, but that is for a limited purpose, like for valuation of the business or for mergers, acquisitions and all. But in real world, while we do the normal accounting, we have to stick to the purchase cost plus non-refundable taxes, test run, warehousing cost, if any, then that will be the overall cost of that particular machinery, and that will be the book value of for that machine, right? So every cost concept, every business transaction is recorded in book of accounts at its cost price, irrespective of the market price. As I gave you an example, like you purchase for 10 lakh, after some time it become 12 lakh. You are not going to adjust your book. You will stick to the 10 lakh only. All monetary transactions are recorded at historical cost, the cost which you have paid for that machine. The machinery is recorded in books by the amount which paid to the suppliers plus the expenses of bringing and installing the machinery which are necessary to put in working conditions, right? So fixed assets are kept at the cost of purchase, not the market value. Every transaction is recorded with the present value and not any future value. Unrealized gain are ignored. Okay? So we, let's say if you have some investment and all, so you have some expectation. You are not going to account those investment expectations, right? An item that has no cost, it is not taken in your books. So this is the cost concept. Very simple. Now the next one is going concern concept. It is very simple. Business is a going concern. I hope you heard this line so many times. So when what does it mean? Like you cannot decide the life of that business. Okay? It can go for 100 or in 100 is thousands of years. Like we have Tata or Reliance and other companies. Okay? So as transaction will happen, accordingly you have to record. You do not have to worry about this business will go beyond 1 year or not. No, that is not your case. You just have to be positive approach, like whatever we are doing, so we are doing for the sake of business, and as transaction will happen, you have to record those, right? So going concern concept, this concept indicate that business is a going concern. This means that business continue with the activities as usual and the transaction are recorded accordingly. Okay? That means you are, let's say you are going to run that business 10 years, so you will not do transaction for the 10 years or accounting for the 10 years or even for the 1 years. As transaction will occur accordingly, that in date wise and amount wise you have to account those particular one. If an expense is incurred and utility is consumed during the year, then it is treated as expense, otherwise it is recorded in asset. Okay? So like let's say we have given rent, we have paid rent because we consume that particular one, that is your revenue expenditure, and that is your expense. You purchase a machinery whose life is 10 years or 15 years, the useful life of that particular machine, so you are going to use that machine for 15 years, so that will be part of your asset side in your balance sheet. So applications, fixed assets are valued at cost, not at the market value. Depreciation is provided based on the total number of years, let's say the useful life or the economic life of the assets. Balances of 1 years carried forward to the next year. Okay, let's say the value of asset is 10 crore rupees, sorry 10 lakh rupees. 1 lakh rupees is the depreciation for first year. So next year your book value will be 9 lakh rupees at your asset side. Okay? Reserve and surplus, reserve and provisions are created for future liability. Like in case of depreciation, you can create 1 lakh rupees reserve. So provision, so you can replace that particular machine after 10 years. Or we create provision for non-performing asset. Deferred revenue expenditures are written off over a time of years. It also helps investors as they can assume the life of the business entity to be infinite. So this is the logic, right? Double entry system, very simple. Every account, like as I told you, every debit has a corresponding equal credit. Let's say, as I gave you an example yesterday, na? So let's say we purchase a machinery. We purchase a machinery worth rupees 10 lakh in cash. So why? How you will account this particular one? Debit machinery account by 10 lakh rupees, credit cash account by 10 lakh rupees. So every debit, we follow dual aspect of accountancy. For every transaction, there will be two entries. One account will get debited, another account will get credited. So we can achieve the accuracy while we are recording these particular things. It make accounting bit complex, but it help us to achieve the maximum accuracy just because of this concept, right? So every transaction has two aspects. One is one account get debited, another account get credited. Which account get debited or which account get credited, this we will understand in next session itself, where we have three type of accounts: real account, nominal account, and personal account. And we do have their golden rules. You have to remember, and if you like, with the help of practice and all, you will be able to remember all these golden rules and all. Like I hope you heard about these one. Like in case of real account, debit what comes in, credit what goes out. Like as I apply here, machine is a real account. Again, it comes in the real account. So debit what comes in machine, and what goes out, cash. In case of nominal account, debit all the expenses or losses, credit all income and gain. In case of personal account, debit the receiver, credit the giver. So we will understand these one. A scientific system in which the business transaction are recorded in books of account in two accounts. One is debited and another one is credited. Crux of the accountancy is to find out out of two account affected, and which account get debited, which account get credited. So we will make sure you will be able to find out those particular cases as well, right? Next one, आपका realization concept. So as I gave you an example also, realization is something like until that transaction is realized. Okay, let's say you started XYZ Limited and you have some expectation. You are not going to account those expectations. You will account the day when the goods pass from seller to buyers. Now buyer is legally bound to pay you for that particular transaction, so you will record that particular one, right? So realization concept, this concept tells us when is revenue treated as realized or earned. It is treated as realized or earned on the date when property of goods passes to buyers and he become legally liable to pay for the goods itself, right? So no future income is considered. You are not going to account expectations. Goods sold on approval will not be included in sales but taken in cost only. The rule of revenue recognition determine that earning process should be either complete or near completion, like approvals or आपका it is about to complete also, right? Matching concept. So matching concept is like that revenue and income. So we have used that property for the office rent and we have paid for this one. So this was the expense and this was the consumption. So that is the matching one. Okay, so accounting periods, we follow these one. So this is the context explained. We have matched the income of certain period with expenses of the that period only. Let's say income of financial year 25-26. So expenses with expenses of 25-26. The term matching refer to the close relationship that exists between a certain expired cost and revenue realized as a result of incurring those costs. The justification of the matching concept arise from accounting period concept only. So accounting period means your financial year, April to March. All adjustment regarding the period expenses, outstanding expenses are made in the financial accounts, in the final accounts. Deferred revenue expenditure concept arise due to this particular concept itself. Next one. Now convention. So concept we have done with the concept. The another part is convention. Conventions means principle. These are like while you prepare the final reports, so you have to remember these particular ones. Okay? And your final report should bound around these particular principles and all. So we have major principle like full disclosure. So like by like which methods we are using to prepare those particular accounts, final reports, what method we have used for the depreciation, inventory and others. So there should be a clear-cut disclosure. So investors or the stakeholders, they can make their understanding about your final reports. Materiality, anything which has material effect or which has money effect, that should be a part of your books. Conservatism, it is something, conservatism, that anticipated profit to be ignored, expected losses to be accounted, like provision for depreciation or provision for non-performing asset. Consistency, we should have some sort of consistency in our reports. Like let's say if you are using one method, that method should be used throughout the economic life of that particular asset. If you are changing, there should be a disclosure for that change. Ki what material effect we got after changing that depreciation method or inventory method. So we will start with disclosure only, right? So entries are made in a way so that provide honestly all information relating to the activities of the business, like disclosure of material effect, anything which has money effect and all. Okay. Contingent liabilities, if any, market value of investment and all. So like while you preparing or presenting your final reports, the person or the stakeholders who is going through those particular report, they can build a crystal clear understanding around those particular one. Convention of consistency, if you are using some method, let's say if you are using written down value method for a for depreciation on your machineries, so you should continuously use the same method. For any sake, if you are changing that particular one and due to that change there is some material effect, you have to disclose those one, right? So convention of consistency, if method is selected for recording and reporting purpose, it must be regularly followed in the future also. Next one, conservatism. All possible losses to be taken into consideration, anticipated profit to be ignored. Yes, this is the crux of this one, summary of this one. Okay. So that means if we have some expected losses on our assets, you can make provision for them. If you have like depreciation, you can make provision. If you have some expected gain from your machine or any investment and all, you do not have to account that particular one. Something related to that realization concept. So creation of provision for doubtful asset is allowed. Value of stock, contingency reserve. So these things like where we have some sort of possible losses, you can account them. But if you have some sort of possible profits from these particular one, you have to ignore that, right? So these were the conventions. Now the final part from this particular unit is your accrual basis accounting and cash basis. Usually we do accrual basis accounting in case of banking system. That means when let's say we enter into a loan agreements and we know we are going to receive the EMIs on 5th of every month. So for that one, like for the entire years, we generally do the accountings. This every month we'll get this. So in a year we'll receive this money. So that is accrual basis where you are doing accounting in advance for the future transaction. But when it comes to the cash basis, when that asset become non-performing, now no one knows when you are going to receive that particular money. So in that case, once you'll receive, then only you will account. So in case of NPA, you'll follow the cash basis. Otherwise, we usually follow accrual basis in our banking system. So the accrual concept distinguishes between the receipt and payment of cash and the legal right obligations to receive or pay. It recognizes the cash flow and the actual transaction may not align in the timings. So revenue recognition and expense treatments can occur before or after the legal right to receive arise. If right has not arisen, the receipt is not considered revenue yet. If the right exists, revenue is recognized even if the cash received later. Okay? As I gave you an example of that loan accounts, which asset we have created. Expense treatment. Expenses are recorded when they are due, not when they paid. Advance payments or like interest payments and others are not treated as expenses. They receive the receiver is treated as a debtor until the amount is due. If an expense is incurred but not yet paid, it is recorded and shown as creditors. So essential features for this particular one, this is the one. Okay, just you have to stick to this much of content. Revenue is recorded as it earned. Cost are matched to a revenue based on the time period for accurate income measurement. Uncharged costs are carried forward and reviewed. Cost losing future utility can are written off as a losses itself, right? So this is all about your unit 2. Very small unit, but the concepts and convention part is the most important. Every time from last 3 years, there is one or two question around that particular one. Okay? We will be practicing a number of questions based on that particular one also. Okay? So let's sum up first. So accounting record the transactions in term of money. Accountancy follow a set of concepts, convention and principles. The two system of recording entries in books of account are a single entry system and double entry system of bookkeeping. But we do follow double entry system. Every debit has a corresponding equal credit. Single column where we are doing only credit or only debit. The method of accounting that may be adopted for preparing financial statement are cash, then we have mercantile and hybrid system of accounting. Accounting is a system evolve to achieve a set of objectives that we have discussed in our previous session. In order to achieve these objectives, a systematic record of all business transaction is maintained for the interested parties. There are certain rules and regulations that are used as guidelines to prepare, maintain and record all transactions in the form of accounting books. These are known as these rules and conventions are known as generally accepted accounting principle gap or basic accounting concepts. The concepts can be classified into two broad groups. Concepts observed during the recording stage like money measurement, business entity, cost concept. Concept to observe during the reporting stage like आपका full disclosure, a consistency, and the other one also. So this is all about your unit 2, right? So record keeping basics, account categories. This is something which is the most important. Debit and credit concept, which is led by this particular one only. Accounting, columnar, and journalizing. These are the areas. Very small unit, but very important one, right? So we will start our today's discussion, which is the most important area, these two subtopics. Then we'll come to the journal entries or your ledger. If you'll open your book, you'll see first journal entries and ledger. Because if you'll have understanding around these particular one, you will be easily able to understand make your understanding toward the journal and ledger also. Okay? So that's why I'm covering this particular thing first, because this is like the most important. So accordingly we will prepare. So guys, when it comes to the accounting, so we have three type of accounts. One is real accounts. Real accounts which generally deal with all the assets of the firms, including tangible or intangible. Tangible means tangible like property, plants, equipments which we can touch and feel, and intangible like goodwill, patent, copyrights, trademarks, we all know, right? When it comes to personal account which include all the persons, so interaction of that company with any person, including artificial person. So we have three further type of these particular account: natural personal, artificial person, and representative person. Then third one is nominal account. When it comes to nominal account, nominal means which exists in name only. So basically, these type of accounts, they generally deal with all expenses and incomes of that particular business. Now, when it comes to the golden rule, so real accounts, debit what comes in, debit what comes in. So many times this things also get asked, okay? And credit what goes out, credit what goes out. Okay, so first one. Second one, when it comes to personal account, debit the receiver and credit the giver. You just have to remember all these particular one. And when it comes to the nominal account, debit all expenses or losses and credit all income and gain. Credit all income and gain. So these are the golden rules. These rules will help you to do the journal entries, and from that only your accounting will get started, right? So please do remember these particular one. They are very, very important for your basic understanding, right? So we have three type of accounts in our accounting system. Personal account, which is like natural person, artificial person, representative person. When it comes to real accounts, so we have tangible and intangible. We have nominal accounts, which is expense and losses and income and gain. And the golden rule is personal account, debit the receiver, credit the giver, debit what comes in, credit what goes out. And in case of nominal account, it is debit all expenses and losses, credit all income and gain. So this is the entire story which you guys are going to build your understanding in next 10 to 15 minutes, right? So please do remember golden rules again. So account to be debited, account to be credited. In case of personal account, receiver will get debited, giver will get credited. In case of real account, what comes in and what goes out. In case of nominal account, expenses and losses get debited and income and gain which get credited, right? So we'll come to this particular understanding, but just build concepts around these particular things. So one by one, let's start this particular discussion. So the very first one is real account. When it comes to real account, as I told you, so real accounts will generally deal with all assets of the firm. Assets could be tangible, which we can touch, like machinery, like property, like plants. Intangible, like patent, copyrights, goodwill, trademarks. All these are basically intangible, right? So for if let's say now how you will do these particular thing. Let's say we purchase machinery worth rupees 10 lakh in cash. So that means now machinery is a real account. Now you have to build these kind of link. So machine is a real account, it is an asset. So it is a real account. So you have to apply the golden rule of debit what comes in, credit what goes out. That means you have to debit machine to 10 lakh rupees by credit cash by 10 lakh rupees. So because of that dual aspect of accountancy, every debit has a corresponding equal credit. So 10 lakh, 10 lakh. Debit what comes in, the in is machine and out is cash in this particular case. So this way you have to remember these particular one. If you'll apply these particular one, believe me, those half marker question you will be able to solve. Even in next unit, when it comes to the rectifications, you will be able to solve next to next unit, unit number 5. So that is something related to this one. So real accounts, the transaction below, like let's say we have a transaction, purchase furniture rupees 5 lakh in cash. So purchase furniture rupees 5 lakh in cash. So what is coming in? So in is aapka furniture and going out is cash. So what will be your correct entry? Furniture to cash, 5 lakh, 5 lakh. So furniture account debited to cash account, amount is 5 lakh and 5 lakh. So this is your first type of account, which is called a real account, right? So real accounts, now this is the conceptual part. So you can go through this one. All assets of the firm which are tangible or intangible fall under the category of real account. We do not close these accounts at the end of accounting year and appear in the balance sheet. So basically, let's say we purchase a machinery worth rupees 10 lakh in cash, and the useful life of that particular machine is supposed at 10 years. So that machinery will be part of your balance sheet. It will be comes under the category of assets, and it will remain in your balance sheet for next 10 years. So that's why we do not close these particular one in a particular accounting period. So even let's say you have purchased some furniture in our previous case. So whatever the useful life of that particular furniture, that will be part of your balance sheet for those many years, right? So we carry forward the balances. Carry forward balances is something which is the purchase cost or book value of the year minus depreciation. Let's say the machine value was 10 lakh and useful life is supposed that 10 years. Okay, so 10 years. And let's say we are accounting depreciation by using straight line method. That means straight line method, how we calculate? You cost minus salvage value, assuming there is no salvage value, divide by year. So depreciation will be 1 lakh. So first year value, book value will be 10 lakh. Second year, how you will calculate? 10 lakh minus 1 lakh. So the book value, carried forward book value in asset side will be 9 lakh. Third year, it will be 8 years, 8 lakhs, then 7 lakhs. This way, you have to account that particular one, right? So tangible real accounts are related to things that can be touched and felt physically. Few examples like building, machinery, stock, lands, and others. Intangible real accounts are related to things that can't be touched and felt physically, like your goodwill, trademarks, patents, copyrights. So they generally fall under this particular category. I hope this is clear. So the very first type of account, that is called your real account. So now you have to prepare very well, because see, you can see 2-3 type of question. One type that can be something like this. So that was part of my examination also. Let's say here they have given real accounts, right? Then aapka nominal account, one question that I have already discussed you in that PYQ session. And then we have, let's say, personal account. And this side they'll give entries, and then they'll ask you to match these particular one, and for correct match they'll give you 2 marks. So that kind of things which you have to prepare, right? So the basic is this. If you understood basic very well, you will be able to solve any type of question based on these. So now next one is personal account. When it comes to personal account, so personal accounts which generally deal with persons including artificial person. Artificial person means your companies, or any company or any artificial persons like XYZ, ABC Bank, or with any other while you are dealing with any other company, artificial person, or it can be Ram Shyam, debtors, creditors, and other also, right? And representative person, personal account is basically which is going to represent the artificial person or the natural person. Like let's prepaid rent, prepaid a sale, or prepaid expenses. So they generally comes under your the category of representative person, right? So the golden rule is debit the receiver and credit the giver. Let's say there is one transaction. Let's assume there is a transaction. So paid, let's say there is a transaction paid ABC Limited 1 crore by check. Let's say, so you suppose that you are preparing account for XYZ Limited, and your company had paid 1 crore rupees to ABC Limited by check. So in this particular case, what will be your correct entries for this one? So who is going to receive? ABC is receiving, so you'll debit this particular one. So debit ABC. You have made payment through the check, so you have to credit this particular one, right? So credit ABC, credit to bank account. Check is cleared by the bank, so your entry will be debit ABC Limited by 1 crore to bank accounts. Why 1 crore rupees? So this will be your entry for this particular one, right? So personal account, when it comes to personal account, which are related to individual, firm, companies, etc. Examples like debtors, creditors, bank, outstanding account, outstanding, prepaid. These are the representative personal team. Then we have account of customers, account of goods, suppliers, capital drawings. They all generally comes under the category of your personal account, right? So now we have further categorization of personal account, but the golden rule will remain same, right? That is not going to change. Debit the receiver, credit the giver. That will apply to all the three type of personal account, right? So first, natural person like human beings. So this is your natural personal. Artificial personal is companies, ABC Limited, XYZ Bank, or anything else. Representative personal, which is going to represent either artificial person or your natural person, right? So like prepaid salary, that is a representative account for the natural account. Prepaid rent, so it is your representative account for artificial company or the others one. So this way you have to remember this. So let's go through these one. So natural person are human beings. Therefore, we include the account belonging to them under this particular head. For like debtors, creditors, capital drawings, they all generally comes under this one. When it comes to artificial personnel are not human beings but can act and work like human, like companies. So let's say a joint stock company. So what I told you in that entity concept, business is a separate entity which is created by law. It is an artificial person created by law. Law can be Companies Act or any other act, right? So that is the artificial person, that they can act like human. They can enter into agreements. They can enter into sales agreement, purchase agreement like us, or they can sue someone, or they can be sued by someone. So these kind of things, but they do not have any physical appearance. So that's why they are generally called artificial person. So they have separate entity in the eye of law and are capable to enter into agreements. These include HUF, partnership firm, insurance companies, cooperative societies, companies, municipal corporation, hospitals, bank, government bodies, and others. Representative personal, third type is which is going to represent artificial or your natural person. Like, so these accounts represent the account of natural or artificial persons when expenses become outstanding or prepaid. As I gave you, prepaid rent, prepaid salary, right? So, or outstanding salary, natural person, outstanding rent, your artificial person. So this kind of things. So income become accrued or unearned, they fall under the this category, like outstanding salary, prepaid rent, accrued interest, unearned brokerage and all. So they generally comes under this one. So again, very important one. Sometime you can see 1 marks question around the differences between these three, or sometimes it is for half marks also, which is like further classification of your which of the following is not a further classification of personal accounts. So you have to remember all these three, right? Very simple. Golden rule will remain same. Debit the receiver, credit the giver. So like we have one entry, paid XYZ Limited 1 lakh by check. Now you will be able to make this particular one. So XYZ Limited is going to receive, so their account will get debited. Check will be paid or cleared by the bank. So bank account will get debited in this case, right? So XYZ Limited to bank account. So what will be your journal entry for this particular one? XYZ Limited to debit, XYZ Limited to bank account. So this will be your entry. Amount will remain same, 1 lakh, 1 lakh, because every debit has a corresponding equal credit. Understood? Now the final type of account, which is nominal account. Nominal means which exists in name only. That means we do not carry forward these type of accounts for the next accounting period. So we close their income and expenses in a particular accounting period, right? So you are not going to carry forward the balances of nominal account for the next year. So you have to basically, we generally close within the accounting period itself. So when it comes to the golden rule, so golden rule is debit all expenses or losses. You can also add losses, and credit all income or gain. Income or gain, right? So let's say uh, I'll give you an example. Purchase goods worth rupees 5 lakh, let's say by check, by check, by check. So what will be your correct answer? Now purchase goods आपका, ठीक है, it can be any purchase, ठीक है. So purchase account will get debited because it is an expense for the business, right? So purchase to bank account. So what will be your correct entry for this one? Purchase account debited to bank account 5 lakh, 5 lakh. So this will be your entry for this one. Let's say paid in premium, insurance premium worth rupees 1 lakh in cash. So insurance premium is your expense. So what you have to do, you have to debit the premium accounts to cash account. So that is your entry for this particular one, right? So here purchase goods worth rupees 15,000 in cash. So purchase account get debited to cash account. So this will be your right entry for this particular one, right? So purchase account debited to cash accounts 15,000, 15,000. So that will be entry for this particular one, right? So nominal account are the accounts relating to expenses, losses, income and gain. The dictionary meaning of this nominal means which exist in name only, like purchase account, salary account, commission received, bad debts. So all these are generally comes under this category. These are temporary accounts, and thus we do not transfer their balances to the trading and profit and loss accounts at the end of the accounting period. Therefore, these accounts have no balances. Sorry, these are the temporary accounts. So thus we need to transfer their balances to trading accounts or your profit and loss accounts at the end of the accounting period. So that means we are not going to carry forward these particular entries for the next year, right? So no balances to be carried forward for next year as they are closed. So the golden rule was debit all expenses and credit all income. So this is your this zone, right? So now so here we have a summary also. Personal account. So like personal account like bank, Tata Iron, Santosh, Capital. Capital means risk capital, the owner. We have bank loan, artificial person. We have rent outstanding, represented personal. Real accounts, assets, tangible, intangible, plant, machinery, investment, land, building, stock, bills, receivables, trademark, cash. Nominal accounts, interest, salaries, rent, carriage, commission received, paid, insurance premium or claims, discount received, wages. So these are the three different type of accounts. I hope this is clear. So you have to be very careful around these particular. The first part, or almost 70% of this particular curriculum or this unit is based on these particular. And even these things are also going to help you in your unit number 5 while you correct the journal entries and all, right? So please do careful. And every year 2 marks question around the different type of accounts. So you have to, you can get 2 3 type of questions. One is, as I told you earlier also, that match the following. So real accounts, right? Real, nominal, personal. Then this side you'll get the entries. Then you have to match those particular one questions for 2 marks. Another type of question, this I have already shown you in our practice portion, or that during that module A revision things. Another question is, which of the following statement is true or wrong about the real accounts or personal account? Or the another question is, while they are ask you, let's say there is an entry given, purchase machinery worth rupees 50 lakhs in cash. So which account will get debited, which account will get credited? So these kind of questions. So this is for 2 marks. this is for 1 marks, and this is for half marks. So this type of question you can expect based on these particular. So we will practice all these one. Then the next part is journal. So I hope you guys remember when it comes to the entire accounting things. So it start with the journal entries. Okay, it start with journal entries where basically anything which can be measured into money, or any transaction which has financial character, we generally account those particular one. We generally account those in term of we generally account those things. We have to record those particular one in a chronological order, right? So like let's say we did purchase worth rupees 5 lakh, we did sales worth rupees 10 lakh, we did suppose that capital contribution 1 crores, machinery purchase let's say 30 lakhs. So for all these you will account in this. While you account, you have to consider those accounts like purchase a 5 lakh. So nominal accounts debit the expenses, credit the loss. Let's say so purchase account debited to cash 5 lakh, sales income. So again aapka you have to follow this one, cash sorry capital or your machinery. By using those golden rules and all, you have to apply them, right? So journal entry, the point was what I want to convey, that is I hope you remember that sequence. The day one itself, first one is, if it comes to account entire accounting cycle, so it start with recording. Recording we generally do in with the help of journal entries. Journal entries are the very first entries, and they are in systematic chronological order, right? So date wise, first we did this, first July, second then 5th July, then your let's say 30th July. So these are the entries during the month of July. Then first is journal entry. Once you're done with the journal entries, then you prepare the ledger. Okay, so from journal, this is called, after journal and after recording, first step is recording. Then what we create summary. Sorry. After journal entry, what we generally do, we generally classify. Okay, we create different classes of accounts, right? So they are generally known as ledger. So we'll have a sales ledger, we'll have let's say purchase ledger, okay, we'll have capital. So any transaction related to sales during that period, they'll reflect in this, their debit and credit balances. Any transaction related to purchase, that will reflect in purchase ledger. Any transaction related to capital, that will reflect in this particular one. After this, after you have done with this one, we come to the summary. So when it comes to summary, so summarization we generally do with the help of trial balance. Okay, summary in the form of trial balance. So trial balance format is something like this. This is your particulars, means the name of the ledger. So when it comes to trial balance, it is a summary of all the ledger account. It is a summary of all the ledger account. So particulars, ledger folio, then we have debit balance, and we have credit balance. So these, the final balance of this, the final balance of this, the final balance of this, and the total of debit should equal to credit, because we are following dual aspect of accountants. If it is not total, you have to create one additional account, that is called suspense account. Okay, that we will discuss in our next topic, right? So suspense account you have to create when we'll come to trial balance next to next. We'll discuss this particular one again. So if it is equal, that means you have achieved the arithmetic accuracy. Then after trial balance, we prepared the reports. When it comes to report for a joint stock company, it include your balance, profit and loss account. For that, you have to create trading accounts. Profit and loss account, with this, we'll get to know about the net profit or losses. Then we have balance sheet statement, balance sheet statement. Then we have cash flow statement, right? So these are the entries. Now, once you're done with this, then we'll go for the interpretation, module C, your ratio analysis and all. So this is the entire journey. So when it comes to the unit 3, which is all about your recording and classifying, right? So recording, because unit 5, your unit 5 will deal with this, unit 5 will deal with this summary. And when it comes to the reporting part, it is part of your module B, unit number 13, 14, company account 1 and 2, unit number 12, balance sheet, unit number 16, cash flow statement. So, right. So this is the entire journey which is beautifully designed in your course curriculum itself. So in this particular session, basically it is about the journal entries. Journal entries, these are basically in chronological in order, and you have to account everything which is which has material effect in your business. You have to record that. That means anything which has financial character, anything which can be measured into money, that will be part of your books. Anything which cannot be measured into money, that won't be part of your book. So once you record, then you have to classify them under the individual accounts. Like all sales related transaction will be in sales ledger, all purchase related transaction will be in purchase ledger, or anything else, right? RAM related transaction will be in RAM ledger, XYZ related transaction will be in XYZ ledger and all, right? So this is the one. So these two which get introduced in this one, things when we move things from journal to your ledger, when we move things from journal to ledger, this is called posting. It is known as posting, right? There is a term used while we move entries from journal to ledger, that is called posting. As simple as that. Simple. Everything is get explained. Now you have to go through the concept part, right? So first thing, please go through this. A journal entry record a business transaction, and the first step of the accounting cycle, because this is the time, this is also known as bookkeeping, where you are recording transactions. Okay? So journal entries should be made for every business transaction which has financial character and are posted to your journal ledger later on. Okay? First, you have to record the journal entries. Journal entries are chronological in order. So properly documented journal entry consists following: correct date. Chronological order means date wise, amount wise, right? So this is the sequence which you have to follow. Like 1st July, 2nd July, 3rd, 4th, 5th, 7th, 30th. You have to record in this particular chronological order, right? So then we prepare ledger. So the other part is ledger. So a ledger is a book or collection of accounts in which account transactions are recorded. Each account has an opening or carry forward balance, would record transaction as either debit or credit in separate column, and the ending or closing balance. So the ledger is a principal book of the journal is primary. This is a principal book of accounts where similar transaction relating to a particular person, property, revenue, income, expenses are recorded. Like means we are going to create individual account for all the different entities. For XYZ different, for Sham different, for ABC Bank different, for capital different, sales different, rent different, your purchase different. This is the one. So if we want to check anytime key what is the relationship with this XYZ vendor, so with the help of ledger only you'll get to know, right? So that is the one. It contain all accounts of business enterprise, whether real, nominal or personal. The main function of ledger is to classify or sort out all its item appearing in the journal or the other subsidiary book under their appropriate account, so that at the end of the accounting period, each account will contain the entire information of all transaction relating to it, and it in a summarized or condensed form, which is your known as trial balance. So this is your ledger account. The journal, the basic entries, while you do those particular entries, you have to follow the golden rules. Then second one is your ledger, which is for each and like in case of journal, we have mixed entries, like all the entries, basically date wise. Like let's say first we did some sale, same day we did purchase, and same day we paid some rent also. Day 2 we did only sale, day 3 we did only purchase. So this is the one. So now when it comes to the ledger, they'll have like for sales we have during that period, let's say we did 1000 number of time sales, all those 1000 entries will be part of your sales ledger. We paid rent 12 time in a year, so that those 12 entries will be part of this one. We did utility expenses 1000 time, all those will be part of that one. We capital contributed by owners, that happened 3 times, so that will be part of that particular ledger. So specific, the company's relation, the company for which you are preparing those books, and their relation with the others, any type of accounts, whether it is real, nominal or personal. So for that sake, you are preparing separate accounts, right? So relationship between journal and ledger. So this was given in your book. So I have picked this particular one also. Again, both journal and ledger are important books under double entry system of bookkeepings. The following are the points of comparison of these two. The transactions are recorded first in journal, then they are posted in ledger. Thus, journal is the first or original entry. Journal is called first and original entry, while ledger is second entry. The journal is a book of chronological record, date wise, amount wise, while the ledger is a book of analytical records where we have a similar type of or a individual accounts. Journal is more reliable as compared to ledger because this is the very first entry. So you will always refer this since the book in which the entry is passed very first, right? The process of recording transaction in term of journalizing, while the process of recording transaction in ledger is posting, right? So journalizing is by following those golden rule of different account, debit and credit. Every debit has a corresponding credit. Like we purchase of machinery worth rupees 10 lakh. So debit machine to cash accounts 10 lakh, 10 lakh. So that is journalizing. When it is comes to posting, what I told you, when we move transaction from journal to ledger, so that movement is generally known as posting. This get asked so many times. Please do remember this one. Okay? So what is the difference between journalizing and posting as well? In term of posting means transfer the debit and credit items from journal to their respective account of ledger. That is called posting. That's why this get asked so many times. It may be noted that the exact name of account used in journal should be carried to ledger. So like separate account, the following rules should be observed while posting transaction in ledger from journal. Separate account should be open in ledger for posting transaction relating to different account recorded in journals. Like for sales, separate, for purchase, separate, for rent, separate, for salary, separate, for electricity, separate. That is the meaning. The concerned amount that has been debited in journal should also be debited in ledger, credited in journal, credited in ledger. Third one is the concerned amount that has been credited in journal should be credited in ledger also. Otherwise, there will be problem. It is customary to use the word to or by while posting in ledger. The word to is used with account shown on a debit side of the ledger, means to account machine to basically machine account debited to your आपका buy cash accounts. That is the one. ठीक है, cash buy is your credit side. So to your debit and buy is your credit side. So in a folio columns, ledger folio that is called, or journal folio, in page number of the journal from where the entry is transferred to ledger account is written. The date of the transaction is written on the date column. I'll show you the format also. Like, let's say this is the case which is given in your book itself. So, purchase goods. This is the very first entry because this is cash in hand. Again, purchase goods from Ashok, sold goods to Madhav, pin to invoice goods, purchase goods, cash sales made, paid Ashoka, and received from Madhav on account. So these are the entries in the month of January. These are the date. 1st January, 6th January, 8, 9, 15, 20th. So while you have recorded these particular one, this is get recorded in your journal accounts. So first your journal entries. So when it comes to the debit side, so debit side we have to Ashok 5,000, Pinto 8,000, cash your 7,000, right? And Madhav accounts. So these are the ledger. So this is something related to this ledger is purchase ledger. So out of these particular one, these were the purchase, right? And one another purchase was there, cash sale made. So we have Ashok, Pinto, and this purchase account. All purchase account related transaction in one ledger, that is called purchase ledger. Madhav related accounts or Madhav related transactions get recorded in this to sale by cash. So debit side, credit side, and this is the entry. So for that means while when we talk about the your journal entries, you have to do these journal entries by following those golden rules or the three different type of accounts. When it comes to ledger, so you have to prepare for each and every single different type of account. So like in case of purchase, different type means in purchase we have done these. We did purchase on 1st January, 8th and 9th January. So all purchase related transaction will be part of your purchase ledger. All sales related transaction will be part of your sales. All Madhav related will be part of Madhav. All any other XYZ related, capital related, so for them will have separate ledger account. So this is the basics of this one, right? Now the final thing from your this particular unit is cash book. So when it comes to cash book, so this is something which is very important because your next topic, which is BRS, which is completely driven by this one, right? So you have to build your basic understanding. So when it comes to cash book, first of all, it is generally known as a mirror image of your passbook, right? A mirror image means opposite, like transaction will be reflect in a opposite direction. Like debit in cash book will reflect credit side in your cash. Debit in passbook will reflect credit side in your cash book. Credit in passbook will reflect debit in debit side of this one. That means you have to be very careful around this rule because this is something which you always miss, right? In my experience in last 7 to 8 years. So when it comes to the cash book, we have like single column, double column, triple column. Cash book is simply, it is all about the cash inflows and outflows of that particular business. So let's say what are the sources from where we are receiving cash and what are the sources where we are applying that particular cash, inflow and outflow. Only and only cash, not even equivalents, right? So like credit sales, credit purchase, they are not part of your cash book. They are part of your day book. It can be purchase day book or purchase sales day book, right? So in case of cash book, basically we have like this is a triple column. We can have three type of passbook. One is where we have only debit and credit side, single column. Double column is along with this debit credit, we have discount column also. Discount allowed and discount received. So these are the two column. In case of triple column cash book, we have debit credit, discount received, discount allowed and received, and we have bank. Third one is bank statement also, the bank balance also, right? So that is called your triple column cash book. This is the format of triple column cash book, right? So in this particular case, guys, the one thing which you have to remember, that thing is like when it comes to the cash book, passbook. When it comes to passbook, how we create our passbook. So passbook is basically, in case of passbook, like the simple rule is credit when money comes in and debit when money goes out. This is the simple rule. Let's say customer deposited 10,000 in their account. So the entry is customer account get credited by 10,000 rupees. That is the simple one, right? But when it comes to the cash book, it is a mirror image of passbook. Here, debit is a favorable balance, right? So that means when company will receive money, you will put that amount at debit side. When company credit is unfavorable balance, negative balance, when money will go out, you will put that balance at credit side. This you have to remember. Believe me, if you remember this, you will be able to solve so many questions. Otherwise, like maximum time, because from our childhood itself or in our daily basis in banking operation, we do these kind of things. But it is a mirror image. Always remember, this is cash book is a mirror image. Mirror means it will reflect opposite side. So credit balance in cash book, it will reflect at debit side of your cash book. Okay, so credit balance in passbook will reflect debit side of your cash book, right? So that means debit is a favorable balance as per cash book and credit is unfavorable balance. That means if a question, like while you solve the BRS question, if it is showing debit balance as on this is this, that means that is a favorable balance. If they are showing credit balance as per cash book is this, that means that is a unfavorable balance. They have already overdraft in their books. So let's discuss this particular one. A cash book is a financial method of recording all incoming and outgoing cash. Cash book are often divided into a section for cash receipt and disbursement and are linked to general ledger. There are three main type of cash book: single column, double column and triple column. We'll come to this one. Each type of cash book serve different purpose and provide varying level of details. Single column only debit credit, double column discount column, triple column is bank balance. Maintaining cash book offer benefit like attaining more efficient cash management and easier access to cash situations of the business also, right? Single column cash book, a single column cash book is simplest form, recording only cash transactions. Small businesses in sole proprietorship may prefer this particular format because of the straightforward nature. It maintains a running cash balance on hand and can be updated in real time or reconcile at the each day. Single column. Double column, we have discount allowed and discount receive also, right? So this is more sophisticated version, incorporate cash and columns, allowing business to track physical cash and bank accounts simultaneously. So cash and banks. Then third one is discount, cash bank along with the discount column. So we have discount also, take a column for discount, discount received and discount paid by the businesses. So this was the format, right? So you can see here. So first, debit side, we have receipt. See, debit side, they have mentioned receipt. Debit is favorable balance. You have to remember this. So if your business is going to receive money as an accountant, you have to add that particular one at debit side because it is a mirror image of your passbook. So in mirror, it will reflect opposite side. Your credit balance in passbook will you have to make entries in debit side balance, debit side of your cash book, right? So date, particular name of the transaction, then we have ledger folio and numbers, discount allowed, cash, rupees, bank, cash, bank. So these are the, if it is only debit, if single column is date, particulars, ledger folio and your balance. Okay, debit or credit balance, debit balance, their side credit balance, single column. Double column is date, particulars, LF, then your BAS, then after discount, then it is double column. Then if we have all these three, then it is triple column. Usually we go for the triple column. So there is no differences, just a small or minor difference which you have to remember. And whenever they'll ask question, they'll ask fundamentally what is the three different type of cash book and all. And the cash book rule is part of the BRS itself, right? So when it comes to BRS, bank reconciliation statement, so reconcile means basically we are doing some sort of inquiry in our cash book. We are checking or matching our cash book with our passbook, right? So like the major agendas is basically our cash book should reflect the right balances. If there is some sort of malpractices or if we missed out some entries and all, to reconcile those particular one, that is the primary agenda of this particular one, right? So recording transaction in cash book, this we have discussed yesterday also, that debit and credit rule. Transaction contained in the passbook and bank statements. Then we have passbook is a mirror image of cash book. Why this is? Causes of passbook and cash book differences. This is the very major important point basically from this one. Understanding reconciliations, preparing reconciliation statement, need for this and adjusting entries, advantages and all, right? So first we will be discussing the overall concept part of this particular unit, then we will be practicing or with the help of questions we'll try to make our understanding for this particular one, right? So when it comes to the reconciliation or when it comes to BRS statement, right? So it is all about with the help of BRS. Basically, what we generally trying to do, we generally trying to match the entries which is in your cash book with the passbook, right? So passbook, when it comes to the preparation, so it is prepared by bank. Passbook is prepared by bank, and when it comes to cash book, it is prepared by the firm. Okay, so basically to check their cash book, which include all the cash transactions, inflow and outflow of cash, that is really part of this particular. Now few things which you have to remember. The first and the very important one, that is rules. So when it comes to cash book and passbook rule, when it is about the passbook, so credit balance is a favorable balance and debit balance is unfavorable. So as it is mentioned here, the cash book is a mirror image of passbook. So when it comes to cash book, your debit is a favorable balance and credit is unfavorable balance. You have to remember this one because most of the time you'll see question around this particular rule only, and this is something which is confusing also, right? So it is a mirror image, so that's why things reflect in a wrong direction or opposite direction, not wrong direction, right? So that means when money comes in, and let's say if you are maintaining the cash book of your business, so you will make entries at debit side. When money goes out from your business, let's say you made some payments or you paid some rent or salaries, that will come to the credit side. In case of your cash book, where like in case of passbook, your basically credit are basically your positive transactions or credit transaction, and here we have a, so they have inverse relation because this is the mirror image of this one, right? Now apart from this, so like when there is a differences, now there are so many reasons for the differences can be due to, like let's say we have some sort of like let's say there is a check issued by a business, right? So on the date of issuance, let's say we issued a check on first, how these differences comes, like first, let's say first July 2025, this XYZ business, they generally started they issued a check to vendor A. Let's say they issue a check to Mr. A, which is a vendor of this particular company, right? So now in cash book, you will record that particular transaction on the date of issuance. That means you will make a entry, you will make a credit entry because it is a negative balance, money is going out. So let's say the check worth rupees the check is worth rupees 1 lakh. So you will keep this 1 lakh rupees at your debit side. Now the date on this particular check is suppose that let's say the date mentioned on that particular check is 15th July, right? This check is like A can encash that particular check on 15th July, or suppose that it is 1st July, any date you can take, right? Now this vendor X, if he did not let's suppose he did not deposit it or send that particular check for collection at the bank. So when while we are doing the reconciliation on 30th July, let's assume we are doing this, we are preparing the BRS statements on 30th July. So in your cash book, there will be lower balance because we have already adjusted this 1 lakh rupees check. But in your passbook, it will show higher balance because A did not presented that particular check in the bank for the clearance. So these kind of situations. So once we'll see this particular transaction, while we reconcile, there will be a mismatch. While we go through the transactions, so while you do the BRS things, you have to prefer the balances of passbook because you can edit this one, you cannot edit this one because this is maintained by the bank itself. And once you'll do the reconciliation, you'll match the entries of passbook with cash book. You'll find this particular entry because this check is in transit, right? Sometime what happened? Let's say there is a customer who directly deposited money in your account itself. Okay? There is a customer who deposited, let's say 50,000 in your accounts as a business in this XYZ's account. Okay, this information, let's assume that this information is not available with the XYZ limited accountant who is preparing the cash book. So in that scenario, the balance of passbook will higher and the balance of cash will be lower. So while you reconcile things, you will adjust that particular entry by adding 50,000 debit side of your cash book, right? So few things you have to remember. First is the debit credit rule. This is so confusing, so important, right? Because it is a mirror image. You have to remember this one. Okay. Another one is when there is a difference between cash book and passbook, you will prefer passbook first. Reason being, you cannot edit this particular one. This is maintained by bank and you can edit this particular one, right? So there are so many things which due to these small transactions, there is some sort, like sometimes let's say there is an error in books while we are preparing the cash book, we did some accountant, he did some errors, or apart from that there can be some like check in transit or some let's say annual maintenance charges are auto deducted by the bank. That will make a difference. Or let's say there are some standing instruction issued by the company to the bank regarding the insurance premium or any other thing also, so that can also make some sort of differences, right? So this is the chart which will help you to understand which you have to add, which you have to subtract. This is something which is very important, right? So let's say BRS as on 31st March 2025. Debit balance, which is also known as favorable balance as per cash book, and credit balance, which is your negative balance as per the it is negative balance as per cash book. Now, one another thing, if your question will start with debit balance or credit balance, or simply saying balance as on 31st March 25 in cash book. So if your question start with cash book, it will end with the passbook. One another rule which you have to remember, so as you can see, so credit balance as per this one. Okay? So this is the one. Debit balance as per cash book is favorable. Credit balance is unfavorable. Credit balance as per passbook is favorable. Debit balance is unfavorable, right? So what you have to add, these are the transactions which generally make differences between your cash book and passbook. Like check issued or drawn but not yet presented for payments, as I gave you. So that means, so you have to add this particular one. Why you are adding this particular one? Let's say your company, as I gave you an example now. So that company XYZ Limited, you are preparing book for XYZ. They issued 1 lakh rupees check to A, but this check is not presented for payment. So in your passbook, it will show the previous balance. In your cash book, there will be a credit balance of 1 lakh rupees. So while you reconcile that particular one, you can show check in transit and you can add that 1 lakh rupees. Another one is, second one is, same opposite side, you will also see check paid into bank for collection but not yet credited by the bank. If this is the case, let's say you receive a check but it is not credited in your account, so you have to minus that particular. This is just reverse entry of this. Interest allowed by bank not recorded in cash book. Let's say on your account you got some interest and that is auto credited by the bank, but the information is not passed on to the cashier, so he will not record. So later on, while you reconcile things, you have to add that particular one. I'll give you one another case so you can make your understanding very well, right? Let's say let's say this XYZ company bank, they have a bank account with SBI, and during that particular period SBI credited 10,000 rupees in the form of interest. So they have credited 10,000 rupees interest auto credited to the bank account, and this information is not available to the cash book handler, right? So while you reconcile things, what you have to do, you have to, in your cash book, you have to do one debit entry with 10,000. Why debit entry? Because when money comes in, we debit the accounts, right? So this is the one, right? So this is the one. Now check, there is some opposite transaction also. Bank charges and commission charges by the bank. So bank deducted bank charges, AMC, let's say 1,000 rupees during that particular period. So that information, while you reconcile, you'll get to know about this one. So you have to minus that particular. You have to do credit entry in your cash book itself. Hope you're getting these particular things. Apart from that, amount directly deposited by customer in our bank accounts, interest and dividend collected by bank on investments, check paid into bank but omitted to be entered in cash book, right? So there is an error or error of omission. Any wrong credit given by bank in passbook. Less what you have to deduct, check paid into bank for collection but dishonored by the bank. Let's say you receive a check worth rupees 1 lakh from vendor A, you received that particular check. So the date you received, you accounted that particular one debit side of your cash book. While that check went for the clearance, it got disowned. So if it is disowned, so you have to minus that amount of 1 lakh rupees along with the non-sufficient fund charges, NFS charges, right? So that way you have to make a negative entry, right? Direct payment made by bank according to prior instructions, that is standing instruction like premium or any club charges or any other charges. Okay? Check issued but omitted to be recorded in cash book. Any wrong debit given by the bank passbook itself. So this is something which is all about your BRS. So it is all about where basically what we are doing. We are doing some sort of like we are matching our cash book with the passbook, and that matching process is generally known as BRS. And like if we have some sort of surplus or deficit balances, we are trying to find out those reason, and the reason can be around these particular one, correct? Sure. So bank reconciliation statement is a report or statement prepared by businesses. BRS is prepared by businesses to match bank transactions recorded in books, means your passbook account with the with your cash book with your passbook, right? So that is the one. The bank reconciliation statement help to check the correctness of entries recorded in the book of accounts, thereby ensure accuracy of the bank balance. So you'll get to know the exact amount, how much money you have. So there are few things which you have to remember. I have stated and mentioned here also, so you do not miss these one. First, favorable balance in cash book means positive balance, and such balances is represented through the debit balance. In previous session also we talk around this particular one. First thing, a credit balance is in cash book shows reduction in cash balances to extend that the final cash balance is negative. If your question is starting with credit balance as per cash book is 50,000, that means they already have overdraft of 50,000. You have to remember these kind of things, right? So that means it is a negative balance. So negative balance, they are starting their entry with negative balance. Now, how these transaction will help, I'll give you an example. Let's say there is a question, credit balance as per cash book is 50,000. So this is the opening entry, suppose that. Now the organization, let's say that same organization XYZ Limited, XYZ issued a check, they issue a check, worth rupees 1 lakh to vendor A. Now you already have negative balance in your book, in your cash book, credit balance 50,000. Now you have done one another entry which is 50,000. So if they ask you what will be the balance as per the cash book, then they'll give you option. आपका credit मतलब like they'll give you option like favorable balance 50,000, unfavorable balance 50,000, favorable balance 1,50,000, unfavorable 1,50,000. So what will be your correct answer? Your answer will be unfavorable balance 1,50,000 will be the right answer for that particular one. Why this? Because you have already a negative balance of 50,000 because it is mentioned credit. You have issued one check, again one credit balance, your money is going out, credit transaction. So your final balance as on will be 1,50,000. So this is the one. The cash book is debited when cash comes in and credited when cash goes out. Simply saying the overall meaning of this one, right? Apart from this, when any transaction related to bank happen, say cash is deposited in bank, So cash and deposited in bank. So in case of passbook, you will credit. In case of cash book, you will debit that one. Okay, so money is coming in. So in passbook, it will credit it. In cash book, it will debit it. Okay? So the businessman record this transaction in the bank column debit side of the cash book, and passbook or bank will record credit side of the passbook itself. Similarly, when cash withdrawn from the bank, so for a bank, it will be debit balance. In your cash book, it will be credit balance. So this is the rule which confuse people, because from our childhood or in our daily working, we always follow debit and credit rules, and credit when money comes in, debit what money goes out. But this is happening due to the mirror image of the, because the cash book is the mirror image of your passbook. Please do remember this. If there is differences, you have to prefer passbook first, because you cannot edit passbook as a businessman, right? This is done by the bank. So you have to, like, let's say one side your passbook entries, so you will prefer these particular one, right, as a right, then accordingly you will check these particular one with your cash book. Okay? So you have to prefer passbook first, right? So if questions start with balances as per cash book, so then you will the question will end with balances as per passbook. So if question start with cash book, your usually you will not get that lengthy question in all thing. But in general also, while we prepare the BRS, long BRS. So if questions start with cash book, it will end with passbook, or if it start with passbook, it will end with cash book itself, right? So this is the whole. Now, causes of passbook and cash book differences. This we have discussed earlier also. So what are the reason which make differences between the balances of cash book and passbook? First, bank issued check but not yet deposited for payments. Bank made direct debit from the customer side. Check amount deposited directly to the bank accounts. Dividend interest collected by bank. Bank made direct payment for customer side. Check deposited or bill discounted or dishonored, or that list which I have shown you, right? So these are the, basically you have to refer this particular list. That list is here also. Okay? So this list will help you to find out the entries. But in your book also, they have explained these particular thing in detail. So let's have a quick look around these particular one, right? So causes for passbook and cash book differences. One can be error. There can be error in both the passbook and the cash book. While recording the entries, our bankers or accountant might make some errors under casting. Overcasting means, let's say the balance was 10,000 and they added one additional zero. So that become 1 lakh. So these kind of errors, right? Or they omitted, or the cashier or the accountant who omitted one entry itself, right? So let's say they receive a check worth rupees 10,000. He forgot to account that particular one. So omission. So these kind of errors. So you have to adjust those one. First, entries which do not require to change in passbook. So basically you have to mention, like as I gave you an example of check. So we issued one check to vendor A that is in transit. So you do not have to make any separate entry for that particular one, because not today, but tomorrow or day after tomorrow or in the future or within 90 days, that vendor A is going to deposit that particular check, right? But you have to, like that, you have to know the differences. What is the difference? What is the causes behind that particular differences? Like check issued but not yet presented for payment, as I gave you in case of A. So XYZ issued check worth rupees 1 lakh to A. The date was mentioned 15 July. We are preparing BRS on 30th July. But there was a difference. When we reconciled the difference, we found that A did not presented that particular check for the clearance. So obviously he is going to present that particular one in future any date within that validity period of 90 days, right? So a trader immediately record the payment made by a check to creditors for any expense on the cash book credit side. The debit for the same, however, will appear in the passbook only when the payee present the check for payment to the bank. There is usually a time lag between the date of issuance or date of presentation. So you do not have to mention about, or do not have to correct those particular one in case of like when we have this kind of scenario. Check deposited into bank but not yet collected. This is a reverse entry of this particular one. Correct it. Apart from this, entries which required changes in passbook, like bank charges. Bank deducted 1000 rupees from XYZ Limited as a annual maintenance charges, right? So that you have to record. Or interest on saving accounts. So this you have to add a minus in your, so you'll make credit entry in your cash book, you'll make debit entry in your cash book. Interest on saving bank accounts. Let's say we bank paid 10,000 rupees interest for that particular during period. Okay. So you have to add that particular. Add means you have to add debit side of that particular one, right? Interest on overdraft you have to minus. Amount the credit side in your cash book. Amount collected by bank on standing instruction, that in insurance premium paid by bank on behalf of XYZ Limited, you have to subtract that particular one or make a credit entry in your cash book. Amount paid by bank on standing instructions, same. Direct payment into bank made by traders customer, so you have to add that particular one your debit side. So these are the similar entries, nothing new. Whatever I have explained you with that particular chart, if you understood that particular well, you are good to go, right? So understanding reconciliation, the importance in others. So the bank statement is received periodically, usually on monthly basis. We generally deliver their, these are the auto-generated basically. Okay, so every bank, they generally deliver their statement to their customers or account holders, right? So we check if it for clerical errors, and if any error are found, we obtain revised statements containing no errors. The balance in statement give us a form of starting points to proceed for. Finding out entries which do not require a change in cash book, like that check cases. Finding out clerical mistake, and finding out entries which require changes in our cash book, as we discussed earlier also. So these are the three stages to prepare your cash book. Very simple, very simple. You do not have to worry around this. There is no rocket science. You just have to remember the debit and credit things and all, and how it is used in businesses, right? So closing balance in bank statement. Okay. So preparing this is the format. Okay. So add check deposited but not yet credited. Subtract check issued but not presented to the bank for payment. Adjustment balances as per the cash book. So adjustment made in cash book. Add or subtract clerical errors. Add credit entry shown in bank balance, means customer paid direct payment to the bank or interest credited by banks. Subtract debit entry shown in bank balance, like the standing instructions or the AMC charges and others, and you have to make the adjusted one, right? So this is all about your cash book, or this is all about your BRS things, right? I hope this is clear to everyone. So this is something, while you like how you have to practice this, just go through these particular entry, why we are adding these one, why we are subtracting these one. So do some sort of murmuring. If you are clear with each and every entry, then you are good to go. In this particular session, we are going to discuss all these particular subtopics, and we will have our very first set of practice also with the help of PYQs and expected question, right? So guys, when it comes to the trial balance is all about, it is basically summary of all the ledger account. I already told you the entire journey of the overall things like accounting. So when it comes to accounting, it start with the recording things. So recording we generally do with the help of journal entry. Journal entries are basically chronological in order. So it is called journalizing. We have to follow the golden rules for the different type of accounts and all. So this generally comes under this particular one, date-wise, amount-wise recording. Then we have your classifying. Yes, the second stage is classifying, where we generally do we generally prepare separate accounts or ledger for each and individual separate accounts. All right. So like for sales ledger, for purchase ledger, for cash ledger for capital, Ram, Shyam, XYZ, ABC, everyone that generally comes under this. Then after this, we generally summarize. Okay, when it comes to summary of all the ledger accounts, that is generally known as trial balance. So trial balance is generally called summary of all the ledger account, right? So what is the format? So you'll see something like this: particular, the name of the ledger basically. Then we have ledger folio. Then we have debit side, and then we have credit side. And at the end, the total of debit should equal to credit, right? So there should be equal amounts at debit side as well as credit side, because we are following dual aspect of accountancy. That means every debit has a corresponding credit. That means they should be equal, right? So if these are equal, that means you have achieved the arithmetical accuracy. So this is something which is trial balance. Trial balance help us to prepare our final reports, like to prepare in case of a joint stock company, to prepare trading accounts or profit and loss account, then balance sheet and cash flow statement. So very important documents. And basically definition wise, if you go for the trial balance, it is simply like it is a summary of all the ledger accounts, like the final balances of these ledger, which we generally transfer from here to here, right? So for different one, debit balances will come debit side, credit will come credit side, right? So this is the journey which is called posting, moving your journal entries to ledger called posting. And a trial balance is all about the summary of your basically all the ledger accounts. So at a time, the picture of business, the overall debit and credits which is happening in that particular business. So a trial balance is a report that lists all balances of journal ledger accounts of a company at the end of certain point of time. It can be monthly, it can be prepared monthly or quarterly or yearly, right? So summary of all the ledger accounts can be called as trial balance. So multiple entries in various account will create a ledger account, like as I gave you an example. So first we generalize things, journal entry, then we post in different ledger. So let's say in sales ledger we have 50 entries, like debit and credit. So eventually the final balance of that particular ledger, that you have to move to the trial balance, either debit side or credit side. So taking all ledger balances and presenting them in a single worksheet as on a particular date is generally known as trial balance. So this is something which is a format of your trial balance. Like let's say for petty cash, the debit balance or the credit balance, right? So let's say for bad debt reserve, debit or credit balance, or let's say for insurance or sales or capital or the other different type of accounts which are generally part of that particular business. So there is one format also I found on internet. So Jyoti Enterprise Limited, as on 31st March. So their owners capital trial balance is 5 lakh, machinery is 2 lakh, cash in hands debit side 10,000, bills receivable 70,000. So this is the one. Total we have 9 lakh 87,000 debit balance and 9 lakh 87,000 we have credit balance. So sometime if there is a difference, now there should be one question around this. Ki if let's say this is our trial balance, we are preparing this trial balance. Okay. So particulars, then you have laser folio, and you have debit balance, and you have credit balance. Let's say the total of this particular one is coming to, like let's say the total is the total of these two is, let's say this is coming, debit side is your 5 lakh and credit side is 7 lakh. So that means there is some errors in our book. So when you found this kind of situation, so you have to take help of one another account. That account is generally known as suspense account. Suspense account means it's a temporary account, right? And you have to basically add a entry, like let's say in this case you have to, now you have to add one another account which is suspense account debit side, because the balance of debit side is lower. So for a time being, you'll create one suspense account at the lower side. So we can have similar balances 7 lakh, 7 lakh. Then we will check the root cause, what is the reason for this differences, and we will find out the errors. And after that, after the correction of those particular errors or adjustment of those particular entries, we will remove this particular one. So this is from here, the next topic will start, that is called your errors. But before that, we will be discussing around the types of accounts, right? So suspense account, after preparation of trial balance, if there is a difference, may be temporarily transferred to a new account which is called suspense account. As I gave you an example, so there is a difference. So we created a temporary account, suspense account, at the lower side. You have to remember this because this get asked so many times. So a company can use suspense account to record ambiguous entries on books that require clarification before they can assign to their proper account. So this is the one, right? So methods of trial balance. Now we have three methods, very simple one, right? So first one is gross trial balance, another one is net trial balance, and third one is compound. So this is very, very simple, right? When it comes to gross trial balance, let's say these are your ledger. So ledger one, which contain debit balance of 5 lakh and credit balance of let's say 2 lakh. In case of ledger 2, let's say ledger 2, which contain debit balance of 10 lakh and credit balance of suppose that 12 lakhs, right? So while you prepare your trial balance by using total method, so how it will sound or how it will look. So particulars, ledger 1, ledger 2, and this is your total, right? So this is your total. So we have ledger folio, we have debit balance, and we have credit balance. So debit, while you are preparing your trial balance by using total method or gross method, you'll keep balances as it is, right? Debit side 5 lakh and credit side 2 lakh. And ledger 2, which is debit side 10 lakh, credit side 12 lakhs. So the total is 15 lakhs and total is 15 lakhs. This is the methods how you prepare your trial balance by using gross method. The next one is net method. While you prepare same trial balance by using net method, so you'll do some sort of adjustment, right? So let's say particulars, debit, credit, right? So ledger 1 and ledger 2. So what will be your entry? How you'll keep these particular entries after adjustment of income with expenses? So for this one, your debit balance will remain 3 lakh and this will become 0. In case of ledger 2, your credit balance will become 2 lakhs. So this is the entry for this particular one. Again, then you have to add all the ledgers and all. In case of compound method, it is a joint method. First, you represent things like this, then you show the final or adjustment. Like if I'll pick this one and if I'll post here, so that is your compound, which is a combination of both. So initially things are represented as gross, then your net method. So this is something which is your trial balance method. So you do not have to deep dive these particular one. You do not have to practice question and all. Whenever they ask question, they'll just ask half marks or 1 marks question about the types of trial balance or the statement true about the type of trial balance. I'll will practice also. So gross trial balance, each ledger account debit and credit columns are recorded using total method to trial balance. Every debit is entered on the trial balance debit side and every credit entered into the trial balance credit side, as we did here also. So every credit, we posted a debit here, debit side, credit side, a debit side, credit side. So this was the your gross trial balance, right? So given that this method is double entry bookkeeping, the column should be equal in this particular case. That's why your total will be आपका or the column should be at equal side, right? Now next one आपका gross trial balance. Like basically it is following your dual aspect of accountancy. Like if we have debit balance of 5 lakhs, so there should be a corresponding credit balance of 5 lakhs because every transaction you are recording with two aspect debit corresponding equal credit, right? Next one, net trial balance. So approach make it of the final debit or credit balances for each ledger accounts in the trial balance. So net means after adjustment, right? So adjustment between debit and credit. So whatever it is outstanding, that outstanding will reflect in your trial balance. So trial balance both on debit and credit side assist in verifying the accuracy of all transaction after all account balance figure have been published in this one. Composite is or compound, the total of for both side of the account are listed in distinct columns, then gross and net आपका ठीक है. So which is a combination of balance and total, means your net and gross method. The balances are also listed beside this in their independent column. In trial balance, credit balances are written in the credit column and debit are put in the debit column side. So this is the one. So very simple one, and keep them simple only, right? Do not involve or do not enter in the detailed things, the format and others. That is not required for this examination. So you have to stick whatever it is required, right? Now the most important part of this particular unit, that is errors. So when it comes to errors, for sure you guys are going to face 2 marks question. The question type will be in my shift it was something like this. So one side there was 4 errors name was given, like principal error, clerical errors, sorry, your compensating errors. Then we have omission error and compensating errors. Okay. This side there was entries and they ask us to match these particular one, and you have to find out the correct match, and with that correct match you got 2 marks for this one. First type of question. Another type is it can be based on statement ki there is definition given of all the 4 type of errors. You have to find out which is correct or incorrect. Or there can be half marker question also. They can give you like let's say there are multiple statements. Then they can ask you which of the following is error related to your compensating errors or principal errors and all. Okay, so this you first you have to build the concepts around all these particular one. Then if you'll practice as much as you'll practice, you'll get a confidence around your concept things. So when it comes to errors in accountancy, we have 2 type of errors. One is error of principle. When it comes to error of principle, that means the accountant is neglecting the golden principles of accountancy. Like let's say golden principle like dual aspect of accountancy. You are recording a transaction only one side. You are missing that dual aspect of accountancy. When a revenue income is recognized as revenue, sorry, capital income, or revenue expenditure is recognized as capital expenditure, or while personal expense is treated as organizational expense, you are ignoring the business entity concept. So these kind of errors which are generally comes under error of principle. In general, in daily business or real world, we hardly face these type of errors. Major errors which we generally face, these are clerical errors, right? Human errors. So first one is error of omission. When you miss any transaction, you omit the entire entry or a partial entry, right? So that is your error of omission. So omit kar jana, that is the point, right? So let's say there is a sale happened for worth rupees 10,000. Your accountant missed that entire entry. That is error of omission. We did some expenses, but uh, we did not record that particular one in our journal or the first or the primary book of accounting. We forgot to record that particular one, omission. The another one is commission. So commission is something, these are the errors due to negligence of accountant. They did some sort of wrong totalings, right? So let's say while we were adding those ledger accounts total, the balance was 5 lakh, but we added one additional zero, it become 50 lakhs. These kind of errors, right? So that is, or while we are moving things from ledger to trial balance, we only like what we generally did as an accountant, the balance was credit, we put it at debit side. So that is something which generally comes under error of commission. The third one is compensating errors, where two errors happening, and the another error, the second error, which is nullifying the impact of first one, right? So let's say this is your sales ledger. So we did sales to A worth rupees, suppose that 1 lakh, this is the actual figure, but at the time of posting we posted it as 10 lakh. We put one additional zero, so this is your wrong entry, this is your right entry. Okay, this is your wrong entry. We did sale to B. The actual number was 10 lakh, but it get posted as 1 lakh. We omit 10 from that particular numbers. So your overall sales, if you'll ask me what was the overall sales of the business, it is 11 lakh, which is showing true, which is correct, right? There is no problem with this particular one. This business had done 11 lakh sales, but this, while you come to the individual ledgers accounts, there is errors. Take like the receivables from A, it was actually 1 lakh, but we are asking for 10 lakh. For receivable from the B was 10 lakh, but we are asking for only 1 lakh. So when two errors happen and the second error or the another error, which generally nullifies the impact of the first one, that is called your error of compensate or compensating errors. That's it. Okay, that's a very simple one. Take it, keep things very simple. If you'll try to make them complex in your mind, so they'll become complex. Just build the basic understanding that is required for this one. So we have two type of errors: error of principle or clerical error. Clerical errors, we have error of omission, commission, and compensating. So error of principle is said to occur when the accountant record a transaction that does not comply with the rule of accounting. That means the fundamental concept, conventions, or the other things. Take a debit credit rules. So as per the accounting rule, every debit there should be a corresponding equal credit. When a transaction violates this particular rule and error result from it, that is error is generally known as error of principle. Okay? Or else the other one, the concept, the money measurement concept, the cost concept, and others. If you are recognizing revenue expenditure as capital, that is personal expense as business expense, that is also an error. The another one is clerical errors. Clerical errors are those errors that are generated from the improper recording of transactions. Clerical errors, we have error of omission, error of commission, and compensating errors, right? So error of omission first. Error of omission are those type of errors that are generated when accountant forget to record any entry. So it can be complete omission, it can be partial. So basically one is complete omission of the transaction in which transaction is not recorded in book of accounts. The another one is partial omission in which the accountant record the transaction in either debit side or credit side and forget to record another side. So that is something error of omission. Omit kar jana. The next one is commission. So these type of error result due to the negligence of the person who is in charge recording the transaction. As I told you, like while he was adding the ledger accounts, they did some mistakes in calculations while they are moving posting things from journal to ledger. They did some mistake, or journal to trial balance, they kept things at debit, things at credit side. These kind of errors are basically error of commission. So these type of errors have an impact on the trial balance, and the example of such errors can be the recording of incorrect amount and incorrect totaling in the ledger or subsidiary book, or posting at wrong side of the ledger accounts, right? The debit balance kept at credit side. These kind of errors, they are generally called error of commission. The next one or the final one is compensating errors. Compensating errors occur when one wrong entry neutralizes the impact of another wrong entry or incorrect. These entries cancel the other errors that is recorded. As I gave you an example of sales account or sales ledger itself, right? So this is all about your trial balance, types, and the errors and all, right? When it comes to the course content, it include the basic introduction of depreciation, causes, need, factors, accounting entries, method of depreciation, the most important part. So which includes straight line method, diminishing balance or written down value methods, and unit of production method. And the final one is sum of year digit. So these are the four methods which are generally part of your curriculum itself, right? So exam wise, this topic is very important. So we'll be exploring each and every subtopic of this particular unit. So let's start the discussion with your very first. I hope everybody know what is depreciation. So when it comes to the depreciation, it is basically decrease in the monetary value of an asset, right? So depreciation is as simple as that. Let's say we purchase an asset. Let's say we are running a tour and travel company. We purchase a car worth rupees 15 lakhs. Okay? After some time, or let's say after 1 year itself, after 1 year, the value of this car become suppose that 12 lakhs. So this decline in value, this reduction in value is generally known as depreciation. So we have to account this particular one. Basically, depreciation get adjusted with your it is treated as operating income, and we have to adjust this particular one in our profit and loss account, right? So now the meaning wise, this is reduction in the value of an asset, or decline in the monetary value of an asset, that is called depreciation. So you have to account this particular one. Like let's say the reduction in value is 3 lakh. So you have to change the book value of that particular asset like from 15 lakhs to 12 lakhs. That means like if you want to check the fair value of your assets, or if you want to know about the exact profit, let's say during this particular period you accounted a profit of 1 crore rupees. So 1 crore minus if it is depreciation adjusted, that means this is your pure income or pure profit. If it is not, that means your assets whose value is declined, so you have to adjust that particular one, then only you'll get to know the depreciation, the exact profit. Apart from that also, like let's say we also create provision for the depreciation. Let's say the useful life of this particular asset or the economic life of this particular asset is 10 years. That means after 10 years, you have to replace that particular asset with a new asset. So for that one, you will be requiring funds. So what we usually do, let's say the depreciation amount is 3 lakh rupees. So we create a provision of 3 lakh rupees. So we can have sufficient fund at the end of the useful life of that particular asset. So it is a very important aspect in our books also for any company, because majorly it is accounted on property, plants, equipments. Okay. So PP, accounting standard 10, and Indian accounting standard 116. So they have defined like why depreciation is important and which methods are important. Now most of the time you guys will face question based on your straight line methods, or a written down value method, or unit of production method. Why they generally ask question around these particular one? Because these are the permissible methods as per the Indian accounting standards. So companies, they have to account their depreciation by using these particular methods, right? And out of these like three methods, most of the time you'll see question around written down value methods, because most of the companies, they generally use a written down value method or diminishing balance, which generally says assets in the beginning of their useful life, they produce more, so the depreciation amount should be at higher rate compared to the later years. So this get used so many times, that's why it is part of your exam curriculum also, right? So a very interesting one. We will be discussing the depreciation factors and others. I hope you got an idea about this particular one. Then, like once we'll come to the areas of the methods, all the four methods which are given in your book. Apart from these three, we have sum of year digit method also. That is again very simple one, right? So let's start the discussion with the basic summary portion. So when it comes to depreciation, is charged on profit and loss account for the fall in value of an asset during each years. This is the kind of a summary whatever I told you so far. So depreciation is part of operating cost or operating expense. It is a reduction in value of asset, that 15 lakh to 13 lakhs. The decrease in value of an asset is due to uses of that car or that asset, or it can be caused by any wear and tear causes, or by other reason like time effects, or that is also known as efflux effect or obsolescence. Like let's say we purchase a laptop for our business purpose. We did not use that particular, even we did not open the seal of that particular laptop. We purchased it for 50,000. After 1 year, the value of this particular laptop become 40,000, even you did not use that particular one. This is called your efflux effect or time effect, right? Because, or it can be obsolescence, that technology become out of you like kind of less popular compared to the previous 1 year and all, right? So this is something, the decrease in value of an asset is gradual and continuous. So now every year you have to adjust the depreciation amounts. Like every year there will be a reduction in the value of an asset, right? So depreciable assets apart from land, others, all are others basically depreciable assets, right? So depreciation is simply saying it is a reduction in the monetary value or economic value of an asset, which is continuous or gradual till the useful life of that particular asset. Now, while you calculate the depreciation, so you will be requiring these three factors. Like let's say we purchase a machinery worth rupees 10 lakh. The useful life of this particular machine is supposed at 4 years, and the salvage value, which is also known as scrap value, so that is supposed at 2 years, 2 lakhs. Okay? So scrap value is something ki at the end of the useful life, when we sell that particular asset, so how much value you will get. So you will get 2 lakh in this particular case. So like let's say if you account depreciation by using straight line method, one of the simplest methods. So how we calculate depreciation? Depreciation is equal to your cost minus salvage value divided by useful life. So this is the formula. If you'll calculate depreciation by using, this is your straight line method. When you'll use a written down value method, so for this one, depreciation is equal to the book value or the book value of the year at the rate of a fixed depreciation rate. When you'll calculate depreciation by using unit of production, it is actual uses divided by estimated uses of that particular asset, uses in term of units or hours, into cost minus salvage value. So these are the three different methods which Indian companies they generally use while they account the depreciation. We will be discussing all these particular one, but whenever you will calculate depreciation, you will be requiring the cost of the asset. So when it comes to the cost, you have to apply accounting standard 10 or Indian accounting standard 116, property, plants, equipments, which says cost is equal to purchase cost plus installation cost, again installation cost plus any test run or any freight or any warehousing plus any non-refundable taxes. Again, any non-refundable taxes. So this get included in the capital cost itself. So that is the one. So this is your cost. The estimated residual or scrap value at the end of the life. So after uses or after the useful life, when you'll sell that waste, so how much money you are going to get. So that is like in our case it is 2 lakh. That means actually you are paying 8 lakh for this particular one, correct? So the estimated number of years of its useful life, for how many years that asset will be part of your balance sheet in asset side. So that is the one, right? So these are the requirements. Before coming to the types of depreciation, let's discuss about the Indian Accounting Standard 16 or Accounting Standards 10, which generally deal with property, plants, equipments, right? So how companies will account depreciation on these property, plants, equipments, that is generally defined under this particular one. So deal with the accounting of property, plants, equipments, covering the asset recognition, valuation, and depreciation. So depreciable amount will be your cost minus residual value. Okay. So cost minus scrap value. Depreciation is a systematic allocation of depreciable amount over the asset useful life. Let's say if you are using straight line method, if the first year depreciation, the useful life is supposed at 4 years in our case. So first year depreciation was 2 lakh, second year it is again 2 lakh, third year again 2 lakhs, and fourth year again 2 lakhs. So this is the one 8 lakhs, and 2 lakh was salvage value. So it become 10 lakhs. So that is the logic behind this particular one, right? So useful life means time period of the asset, which for how long you are going to use that particular asset, and number, or it can be in some cases number of unit expected to be produced, like where we use unit of production. Let's say we purchase a printer or we purchase a machine which can give an output of 1 crore units. So which can give us an outcome of 1 crore units. So 1 crore unit is the like now how you are going to consume them in a year or 2 years or 3 years and 4 years. Once you'll consume 1 crore units, that asset will become aapka scrap, right? So that is the logic behind this particular one. Next one, property, plants, equipments, tangible assets, items used across accounting periods, held for the production or rental or administrative, not used for sale. Okay, let's say that car is not for sale, that laptop is not for sale. We are going to use that particular equipments as an asset in our business, so it can generate some revenue for the business itself, right? So depreciation rule, when it comes to the, so each significant part of item must be depreciated separately. Charges are recognized in profit and loss accounts and treated as operating expense. Depreciation must be systematic over the useful life. The method should reflect how economic benefit are expected to be consumed in each and every single years, right? So this is something which is given in your book itself. So let's have a look. So depreciation, each part of the item PPE with cost of the significant relation to be a total cost of the item should be depreciated separately. The depreciation amount allocated systematic basis. Depreciation charge for each period should be recognized in the statement of profit and loss account. Residual value or useful life to be reviewed at each balance date. Any changes in account accounted for the change in the accounting estimate as per the accounting statement 5. Depreciation method should reflect the pattern in which the asset future economic benefit are expected to be consumed. Depreciation method to be reviewed at least at each financial year. Any change in the accounted for the change in accounting estimate. So you have to deal with the prior period item accounting standard 5. Depreciation method includes straight line method, written down value method, and unit of production method. So this is as per the requirements of the accounting standards and Indian accounting standards. That means if as an Indian company, if you are preparing your accounts or your reports, so while you account the depreciation, you are allowed to use only these three methods, or you can opt any out of these three methods, right? When you'll come to the depreciation accounting, we have so many methods, but you have to use any of these three methods, right? That is the one. In your curriculum, we have one another method, that is sum of year digit. We'll talk about that one also, right? So methods of depreciation, that means straight line, diminishing balance, and unit of productions are allowed as per accounting standard 10 and your Indian accounting standard 16. Method should be applied constantly to the convention of consistency that must be followed. That means if you are using like written down value method to account the depreciation, so it should be followed throughout the useful life of that particular asset, right? That is the logic. Disclosure requirements, depreciation method, like while you disclose the things, so you have to disclose ki, like let's say you have accounted 1 crore rupees depreciation on your all assets. So by which method you have accounted that particular one? You have to show it in your note to accounts. Depreciation rate or useful life of the asset, that also have to disclose in that particular one, right? So this is something about the fundamental part of your depreciation. Very simple one. So what is depreciation, or the uses of accounting standards and all that we have discussed. Now, the most important part which we are going to discuss, that is types of depreciation methods. So first we will be discussing the three methods. Here we'll be discussing all the four methods one by one with examples also. Okay. Out of these four methods, written down value method and unit of production in straight line, they are very important. Why they are important? Because as per the accounting standards, these are the permissible methods to the Indian companies. Okay. But some of here is also given in your curriculum, so we have to cover that particular one also. So let's start the discussion with very first method, which is straight line method. So guys, when it comes to the straight line method, it is one of the simplest method to account depreciation. As per this particular method, depreciation amount charged will remain constant throughout the useful life of that particular asset. Let's say we purchase an asset worth rupees 12 lakh. The salvage value is supposed at 2 lakh, and the useful life of this particular asset is 5 years. Okay? So this is the data which is given in your question itself, let's say. So now when you use depreciation by using straight line method, so depreciation is equal to your cost minus salvage value divided by useful life. That means what will be cost minus salvage value? 10 lakh divided by divide by 5. So it is 2 lakhs. So depreciation, the company is going to charge depreciation on this particular asset. First year depreciation will be 2 lakh. Second year depreciation 2 lakh. Third year, fourth year and fifth year depreciation will be 2 lakh. So every year they'll charge depreciation by a same or with a same amount. So that is your straight line method. Simple one. I hope you understood this. So straight line depreciation is very common and simplest method to account depreciation expense. In straight line depreciation, expenses amount is the same every year, 2 lakh, 2 lakh, 2 lakh, over the useful life of the asset. So every year we are charging or accounting depreciation with 2 lakh rupees till the useful life of that particular asset. You just have to remember this formula and you will be able to solve this one, right? So very simple one. Understood? Cost minus estimated residual value divided by useful economic life. So that is something, the formula for this particular one. Now we will be solving some questions. With these particular questions, we will be building our understanding. So an asset purchased for 50,000 has a salvage value of 5,000. Useful life is 10 years. So what will be the annual depreciation under the straight line method? So what will be your correct answer? So depreciation is equal to cost minus salvage value divided by useful life. So which is equal to, cost is 50,000 minus 5,000 salvage value divided by 10. So this is the one. So that means 4,500 will be your correct answer for this one. So the depreciation will be charged with the amount of 4,500. So every year this company is going to account depreciation at the rate of 4,500 in their books. Okay, they'll, like, let's say first year the book value of that particular one is supposed at 5,000. So next year it will reflect after this minus this. Okay, every year they'll decline that particular balance by the depreciation amount, right? Next one. An asset cost 80,000, salvage value is 10,000, useful life is 5 years. So what will be your correct answer? Your cost is 80,000 minus 10,000 divided by 5. So that means 70 divided by 5. So 70,000 divided by 5. So what will be your correct answer? Okay. The question was something else. Okay, sorry. So what will be the total depreciation over the asset's useful life by using straight line method? What will be the total depreciation during this? So 70,000. So why it is 70,000? Because cost minus salvage value. Salvage value will get at the end of the life and this remaining amounts will get depreciated throughout the period. So if they ask you to calculate the depreciation, so depreciation per year, so the outcome will be the depreciation per year. Okay? So this is depreciation for a year into 5, that will come to the 70,000 itself. Hope it is clear. Next one. If an asset costs 60,000, the salvage value is 5,000, estimated useful life is 10 years, and the asset sold after 5 years for 25,000. What will be the gain or losses on this particular sale? So now see, the asset, the depreciation is equal to, depreciation is how much? 60,000, 65,000, 65,000 cost minus salvage value. It is also known as depreciation base. Depreciation base, take a 65,000, 65,000 divide by 10, which is per year depreciation is 6,500, right? So depreciation, first year depreciation will be 65,000. Second year depreciation is 65,000. Third, sorry, it is 55,000, 55,000 minus 10,000. So it is your 55,000. So divided by 10 is 5,500. Okay. So 5,500 for the 4 years. Okay. So if you multiply this particular one, how much it will come? Okay. So 5,500 into 4. So the depreciation which is charged for the fourth till the fourth year is how much? 22,000. Okay, this is 22,000, and the asset value was like 55,000 minus 22,000 is equal to 33,000. So it was 33,000, and they sold after 5 years. Sorry, we have to calculate for 5 years. 55 into 5. So 5-year depreciation was 27,000. 5 years depreciation is 27,500. First, then if you minus this particular one with the 60,000, so 32,000, and you'll get 32,500, 32,500, and they sold it for 2,500 minus 25,000. 7,500. There is some calculation error, but it is a loss of 7,000. It is a loss of 7,000. A loss of 7,500. They occur a loss of 7,500. If it is explained, yes. See? So there is a loss of 7,500. How we calculated this particular one? See, the depreciation for 1 year, we are using straight line method. So per year depreciation is 5,500. How we achieve this one? Cost minus salvage value. Now the depreciation over 5 years, if you multiply that particular one, so we reach to 27,500 itself, right? Now the asset book value at the beginning was 60,000 minus 27,500. So asset value as of now, or at the end of 5 year, at the end of 5th year, the value of this particular asset is how much? 20,500, and you are selling that particular asset for 25,000. So 32,500 minus 25,000, so it reached to 7,500 in negative. So we made a loss after selling this particular asset of worth rupees 7,500. Understood? Very simple calculation mathematics, and you all know about this one. One another question, guys. January 1st, 2020, ABC purchase of machinery worth rupees 1 lakh, spent 4,000 on carriage and 8,000 on its installation. This was a PYQ. It is a PYQ question. It get asked in 2023 or somewhere. So it is useful life is 10 years. Scrap value is 12,000. So what is the depreciation value every year by using straight line method? Very simple. So your cost. So cost is equal to purchase cost 1 lakh plus installation 4,000 on carriage, 4,000 plus 8,000 on installation. So the total cost of this particular one is 1.12 lakh. This is the cost. So when you account the cost, you have to use the property, plants, equipments that accounting standard 10 or Indian accounting standard 16. Salvage value is आपका 12,000. So that means depreciation base or value is your 1 lakh. So now 1 lakh divided by 10. So that is 10,000 will be correct answer for this particular question. Understood? So 10,000 will be right answer for this particular one. So the very first method, which is called your straight line method. One of the simplest method. Basically this method, which if you apply this particular method, the rate of depreciation, the amount of depreciation which we have to account, that is the same throughout the useful life of that particular period. In this case, the depreciation for first year will be 10,000 and even for 10th year it will be 10,000 only, right? So this is the very first method. Now let's move to the second method, which is your straight line method, or sorry, written down value method, or your diminishing balance method. So when it comes to written after this method, please listen me carefully for next 5 minutes. So because if you'll able to make understand, so it will be very easy. Okay. So straight line method versus your written down value method or diminishing balance. Let's say there is an asset, we purchase an asset worth rupees 12 lakh. Same question. Let's say salvage value is your suppose that 2 lakh, and depreciation rate, in case it can be given depreciation rate also. So because for written down value method, we generally have a depreciation rate that we charge depreciation at a fixed rate. So it is your let's say 10%. Okay. So if you calculate depreciation by using straight line method, if you use calculate depreciation by using straight line method, so what will be depreciation for first year? It will be 10,000. Okay, 10,000. How we reach to 10,000? Cost minus salvage value, so that is 2 lakh, 10 lakhs. So cost minus salvage value, which is 10 lakh. 10 lakh ka 10% is equal to आपका 1 lakh. ठीक है, not 10,000, it is 1 lakh. Sorry. So it is 1 lakh. So first year depreciation will be 1 lakh in this particular case. Now, if first year depreciation is 1 lakh, your 10th year depreciation will be also 1 lakh. This is the something which we have already understood with our previous question. So every year depreciation amount charged with the same value. Now, in case of written down value method, the game will change slightly. How it will change? Written down value method says an asset which when it is new, it produce more, it give more output. So the depreciation amount should be at higher rate. So basically, written down value method, when it comes to the diminishing balance or written down value methods, so how you will account the depreciation? First year depreciation will be same, because the book value is how much? No, not same. The book value is 1 point. It is salvage value this 12 lakhs. So the book value is 12 lakh. 12 lakh ka. Now in case of written down value method, it is book value of the asset at the rate of depreciation rate. So that means you do not have to account the salvage value. You do not have to consider this salvage value in this particular case. So 12 lakh at the rate of the depreciation rate is 10%. So it is equal to 1.2 lakh. So initially, what will be the depreciation at the first year? 1.2 lakh. Here it was 1 lakh. Now second up, every year you have to calculate the declining balance or the diminishing balance of that particular asset. How you will calculate that diminishing balance? Again, diminishing balance is equal to, or the decline value of that particular asset is your previous year book value, or at the beginning of the book value minus depreciation for the year. So that means 12 so how you'll reach this particular one? At the end of first year, the asset value will be 12 lakh minus 1.2 lakh. So which is equal to your 10.80 lakh. So this is the book value at the end of first year. So while you calculate depreciation for second year, how you will calculate the book value at the beginnings, which is 10.80 lakh at the rate of 10%. So which is equal to, so the depreciation for second year will be your 10% means 1.80, sorry, 1.08, 1.08 lakh. So the depreciation for the second year will be 1.08, right? Am I clear? Correct? It is 1.2 lakh and it is, please go through these calculation if I'm doing any wrong here. So how you will go for the third year? Just I'll calculate this one. 1,08,000, which is correct here. So 1,08,000. Now minus 1,08,000 is the depreciation. If we reduce this one, so the asset value or the book value at second year will be 9,72,000, right? 9,72,000. This is the book value at the end of second year. When you'll calculate the depreciation for third year, so into, so it will be depreciation. So आपका इसका 10%, which is equal to 97,200. So depreciation for second year will be 92,000, sorry, 97,200. So every year. Now this is the game which you have to make your you have to build your understanding around, right? So here in this particular case, depreciation amount charged will remain same throughout the period. But when it comes to written down value method, initially that machine or asset give the higher output, so depreciation amount charge will be higher, 1.2 lakh. Then आपका it will gradually come down, 1.08 lakhs and 97,200 lakh, 97,200. If you'll calculate depreciation for fourth year, obviously it will come down that one, right? So two things which you have to remember this: your depreciation rate will same throughout the period, but you have to calculate the book value at the end of every year. So sometime how examiner will ask question ki what will be the book value at the end of second year and what will be the depreciation for third year. So in a same question they are asking two, they are giving you two options. So depreciation for third year will be आपका 97,200 and book value at the end of second year will be 9,72,000. So this is something, or even they can ask for 1 year or the fourth year also. So that is something which you have to remember. Understood, guys? Yes or no? Now let's go through the fundamental aspect of this particular topic, right? So this is the depreciation method in which percentage rate that apply to the residual balance. Residual balance means how you will calculate this residual balance. It is the book value at the beginning minus depreciation of the year, right? So this is the one, rather than the original cost, as we are doing in case of your straight line method. In straight line methods, we have to minus the salvage value. Here you do not have to consider the salvage value also. The written down value method account diminishing balance method. Diminishing balance means every year the asset value decline and you have to adjust that decline in your books, that is known as your residual balance, right? At a constant depreciation rate per years. So this method is more relevant where the particular asset is expected to give better performance in the initial period of compared to later one. Sorry. Thus changes in profit and loss account is higher. Charges in profit and loss account is higher in initial years as compared to later years. So how you calculate depreciation? Previous year value divided by, sorry, into your rate of percentage. Okay, now please quickly go through this particular question, Tim. Go through this particular question and try to answer, right? Very simple question. So you have to practice these particular one because it is a downside 3 marks. You guys are going to get these one. So if an asset with any original cost of 1 lakh and depreciation rate is 10%, depreciated using written down value method, what will be the depreciation expense in the second year? So what will be the depreciation amount for the second year? Very simple. So first year depreciation is, depreciation is first year is your asset value 1 lakh at the rate of 10%, which is how much? 10,000. So depreciation for first year will be 10,000. Now asset value at the end of first year is how much? If 1 lakh minus 10,000, which is equal to 90,000. So this is the residual value of the asset at the end of first year. Now when you will calculate depreciation for second year, it is 90,000 into 10%, right? So that is equal to 9,000, right? So the depreciation charge for the second year will be 9,000. So this is the case. If they'll ask for the third year, so 90,000 third year, how you'll calculate? So asset value at the end of second year is 81,000, ठीक है? And the depreciation for third year is आपका 81,000 into 10%, which is 8,100. So 8,100 will be the depreciation amount for the third year itself. So on. So you can calculate according to this. Understood? Next one. If an asset purchased for 50,000 and depreciation is 10%, depreciation rate under the written this. So what will be the at the end of first year? It's a very simple question, right? So 5,000. Sorry, what will be the value of an asset at the end of first year? So it is 5,000 will be the depreciation. Depreciation for first year will be आपका how much? It is 5,000. How we reach to 5,000? 10% of 50,000. And the asset value is आपका 50,000 minus 5,000, which is equal to 45,000. So 45,000, that means option A will be your right answer for this one. Getting my point? Next one. An asset cost 80,000, salvage value 8,000, depreciated at 15%, written down value method. What is the depreciation in the third year? Assuming the depreciation rate is applicable to written down value method. So how you will calculate? So like, see, this is a written down value method. So you do not have to consider the salvage value, right? So this will not get considered. So first year depreciation will be 80,000 and uska how much percent is 15%. This is the depreciation for first year. Let's say it is X. Now this 80,000 minus X, this is the depreciation base for your first year at the end of first year. Second year is, let's say, Y into 15%. So this is suppose that Z. This is the depreciation for second year. Now if you'll minus Y minus Z, so let's say you reach to A. This is the asset value at the end of second year. Third year आपका, how you will calculate third year? So it is A at the rate of 15%, and that will be your answer for this particular question, because they have asked what is the depreciation in the third year. They did not have asked you the book value or others. So that is your answer for this one, right? These answers can be wrong also, but just you have to follow this particular structure. This you have to do it, okay? This is kind of your homework question. So please try this particular one, right? So just build your concept, right? As asset 20,000 for every year rate of depreciation 20%. 3 years. Again similar आपका, ठीक है? You will be able to calculate this one, yes or no? Very simple calculation also. So first year depreciation will be 4,000. Book value at the end of first year will be 16,000, right? Then second year depreciation will be 16,000 at the rate of how much? 20%. So it is equal to 3,200. So my book value minus 3,200. So it is equal to 12,800. So 12,800 into 20%. So which will come around कितना आएगा? Just a minute, I'll calculate this. So 12,800 into 20%, 0.2. So it is 2560. So 2560 means option D will be your right answer for this one, 2560. Okay, so option D will be correct answer for this one. So this is the one. So this is your second method. Now we will be entering to a third method. Third method is unit of production. So when it comes to unit of production, so far your basically these two method is generally based on passes on time. Okay. Now unit of production is something which is about the depreciation is generally get accounted on the basis of uses. Uses means, let's say we purchase a machine for rupees 10 crore. Well, let's say we spend 10 crore rupees on this particular machine. So this is your purchase cost. So cost is aapka 10 crore. Okay? And the salvage value is supposed that 1 crore at the end of the asset. Okay? And the third one is, let's say like that simple meaning same. Output, the expected output from this machine is suppose that 100 crores. Okay? So we have invested, actually we have invested 9 crores. Okay? Cost minus salvage value, that is 9 crore. In this 9 crore you will get how many units? Aapka 100 crores units. Okay? So this is use base. This is called use base method. So you have spent on a machine worth rupees 9 crore. How we reach to 9 crore? Because this 1 crore you will get at the end of the useful life, or the after using these 100 crores units, right? When you sell that particular one as a scrap, so you'll get the 1 crore rupees back. So the actual spend is your 9 crore. So you have spent 9 crore rupees on an asset which will give you an output or estimated output of 100 crores. Now, out of this 100 crore rupees, okay, let's say first year we consume or we produce, let's say 15 crores of units. Okay? So first year production was 15 crore unit. Now how you will calculate depreciation by using this? So unit of production, so depreciation, while you calculate depreciation by using unit of production, it is actual production, taken actual production divided by estimated production into cost minus salvage value. And here is your answer also. So cost is, sorry, actual production is how much? 15 crores divided by the lifetime or the expected production is 100 crores into cost minus salvage value. Cost minus salvage value is how much? 9 crores. So if you solve this particular equation, what will be your correct answer? So 15 divided by 100 into 9. So it is 1.35 crores. So your depreciation for first year will be 1.35 crores. Okay? So this is the first situation. Let's say another situation, second year or any other year, we produce, suppose that 30 crores. Second year production was 30 crores unit. So the depreciation will be higher because it is use based method. If you are producing less, if you are consuming less, you will charge less depreciation. If you are consuming higher, your depreciation will be at higher rate. Let's say, so how you will calculate this one? 30 crores divided by 100 crores into 9 crores, right? So 9 crores means cost minus salvage value. So 30 divided by 100 into 9. So it is 2.7 crores. So depreciation for the second year will be 2.7 crores. So this is the basic calculation. बहुत ही आसान है, ठीक है? I hope you're getting this particular one clearly, right? So unit of production method which generally account depreciation based on uses. You have spent 9 crore rupees on that particular asset, and in that 9 crores you will get estimated 100 crore rupees, 100 crores unit, right? So this is output is in unit or hours, taken 100 crore units. So now out of 100 crore units, first year you consume 15 crores, take 15 crores unit. So for that one, your depreciation will charge accordingly, which is 1.35 crores. Second year you consume 30 crore units. So depreciation will be higher than the previous year because your consumption was higher. So that's why the depreciation is 2.7 crore. Third year, suppose that you consume only 7 crore units. So 7 divided divide by 100 into cost minus salvage value. That is your answer for that particular question. Understood, guys? So let's go through this definition. This method is use-based method. Use-based method. Again, the depreciation amount is not based on passes of time, but actual use of asset. In this method, useful life measure in term of production output or number of unit which an asset is capable of producing during its useful life or lifetime. Like our asset was capable to produce 100 crores unit, right? So that is the one. So how we calculate this one? Depreciation expense is equal to number of unit produced. This is actual number of units produced during that particular period, divide by lifetime number of units or estimated number of units that machine can produce into cost minus salvage value. So this way you are going to calculate the depreciation by using unit of production method. Now first question on your screen. If an asset under the unit of production method produce 15,000 units in the first year, 20,000 units in the second year, and 10,000 units in the third year, what is the total depreciation for the first year if the depreciation per unit is 0.55? So this game is very simple. So depreciation per unit is आपका 0.55 into the first year output is 15,000, right? 15,000. So it is 8,250. You just have to multiply this particular one, right? So this is a very simple calculation. 8,250. Next one. If an asset cost 50,000, salvage value is 5,000, expected production is 1 lakh units, what will be the depreciation third year? 12,000 units were produced in this particular year. So you do not have to worry about the first year, second year, third year. You just have to worry about the actual number of unit produced during that particular period, right? So what will be your depreciation? So your depreciation is equal to 12,000 divided by the actual production or the actual production divided by estimated production, which is 1 lakh into cost minus salvage value. Cost is 50,000 minus salvage value is 5,000. So the outcome is 12,000 12,000 divided by 1 lakh into 45,000. So it is 5,400. It should become 5,400. Am I doing any mistake here? 12,000, 1 lakh 50. It should become around 5,400. I guess these options are wrong. Again, I'll check this one. So 12,000 divided by 1 lakh is equal to 0.12 into your 45,000. So it will come 5,400, right? So it will come 5,400. So 5,400 will be right answer for this one. If an asset purchase 80,000, purchase for 80,000 and production is 1,60,000 unit over life, the residual value is 8,000. What is the depreciation expense for the first year where we have produced 20,000 units? So 20,000 divided by the actual production asset was purchased for 80,000. Expected production is 1.60 lakh into cost is 80,000, salvage value is 8,000. 80,000 and salvage value is 8,000, 72,000. So the outcome will be your answer. It is 20,000 divided by 1,60,000. So it is equal to 0.125 into 72,000. So it is 9,000. It will be your answer. So option A will be your 9,000. Okay? So with some question, what we have the problem with these answer is we have changed these numbers, but we did not change the option. So that's why the challenge is coming. Otherwise, like you have to understand thing, your logic. You have to build your logic. That's it, right? An asset cost 1 lakh. Residual value is 10,000. Expected production is 50,000. First year they produce, or during that particular period they produce 5,000 units. So depreciation will be 5,000 divided by your cost is this. Expected production is 50,000 into cost minus 1,90,000. So outcome will be your answer for this particular question. Understood, guys? A company ABC purchased printer machine that can manufacture 20 lakhs prints. After it have to be scrap. The purchase cost is 1 lakh 10,000. Scrap value is 10,000. During first year production, machine produced 2 lakh. So 2 lakh divided by 20 lakhs 0.10 into the cost of this purchase cost is 1 lakh 10,000. This, so it cost minus service value is 1 lakh. So what will be your correct answer? 10,000. Okay. So 10,000 will be your right answer for this particular one. So this is all about your unit of production. Now the next method is basically based on sum of year digit method. Very simple one, kind of a Sudoku. You are going to solve the Sudoku by applying this particular one, right? First three methods are the most important. Why they are important? That I have already explained you. So sum of year digit method of depreciation. Here in this particular case, when it comes to the sum of year digit method, so you have to sum of year digit methods of depreciation is equal to remaining life divided by sum of year digit into cost minus salvage value. This is the formula. So basically in this particular, in these kind of cases, how you'll calculate depreciation, you have to calculate the depreciation rate first, right? So first you have to understand how we calculate sum of year digit. Let's say there is an asset whose value is 10 lakh, right? Salvage value is 2 lakh and useful life is supposed at 5 years. Now, how you will calculate depreciation or account depreciation by using sum of year digit method. So, सबसे पहले first you have to calculate the remaining the sum of year digit. Sum of year digit is equal to this is depreciation actually. This is depreciation is equal to this. Sum of year digit is the sum of these 5 years, means 5 year plus 4 year plus 3 plus 2 plus 1, which is equal to 15. So the sum of year digit is how much? 15 years. Okay, this is the one. Now, why I mention around this, I can also write like 1 plus 2 plus 3 plus 4 plus 5. This, and again it will be 15 years, right? But this is a wrong approach. If you write this now, you'll do some sort of mistake while you calculate depreciation for second year, third year and all. Well, how come? So what will be the depreciation rate for first year? So first year depreciation is remaining life, that is 5. So 5 divided by sum of year digit, that is 15, into cost. Cost is 10 lakh minus salvage value is 2 lakh. So depreciation for first year is like this. Okay? So what will be your answer for this one? Sorry. So 0.333 into 8 lakhs, right? So 28 lakhs now. Yes. So 20 for the first year it will be आपका 2.66 lakhs. 2.66 lakhs. Okay. First year depreciation will be 2.66 lakhs. 0.33 into 8 lakhs. हाँ बिल्कुल करेक्ट. So first year आपका 26,000 around आपका 666 whatever the number is. Second year, how you'll calculate depreciation for second year? Remaining life. Now this second year remaining life 4 divided by sum of year digit 15 into 8 lakhs. Okay, cost minus salvage value. So the second year depreciation will be 4 divided by 15. So which is 0.2666 into 8 lakhs. So it is 2 first one was 2.13 lakhs. Okay? So 2.13 lakhs will be depreciation for second year. So this is the way, right? So the only thing, now this part why I mentioned or why I have written like this. So see, sometime what happened now during the examination, if you write something like this, so when you calculate the first year, this is your second year, third year, fourth year, and fifth year. When you'll write like this, so it will when you will pick the remaining life at the first year for the remaining life, first year 5 years, so that you'll pick like this. Otherwise, sometime what will happen in hurry if you'll mention like for the first year, if you'll do 1 divided by 15, your all answer will went wrong, right? So you can write like this also, but you have to consider first this one because this is the remaining life during that first year. This is the remaining life second year, okay, third year, fourth year, fifth year. This is the one. Okay, that's why we write in this direction. So we do not do any sort of mistake while we solve these kind of question also. So the sum of year digit method is one of the accelerated depreciation method. A higher expense is incurred in the early years, as it was in our case also, and a lower expense is in the later year of the asset useful life. So depreciation expenses remaining life. All right, I hope you remember that formula which I have mentioned. So remaining life divided by sum of year digit into cost minus salvage value. How you calculate sum of year digit method? Let's say for 8 years. For 8 years, how you'll calculate this one? So it is 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1, which is equal to how much? 36. Okay, so it will be your 36 years. So this kind of things practice which we have to do. In some of your digit depreciation method, the remaining life of an asset is divided by this. It is formula only, right? Chalo, let's solve this one. Calculate the amount of depreciation for first year using sum of year digit method. So you have to calculate first year. So the equipment cost is 1 lakh. Depreciation is 20,000, sorry, salvage value or residual value is 20,000 and useful life is 5 years. So luckily we have 5 years also. So that means what, like remaining life divided by sum of year digit into cost minus salvage value. So what will be your depreciation for first year? Depreciation rate is 5 divided by 15. How I reach to this 15? 5 plus 4 plus 3 plus 2 plus 1, 15. Sum of year digit. So sum of year digit is 15. So that means your 5 divided by 15 means 0.33333 into 80,000. So if you do the calculation, you reach to your answer, right? So 0.3333 into 80,000. So 80,000. So it is 6,664. So 27. That means option second will be right answer for this particular one. Correct? Hai? Understood? So this is the one, right? So guys, this is like you can see also the curriculum as well. So introduction, expenditure, capital and revenue and the differences. Most of the time your question will be around the your capital and revenue expenditure and sometimes receipt also the similar one, right? So when it comes to capital or the expenditures of a business, they are further categorized between two major areas. One is capital expenditure. These are expenditures toward the capacity building of the organizations. Expenditures like property, plants, equipments, or purchase of property, plants, equipments, or any intangible asset like goodwill, patent, copyrights, and others. And they have long-term benefits. So the benefits which are associated with the capital accounts, capital expenditure are long-term, and that's why they are always part of the asset side of your balance sheet. Another side which is your revenue expenditure. When it comes to revenue expenditure, so these are the expenditures on day-to-day activities of the business, like payment of rent, payment of salaries, payment of utility expenses and others. So that means the benefits which are associated with capital accounts are long term, and long term means throughout the useful life of that particular asset. Let's say we purchase a machinery worth rupees, suppose that 10 lakh. Okay. So, and the useful life of this particular machinery is, let's say, 10 years. So, for next 10 years, this will be part of your balance sheet, and in balance sheet, it will be at your asset side. The another one is revenue expenditure. The benefits are limited to a accounting period. That means in between April to March itself. So the consumption or the income and expenditure that happen in a same period. Like let's say we occupied this particular place on rent, and suppose that during that particular period we paid a rent of 5 lakh rupees for that particular office premises or others. So the benefit as well as expenditure that happen in a same period, or even your employee salaries, your utility expenses, internet expenses, or any other expenses related to sales and purchase. So that generally comes under your revenue expenditure. This is all about your capital and revenue. Sometimes we have one another type that is called deferred revenue expenditure. So these are the expenditure which generally happen during accounting period, or we account those particular one mostly in a specific accounting period, but their benefits are for next 2 to 3 years. Example is like your basically your advertisement expense or marketing expense. Let's say we come up with a new product, this marker. So while you introduce that particular product in the market, you have to spend much on marketing or advertisement things and all. Okay. Now you have done, let's say, 1 crore rupees of advertisement expense during that accounting period, but it benefit will come, like let's say as a user or as a customer, I do not want any, or I do not require any marker this time. But after 1 year or 2 years, when I'll require, so I'll that marketing will help me to buy that particular product and all, right? So this is something which is part of your revenue, deferred revenue expenditure, right? So this is something which is around your capital and revenue expenditure. Sometimes, most of the time, they'll give you statements and they'll ask you to find out the which one is capital expenditure and which one is revenue expenditure. So an expenditure decided by capital or revenue depending upon the number of factors such as nature of expense, effect of revenue earnings, and benefit from the expenditures. Nature is like you are using that, but you are doing that expense to acquire or to build the capacity of the business, like acquisition of machinery, or to pay in the short term things. If revenue earnings short term or long term, or benefit short term or long term. So that is something around this one. So capital expenditure. So these are the expenditure incurred by an organization for long-term benefits are known as capital expenditure. These expenditure are added on the asset side of the balance sheet. It is done mostly on assets such as land, equipments, furnishing, vehicles, means property, plants, equipments, goodwill, patent, copyrights that help drive benefit for organization by increasing the operating capabilities or capacities. Let's say we make a setup of new office, we open a new office. So that means you will be requiring that property or the equipments within this particular office and others, and they'll help you to increase your operating capabilities also. And even let's say if you fix one machinery here, so this machinery, let's say the useful life of this machine is 5 years, so it will give you benefit for next 5 years. So accordingly you have to account the expense also, right? So when it comes to capital expenditure, it is amount spent on acquire or significantly improve the capacity or capabilities of a long-term assets such as your property, plants, equipments, which include. So while we account the capital expenditure, it include purchase cost, delivery cost, legal charges or non-refundable taxes or any stamp duties and all, installation cost, upgradation cost, replacement costs. That means how you'll understand this particular one. So let's say we purchase of machinery, from Mumbai, and your plant is located in, suppose that, Delhi. Okay? So we purchase this particular machinery. The purchase cost is suppose that 10 lakh rupees. Okay? And the freight or the carries charges are suppose that 10,000. And let's say the test run or the fitting charges are suppose that 20,000. So when you will account the cost of this particular machine, so it will cost you according to your accounting standard 10 or Indian accounting standard 20. So this plus this plus this. So in your book, you will in your book your cost will be आपका 10.30 lakh. So this is the thing, or anything else आपका, ठीक है? If there is these are the one, so you have to account those particular one also, right? With the help of practice also, we'll see number of things. Believe me, like you do not have to go through this particular unit after this particular session. Okay? So I'll make sure you'll get everything which will be part of your examination. Some like if it comes to cost, which is classified as capital expenditure. So first one is, this is generally divided between two parts. One is initial cost and subsequent cost. Okay? Sometimes they ask half marks question around this particular one. These include initial cost is your aapka purchase price, purchase cost, okay? Duties and non-refundable taxes, cost attributable to bringing the asset to the location, freight or warehousing, and conditions necessary, that means test run and others. Okay? Subsequent cost, these costs include the part of some items of the asset requiring replacement. Okay? Let's say we purchase a machinery. After 2 years, we replace the part of that particular machinery. So that is requiring a regular interval. So these also include the cost of major inspections or for the potential fault in others. Okay? So this is, we have two type of cost under the capital expenditure. Initial cost at the time of like let's say if you are purchasing that particular machinery for the very first time, okay? And this is something which is comes under the your it is not about the maintenance, it is about the replacement and others. So that generally comes under this. So example, like cost of employee benefit arising directly from the construction or acquisition of an asset. Okay, let's say there are some persons who came to your office to install that machinery, so that will part of this particular one. Okay? Cost of site preparation, where you are going to fix that particular one. Initial delivery and handling cost, again that freight and others. Again, installation cost, cost of testing, test run, professional fee charged by those who are going to install that particular one, research and development expenditures in case of your intangible assets and others, or even in your business also. All directly attributable cost necessary to create, produce, and operate and internally generated intangible assets आपका, so they generally comes under this particular one. ठीक है? So it is all about your आपका capital expenditure. Now the another one is revenue expenditure. So revenue expenditure, there are benefits and expenditure that happen in the same period. As I gave you an example, let's say you have paid salaries of worth rupees 50 lakh to your employees. So you have taken work from them. Like yeah, you paid 5 crore rupees rent or 10 lakh rupees rent. You have already consumed that particular property as a your office or any manufacturing plant. So revenue expenditure is referred to expenditure which incurred by the organization to manage day-to-day functions of the business, which include like employee wages, inventory, rent, electricity, insurance, stationery, postage, and taxes during that particular period also. Okay? So revenue expenditure is the sum of expense that the business incur in production of goods and services, or they are related to your operating activities surrounding sales and purchase, which help for revenue generation of the company in an accounting period. They are also known as operating expenses, right? So the differences, most of the time you'll see question based on this particular slide. So the differences between capital expenditure and revenue expenditure. Capital expenditure, so amount spent is usually large while you purchase that property, plants, or any patent and all. So we have to spend more. And here it is relatively small. The purpose is to improve or enhance business or productive or earning capacities. If you are opening a new office, so you are increasing that particular. If you are including a new car in your tour and travel company, so that will help you to generate more profit. Purpose is to maintain the fixed asset. These are the fixed asset in a good working condition. The benefit is long term, benefit is short term. It is non-recurring in nature. Mostly these are non-recurring in nature. You do not have to purchase machine or cars every year for their business, but it is recurring. You every month you have to pay the salary. Every month you have to pay the rent and others. Next one आपका, it is shown in the balance sheet and it is shown in the profit and loss account, because these are the operating expenses of the business itself, right? So this is very simple. You have to take care around these particular things. If you take care around these particular things, believe me, you are not going to miss your 1 marks, right? Chalo. Now the remaining, like this is all about your capital and revenue expenditure. So now with the help of like so many examples or the PYQs and all, we will deep dive this particular topic. So first one is classify the following as a capital expenditure with the letter of C and revenue as with the letter of R. So first statement one, purchase of new factory building. So new factory building is your capital expenditure. Okay. Repair and maintenance expense for existing machinery, it is categorized as revenue expenditure. Acquisition of patent is your capital expenditure. Purchase of raw material, so it is your revenue expenditure. Payment of salaries and wages, again revenue expenditure. Installation of new software, again you are improving the capacity, so your aapka capital expenditure. Advertisement expense, though it is categorized as deferred revenue, but the major category is revenue expenditure. I hope you are able to solve these particular ones. So this is similar, like sometimes they'll give you entries and then they'll ask you ki which are the capital, which are the revenue expense and all, or even they can give you a mix match also. One side capital, revenue, deferred revenue, capital, another side entries, and you have to match that particular one, right? Now what is deferred revenue expenditure? As I told you, like this is something, the best example is advertisement expense. We are coming up with a new product, so in the during the initial period you have to advertise that particular product at a you have to spend much, so people they can have they can have some sort of awareness about that particular product. So once that product will known to the users, so there that like mouth publicity and others, these all also they'll help you, right? So deferred revenue expenditure is an expense which is incurred while accounting period. The result and benefit of these expenditure are obtained over multiple period. Like let's say first year we spend 1 crore rupees on marketing of that particular product. Next year the benefits or the advertisement expense, that is also going to help you in second year, third year and others. Okay. So revenue used for advertisement is deferred revenue expenditure, because it will keep showing its benefit for next 2 to 3 years, or the time you are using that particular or you are selling that particular product as well, right? Unit number 8, you can expect 1 to 2 marks question based on this particular unit. So basically type of instrument of credit, which include your bill of exchange and promissory note. Then we have terms and due date of bill. So certain terminologies which is associated with the bill of exchange, right? So these are the 2 units. Then we have accounting entries, accommodation bill, bill books, right? So these are some areas which is generally part of your bill of exchange. So when it comes to bill of exchange, it is a negotiable instruments which is defined under section 5 of Negotiable Instrument Act 1881. So we have 3 major instruments which are your promissory note section 4, bill of exchange section 5, and section 6 is your check system, right? And in your curriculum they have like this unit is around 90% belongs to bill of exchange, and remaining 7 to 8% to your promissory note, and the remaining 2 to 3% they just have defined the check and the features of check itself, right? So in this particular session we are going to discuss bill of exchange in detail, and we will be discussing the exam questions and other also, right? So negotiable instruments, when it comes to negotiable instrument, these are the instrument which we can use as a instruments of credit, or they are negotiating the basically the existence of cash also. Let's say if you have to make payments as a person, you have to make person a payment to someone else. So either you can go with the online payments or cash, or like if that payments is in future date, so you can do that particular transaction by using these negotiable instrument, right? When it comes to the credit instrument, so we have majorly two: bill of exchange, which is drawn by the creditors, means the seller, and when it comes to promissory note, it is drawn by the debtor, which is buyer in that particular case, right? So negotiable instrument are documents which promise payment to assignee, the person whom it is assigned or assigned to or given to, or a specified person. In India, we have NI Act 1881 is responsible for governing all negotiable instruments. This law defines these instruments and also deal with each type of them individually, as we discussed this, right? Promissory note, section 4, drawn by the debtors, right? Bill of exchange, which is section 5, again, which is drawn by the creditors, and check system or check, which is drawn by the debtor itself, right? So this is the one. Parties and others, they are generally part of this one, but in your curriculum, this is like your bill of exchange. This topic is around 80 to 90% around this particular instrument only. So we will be discussing this accordingly, right? So let's start the discussion with very first instrument, which is bill of exchange. So when it comes to bill of exchange, it is a creditor document. That means it is issued and it is drawn by the creditor. Creditor means seller. Let's say there are two parties, A, who is seller, let's say A sell goods to B worth rupees, B is buyer in our case, let's say, okay. So A sold goods to B worth rupees 5 lakh, okay. And the credit period is, let's say, 3 months, right? The credit period is 3 months. That means after 3 months, B need to pay A worth rupees 5 lakh for the value received. So in this particular case, how like A, which is a creditor whose account is going to be credited, and B is debtor who is a buyer who need to make payment to A. So bill of exchange, which is drawn by the creditor. So A will draw bill of exchange. I order to pay me or my order worth rupees 5 lakh for value received, and the acceptance by the debtor is necessary, right? So means the acceptance of B is like it is must in case of bill of exchange. But when it comes to promissory note, acceptance is not required, right? So 2 months after, that means this bill is for 60 days. Okay. Pay me or my order the sum of rupees 4 lakh only for the value received. So this is the bill, okay, which is accepted by, means this is a debtor. Okay, this is debtor signed by Raj Kiran and Kunal Singh, who is a creditor who issued this particular bill. So this is the format. So we have three parties involved in bill of exchange. Okay. One is your which is who generally issue that drawer. Drawer is Kunal Singh, and then we have drawee. When it comes to drawee, so we have the to whom this bill is assigned, and third party is pay. Pay is who is going to receive the benefit. It can be Kunal most of the time, or it can be any bank also. Okay, so there are so many terminologies associated with this particular one also. Okay, so we will be discussing all these particular one in detail once we'll go through that particular part as well, right? So I hope you get a fair idea around this one. So bill of exchange refer to a legally binding. Why it is mentioned legally binding? Because it is a part of section 5 of NI Act 1881, right? So it is a written commitments, or it is a written documents, so which can be for, like, if any party is not fulfilling the requirements, it can be notified by the notary public, right? So written documents which instruct a party, means debtor, to pay a predetermined sum of money to the second party, which is a creditor, right? So this is like, let's say we have drawer, Mr. Suresh. We have, this is in your book itself, Mr. Mehta, who is a drawee, means a drawer means आपका creditor and drawee is your debtor, right? Amount is 10,000. Date of bill is 10th March, and 3 days is basically the grace period, acceptance, and the period is 2 months. So in that particular case, drawer means Suresh will issue this particular bill, or this bill is drawn by the Suresh on Mehta, Mr. Mehta. 2 months later or after, pay me or my order a sum of 10,000 only for value received. And the acceptance by the Mehta sir is important in this particular case as well, right? This is the legal definition as per section 5 of Negotiable Instrument Act 1881, and this definition is very very important, because with this, with the help of definition itself, you'll get to know the features of bill of exchange, and they get asked so many times in your examination. So bill of exchange, an instrument in writing, that means it should be in written. It is an unconditional order, that means you cannot make any changes. Like if this is the one thing and accepted, then there is no if and but. Now Mehta sir is responsible to make the payments to Sunil Aapka, in the Suresh Aapka in this particular case. Okay? Signed by the maker. Maker means creditor, directing a certain person who is debtor to pay a certain sum of money only to, or to an order of a certain person, or to the bearer, which can be any third party in case of endorsement, right? So this is the definition of your bill of exchange. Based on this particular definition only, so when it comes to the features of bill of exchange, it include an instrument in writing signed by the maker, creditor, containing unconditional order. There is no if and but, to pay a certain sum of money or money only to a person named in the instrument, or to his order to the bearer. Like let's say Mr. A who draw a bill on B, you have to pay me this amount. So later on, A assign that particular one or endorse that particular bill to C. So now that bearer is C, he will be, let's say if he hold like he fulfill the whole your aapka the due courses and all, so that will be part of this one. Okay? On a certain fixed future date or a demand, so it can be usance or it can be demand. Demand is at the time of presentation, they have to make that fund availability. Usance is where we have 3 months or 4 months or 2 months, not 4 months, 3 months maximum, okay? Or it can be 2 months or 1 month also. Okay? Section 5 of Negotiable Instrument Act 1881. From above the definition, you will observe the three parties, which is drawer, so a person who draw the bill, drawee, a person to whom the bill is drawn, creditor, debtors, payee, a person who is going to receive. So most of the time your drawer or payee are similar, or it can be different also, right? So these are the features of bill of exchange, okay? So which you have to take care. I hope this is clear to everyone, guys. Okay? Now there are some important terminologies which are associated with bill of exchange. They are very very important, right? So there are 13 to 15 terminologies which is associated with this one. First one is holder. So holder is, it can be payee or it can be creditor or any other person, who issue that particular, who hold that particular one, who is going to encash that particular one, or who is going to receive the money. Holder. So the person who is legally entitled to receive money on due date, so that is holder. Then holder due course, this is something very very important one. So holder in due course, it can be like, let's say A draw a bill on B. A is holder because A have given some sort of services or some goods to the B. and they do have invoices to prove that particular transaction. Now, this is not only about the sales. When A endorsed that particular bill to C, so C also have to justify that particular one. Ki, this bill of exchange he got for some value transactions and all. Okay. So the definition of holder due course is very important. The holder of negotiable instrument is called holder in due course if he satisfy the following condition. So there are three conditions. First, he obtained the instrument for valuable consideration. A gives some services to B. That is a valuable, or there is an invoice, or like A pass on some bills to B, goods to B. So that is the one. He become holder of instrument before its maturity. Let's say the maturity is 60 days. So he should become, or he should get that assignment or endorsement before that particular date. C is he had no cause to believe that that any defect exists in the title of the person from whom he derived his title in others. Okay? So let's say if it is a normal case, so drawer and drawee, and if there is an endorsement case also, so there should not be any kind of defect which should exist in the title itself. So holder in due course, this get asked so many times for half marks, so please do remember all these three conditions. Okay. Now bill sent to bank for collection, this is very simple. Okay. This is very simple, this is very simple, right? So the bill sent for bank for collection by the holder itself. Okay, so and holder is going to receive the money. So bill sent for collection of the amounts on behalf of the holder of the bill. Honoring the bill, again very simple. Okay. So the drawee, he is making timely payment, whatever the date mentioned on that particular one. Okay. So basically, let's say you are a creditor, you draw a bill on me for 60 days. The date came and you presented that bill on your bank and it got on. So basically, it got honored means I'm maintaining the sufficient funds, so you can get your value for that particular one. Okay? So that is honoring the bill. Okay? Dishonor is आपका you presented that bill on 60th day as per the promise or date, but there was insufficient funds in my account. So that is dishonor, right? So now case will story will start from this particular one. Okay? When the drawee of the bill is unable or refuse to make the payments on the due date, so this is called dishonor. Okay? Before coming to the non-sufficient charges or the dishonoring case, or notary public or notifying and others, there is one another point which is called discounting of bill. Okay? So discounting of bill, it is a kind of a credit facility which is provided by bank to the exporters and all. Let's say I'm a small exporter. I did a export worth rupees 10 lakh to party ABC. I'm going to receive that 10 lakh after 3 months, right? So now I approaches to you as my banker कि I am going to receive this particular money or value after 3 months, but for the working capital purpose and any other business purposes, I need some sort of money. So I have given or the authority or I have passed the ownership to you, and you discount that particular one, let's say at 5%. That means 10%, 5% of 10, 5 lakh, 5% of 10 lakh you will receive as a commission, because you are managing or you are giving me money for the next 3 months as a kind of a loan. That is this one. Okay? So before the due date of bill, the holder may endorse the bill in favor of his banker and get immediate cash from the banker. So this is called discounting. So I do not have to wait for next 90 days, because that as per the requirement, I'll be requiring that money or I'll be needing that particular money and all. So that is something which is part of this particular one, right? Next one, endorsement of bill. Endorsement of bill, transfer of bill to some other person by the banker's holder. Okay. So let's say it is a case where as a owner, I'm transferring that particular one. Let's say I A draw bill on B. Now A, who have some sort of like they have some vendors from where I have purchased that raw material. I have to make them payments. So I directly assign that bill to C, from them I have purchased those raw material and all. Okay? Retirement of bill, this is something, let's say there is a bill where we have a date mentioned, let's say 90 days, right? But that drawee make the payment on the 60th day. So that is called, now that bill will got retired again. So when the drawee pay the bill before its due date, it is called retirement of bill. Renewal of bill, it is a case of kind of non-fulfillment of commitment. Let's say A draw bill on B. Now A won't be able to make payment on the given date, let's say 60th day. So now A approach to let's say A draw a bill on B. So B have liability to make payments on 60th day. Let's assume that B won't be able to make that payment on 60th day. He approaches to A. Ki, yeah, this is the problem which I'm facing right now. And what I can do, ki, like let's say out of 10 lakh, I can give you 2 lakh in cash. Remaining 8 lakh, please draw a fresh bill. And if you want, you can charge the interest of this particular person as per the negotiation. So that is renewal. So when drawee unable to meet the bill on due date, he requests the drawer to accept a part of the bill amount in cash, and for the balance draw him on a fresh bill together with the interest also, right? Accommodation of bill, when one party accept the bill drawn on him by the another. It is something, let's say there are two like two businesses or two business partner. Let's say like A is drawing bill on B. There is no actual transaction happen. Like let's say B does not have actual liabilities and all, but he needs some sort of money. So B is helping in that particular case. Okay? So when one party accept the bill drawn on him by another without consideration, without any consideration, there is no sales purchase between those parties. Okay? For the purpose of mutual help, the bill is said to be accommodation bill, right? Next one. Now, these particular things are generally from here to here. They generally belongs in the case of your default. Okay, let's say default means dishonor. Dishonor of bill, we know. Okay, the date was 60th date. Okay, and drawee refused to make payment or they are unable to make payments. Now dishonor, that bill got disowned. Okay. So now we'll have some sort of battle, legal battle, okay, and that legal battle which start with the notary public. So as a drawer of the bill, I have to approach to notary public. It's a government official who will notify your case. Okay, so in that particular case, he is an officer appointed by government to exercise the power and functions relating to protesting of negotiable instrument for dishonor. So he is going to account that particular one. Noting is, on dishonor of bill, the holder in due course present the bill to a notary public to make necessary entries on the bill or on separate paper attached to the bill. Okay, that is called noting. Protest, then after this you will file a case. When the promissory note or bill of exchange has been disowned for non-acceptance or non-payments, the holder may within a reasonable period cause such dishonor to be noted and certified by the notary public, such as that is generally known as that official outcome disowning, or the certificate you will get from that one, that is called protest. Okay? Noting charges, so you have to pay some amount to this particular process to governments, so that is called aapka noting charges. Okay? So this is the one. And the final term is a rebate. When it comes to rebate, let's say A draw bill on B for 90 days, and now let's say there is a case ki B is making some sort of offer to A ki if I pay this particular bill on 30th day, so if you allow us a discount of 1%, so we'll make payments on 30th only. So if that deal happened between these two, that is called rebate on bill. So when a bill is paid by drawee before due date, some allowances is given to him. This is generally known as rebate, right? So these are some terminologies which are associated with your bill of exchange, and they are very, very important one. Sometimes you will see the statements, which statement is wrong, and out of let's say 4 statement, 1 is incorrect, 3 are correct. So you have to develop or understand these particular one in detail, right? Now the next instrument is promissory note. So when it comes to promissory note, it is an instrument which is written by the or which is drawn by the debtor. Debtor means the buyer, right? So as I gave you a case, A is seller, A is seller, and A sold some goods to B. B is your buyer, right? So the amount was 5 lakh rupees. So if it is if A draw bill on B, it is your, that is generally known as your that is called bill of exchange, which we have discussed. Now promissory note, when B draw B provides some sort of promises to A, that is called your bill of exchange, right? So STEM, like in this particular case, B will issue or give a written promise. I promise to pay you or your order worth rupees 5 lakh for value received. Okay? So 2 months later, I promise to pay Mr. Sushil or his order a sum of 10,000 only for the value received. In this case, the debtor itself making promise, so we do not need any sort of acceptance. So acceptance is not mandatory in this particular case. Even in case of any dishonor and others, you do not have to root through the notary public and all. Okay? That is that is directly can be challenged in this one. Okay? So this is the format of this one. So now go through the definition. Again, you will get the feature and all. An instrument in writing. So aapka, this is the same thing which we have for bill of exchange also. Containing an unconditional order. This is also same, right, by the maker to pay a certain sum of money only to or to the order of a certain person or to the bearer of the instrument. So that is generally known as your promissory note. I promise to pay you or your order worth rupees this for value received. So this is something which is generally part of this one. We have two parties. One is maker. Maker means drawer, means debtor, right? So drawer, an individual or entity who make or draw the promissory note with a promise to pay a certain sum of money in this, which is also known as promisor. Payee आपका, the payee is the person in whose favor the promissory note is drawn, which is basically your creditor in this particular case. Now, this is something which is very, very important. So many times you'll see the question around this particular slide, right? So basically, the differences between bill of exchange and promissory note, the most asked question in your examination. I hope now everybody able to find out this. So bill of exchange, an unconditional order, same unconditional promise. Okay? It is made by the creditor. Most of the time you guys get confused with this. It is aapka debtor, right? Acceptance by debtor is necessary. No acceptance is required. There are three parties. There are two parties. On dishonor of bill, it is usually noted by notary public. But here, noting is not necessary because it is drawn by the debtor itself, right? So this is done. So this is something which you have to have remember, and that is definitely going to help you in your upcoming examination. Now, next one. The final instrument is check. Very simple one. We all know check and the things around this. So Section 6 of Negotiable Instrument Act 1881, a check is a bill of exchange drawn upon a specified banker and payable on demand. So features of check, this is the only content which is given in your book. So a check must fulfill all the essential elements of bill of exchange, means written unconditional order and those kind of things. It must be payable to bearer or order to, but in either case it must payable on demand. The banker, bearer means to who hold that particular one. The banker name thereon pays it when the presented for the payments. The signature must tally with the specimen signature of the drawer kept in the bank, kept in the bank itself. Your account signature, and that should, like, the account holder signature and the signature which is mentioned on the check should be similar and all, right? So this is the one. Only this much of content given for your aapka check system and all. There is one comparison also. Yes, So bill of exchange and check. If you compare these one, a bill of exchange can be drawn upon any person, including a bank. A check is drawn only upon bank. A bill of exchange require acceptance. It does not require any acceptance. The acceptor of bill of exchange is allowed 3 days. There is a 3 days grace period, but there is always on demand. Take the exact date आपका, ठीक है. Here we have 3 days grace period. Let's say if the date is 1st of August, so आपका first, second, third, it will be payable on 4th आपका, right? A bill of exchange must be stamped. This point is important. Please do remember this. A check does not require any stamp, but this is required. Notice of dishonor is necessary. Here, we do not need, like if check got bounced or disowned, we do not need any kind of that routing that particular transaction through the notary and others. All right. So this is something which is related to this particular one. Correct? Particular features of accounting system, cash and non-cash, and we have accounting system of different banks. So as I said, like when it comes to the banking system, we have two type of transaction. One is cash, where we have involvement of cash deposit or withdrawal, and some are non-cash transaction also, where we are like providing some sort of services and all. Okay? So now like guarantee work and others. But when it comes to cash transaction, it get handled through two major accounts. One is your like debit accounts or debit transaction. Another one is credit transaction. And the rule for debit and credit is very simple. When money goes out, we do the debit transactions, and when money comes in, so that we generally handle through the credit transaction, right? So both debit and credit operation on all accounts, either by customer or by bank itself, are made by mean of vouchers. For that one, we have vouchers. So vouchers, this you have experienced so many times. Let's say there is a customer who came to your branch and he deposited some money. He opened an FD, he opened an RD, or he withdraw, or he generally withdraw money by filling that voucher forms, right? Or even sometime they let's say they issued some check to some other party. That means by routing your bank, you have to make payments or you have to debit the customer accounts and all. So all these cash transactions, they generally handle through the voucher system, and that voucher system is debit and credit. Debit voucher when money goes out, and credit voucher when money comes in. The game is you have to build your understanding which transaction come under the debit voucher and which comes under the credit voucher. This is all about this unit, right? So let's have a look around the debit vouchers first. So type of debit voucher: check issued by customer. So in this particular case, basically, let's say you have account of ABC person. Now he issued a check in the name of XYZ Limited or any other person, right? That means the cash, there will be cash outflow from that account holders. So you will handle that particular transaction, or that voucher which will be required in this particular case will be debit voucher. Check or pay order issued by the bank on behalf of customer. Withdrawal from the saving accounts. It can be through the ATMs or any other one. Simple. Or even by presenting that voucher also. Draft from other branches payable at your branch. Draft from other banks under the arrangements, which is payable at your bank. Dividend or interest warrant by customers payable by the branch. So let's say you have some company accounts, and the company is distributing dividends among the shareholders. So that means you have to debit the customer accounts or the company accounts, and you have to credit to those different shareholders accounts. So that is a debit. That is again deal through the debit voucher. Traveler's check, which is presented for payment at your branch. Cancel draft or pay orders with refund to the customers. Instrument like gift, traveler check of other bank paid by your branch. Standing instruction from the customers, like payment of insurance premium, club charges and others. They generally comes under this. Branch prepared debit voucher authorized by the officials and by the customers also, right? So these are some vouchers, okay, so which is generally part of the debit side. Okay, so these are the vouchers which were given in your book itself. Apart from that, also we have we deal with the different transaction on daily basis, and it is something which is actually based on your day-to-day activities. Okay, so you just have to remember these particular one. That's it. If you practice in others, you do not have to take tension around this thing. So if you'll practice with the questions and all that, so you will be able to remember. And this is something which is part of our daily working. So it is like easy to handle this particular question. Okay. Now, the other part is credit voucher. So when it comes to credit voucher, when money comes in, okay, so like when your branch or your bank is receiving money, okay, your account is getting credited, or you are like you are the money is comes in basically in simple terms. Okay. So in any form, credit voucher are used to record crediting of accounts and can be various type, which include pay-in slip. Okay. So pay-in slip filled by the customers for deposit in the saving accounts, or for opening FD, RD, or for any government challan and others, okay, where you are receiving money, okay, you are handling money. Okay. So filled by depositor, customer borrowers from depositing funds into their accounts, usually standardized through the special format may exist for specific customer agreements. Application for financial instruments, okay, so include like FD opening form. Okay. So let's say there is a customer who open an FD with your bank worth rupees 1 crore. That means you will receive the money. Okay. So it is through the credit voucher. Demand draft, NEFT, RTGS, banker's check, pay orders, gift, traveler check. Some are submitted by the bank for its own payment. So these are the inflows. Okay, you are receiving money through the demand draft, or any traveler's check, okay, or any NEFT, RTGS in other form. Okay. Government challenge. Okay, this get asked so many times, so please do remember this one. Okay, let's say there is an application which is released by the government, or let's say in case of banking system, okay, let's say IBPS is conducting some bank examination, and they like the basically the challan will be submitted through your bank, or even some other, like let's say in case of registration and all. Okay, let's say your bank is collecting bank for that fee which is government is going to charge. That means while customer they'll apply for that instruments, or while students will apply for that particular post, they have to fill the challan and they have to make the payments. So you are going to receive money in that particular case also. So use for depositing amount into central state government accounts for taxes. It can be used for taxes also, or a scheme like the public provident funds and others. So they are generally part of this particular one. Okay. Apart from this, branch prepared credit vouchers. Branch prepared credit vouchers made on official stationery, typically authorized by the bank officials. In some cases, customer also sign as a proof of the transactions, which are like credit for locker charges, and deposit for non-judicial stamp, as I gave you the example earlier also. Payment for documents execution in favor of the bank also, right? Credit evidence from other branches issued on collection of instruments sent for clearing. These may also include collection scheme, or be known as different name in different bank also. So these are some major credit vouchers which we have, which we generally deal on daily basis. This is a very simple one again, or one of the most simplest unit from your module A. And the weightage is very less. Mostly it is half marks question 90% time, and sometimes they'll give you one entry ki there is a customer called Ram. He deposited, he opened an FD with your branch worth rupees this. So it will be categorized under the debit or credit. Sometimes they'll give you 2-3 entries. Then they'll ask you ki which of the following is not a debit voucher, and all these kind of. We'll practice so many questions based on this particular. This is that all about the theoretical aspect. When it comes to the back office function, which include functions, the core functions of this particular one, reconciliation of functions in bank team. reconciliation of inter-branch and office entries. So they are generally part of this one. Very small unit, and everything which is part of your curriculum that we are going to discuss in this particular session. Right now, nowadays banking, which become very dynamic, apart from the traditional banking, we have so many areas. Earlier, like we used to have the limited scope, which is borrowing and lending, but nowadays, like we have so many functions. Like if you study the BCBS, Basel Committee on Banking Supervision, so as per their categorization, we have 8 different type of business segment, right? And when it comes to the further classification, again as per BCBS, we have like risk wise 3 books: banking book, trading book, and off balance sheet exposure. Banking book, which generally deal with deposit and advances, trading book, tradable securities, and off balance sheet exposure, which are basically guarantee work provided by bank. 8 major business line, which include retail banking, wholesale banking, payment in settlements, or any like trading activities and others. So there are so many areas which generally comes under this one, right? So a bit more of theoretical if it comes to the unit 9 and 10, right? So functions performed by back office, like so back office, first of all, when it comes to back office, it is generally known for the your settlements or reconciliation activities and all. Okay? Everything like transaction settlements and others, that generally done through this one. Like we have front office, we generally deal with the customer dealings and others, or execution of trades and others. When it comes to mid office, it include risk management through MIS and others. When it comes to back office, it is generally known for settlement activities, or the bookkeeping, or the reconciliation activities and others. So the back office in banks support the front office activities with specialized role in treasury and forex, focusing on confirmation in settlement transactions, one-to-one confirmation and one-to-one settlement also. Confirmation is, let's say, if front office executed some deal, so that the settlement of that particular one, that means buyer is getting securities and seller is getting payment, that is settlement. Confirmation is like one-to-one confirmation with both the parties, debtors and creditors. So this where basically we are going to talk about these particular one. So bookkeeping and accounting, transaction processing, journal ledger, maintenance and reconciliation and financial statement preparation, deposits, interest calculations on loan and advances, service charges and account operations management, loans आपका end to end loan processing, EMI calculation, interest posting and risk management, regulatory compliances, KYC gap identification, grievances redressal, e-banking आपका handling internet, mobile and card based transactions, and other like clearing, collections and remittances. So these are some core functions which are generally get performed by the back office in the branches. Okay? So like let's say if you are part of any branch, so we generally work as a front office person, and we do not have any segregation. But in some cases like forex business and others, where we do have the segregation, where front office people, they do not participate in mid office or back office. But in case of a normal branch or a retail branch, first like till 4 p.m. we used to deal with the customers. We act as a front office person, but then after that we generally start catering, or we generally start dealing with those particular transaction reconciliation and all these particular activities as well, right? So when it comes to reconciliation functions in bank, so it is basic reconciliation function in bank, which is these are the groups. Reconciliation of accounts for payment involving intermediaries. It can be payment aggregators, or online payments and others, like merchant and all. Reconciliation account of correspondent banks like nostro accounts and others. Reconciliation of bank account with RBI and other bank and institutions, like other banks. It can be bank to bank or other institutions like DFIs and others. reconciliation of inter-branch and office entries, like branch A and branch B, they entered into a transactions. So that how you have to manage those particular one, that generally comes under this one. Okay? So these are the four broader categories, five broader categories of your daily transactions or reconciliation you have to maintain for these. So one by one we will be discussing all these in a broader categories. So reconciliation of account for payment transactions which involve intermediaries role of intermediaries in electronic payments. So online payments for goods and services like bill payment, e-commerce have become common. So payment made through the bank and prepaid instruments often involve intermediaries like payment aggregators like NEFT, RTGS, UPI, and others, or gateway providers like UPIs or like phone pay, Paytms, and others, and e-commerce or m-commerce platforms like wallet system or any other one like Amazon and others, they are generally part of this. So customer, they generally use these different platforms to make payments or to do the transactions and all. So at the end, like after every transaction, we have to reconcile that particular one. If there is any lag, we have to fix that particular lag. Sometime, let's say there is a customer who did some transaction by using some gateway, and that transaction, let's say that transaction got failed. So what will be the reversal entries and all, how to do that particular one? That is a major concern of this particular one. So process of fund flow, payment by customer for are first credited to the account of the intermediary. Then these funds are later transferred to the merchant's accounts as a final settlement. Any delay in the transfer that can risk customer or merchant interest disrupt the payment system. So this is the sequence. Usually these are the part of sequence, and this is something a challenge which we might face during that particular payment. Let's say there is a customer who purchased something online. So now that the customer account will get debited in that particular case, and the intermediary account will get credited, and then intermediary will pass on that particular benefit to the merchants. So sometimes there is some lag or some failures, so we have to like at the time of reconciliation and all, we will able to find out those particular errors and all, and we have to solve those particular one. So reconciliation of account for payment transactions involving intermediaries at RBI guidelines. So to protect customer and merchant interest, RBI mandated, which these are the one, intermediaries must properly account for receive payment. So you have to make confirmation that like let's say customer made that particular payment, that is correctly credited to the merchant accounts and all. Payment must be remitted to a merchant promptly. Same time, guidelines are in place for opening, operating, and settling account for such transactions as well, right? So ATM operation and reconciliation, to bank engage in third party vendors for ATM cash management also. So vendors who collect cash from the bank, load ATMs, and collect deposit customers deposits from the ATM also. So bank must periodically reconcile with these vendors. Reconciles bank departments monitor ATM balances as well as bank book to ensure proper reconciliation and adjustment also. So similarly for the ATM transactions also, you have to do these kind of things. So first category, intermediaries where we have involvement of intermediaries, where there is a no direct relation between bank and customer. There is one third party which is usually your in case of online payment merchant, or in case of ATM handling. So if we have involvement from some vendors, so you do have to reconcile those particular one on timely basis. Apart from this, bank account with RBI, other bank and institutions. Okay, so like our bank, they maintain CRR with RBI, or some other deposit with RBI and other banks and other DFIs and all. So that also need to be reconciled. So bank maintain current and other accounts with RBI for transaction like CRR, repo, reverse repo, clearing RTGS, and currency chest activities. So only designated branches reconcile these balances using a statement from RBI. Designated branches, mostly these are the currency chest or the head offices itself. downloadable from the website of or via mail with maker checker process ensure accuracy. So special attention is given to cash transaction remaining unresponded. If any transaction is remain unresponded, so we have to reconcile those particular one or check those particular one. Then we have outstanding adjustment or any write-off. Old outstanding balances remaining unadjusted for a significant period. So RBI require periodic reconciliation of security balances in bank books, which is our custodian accounts, subsidiary journal ledger or demat accounts, quarterly or more frequently if transaction volume are high. So this is the one. Okay. So the next one is the similar one. Okay. So balances with other institution and all. So these accounts used for clearing, collection, investment, and money at call and short notice. So follow the similar reconciliation process. Ensure no debit for charges or a credit for interest is outstanding, and all items, bills collected or commission are credited when received. Ensure no check sent or received is in clearing is outstanding with a return check accounted for on the same or next day. Ensuring all outstanding check or bill sent for collection are credited by the closing date. So this is something, there was one unit which we have discussed. I hope you guys remember. In case of businesses, we used to prepare one document that is called BRS, Bank Reconciliation Statement. So the bank balance or the which is in the form of passbook and cash book. So the comparison. Similarly, here also we are generally cross-verifying transactions in case of maker and checker relationship. Okay? And we are making sure that our books are error-free. So that is the only motive of these one. Reconciliation of inter-branch offices entries. This is something which is confusing because here one branch is debtor and another branch is creditor, right? So this is something like same bank, two branches they are dealing, like traveler's check or demand drafts and others. So that we have, which is like one demand draft is issued by your bank, which is payable at another bank or another branch. So these kind of things which are interbank transactions, or like one bank to another, like let's say SBI to PNB, or it can be intra also, SBI to SBI, two different branches. But nowadays intra banks transactions are limited after the CBS system, but we have interbank transactions where we have to deal with different transactions and all. So inter-office transaction usually start at branches and invoices interactions with other branches or the head office team. It is something one branch to another, inter-office team. A typical inter-office transaction uses the inter-office account for balancing, like so when draft is issued, customer account debited to inter-office account credited. Okay. When another branch pay the draft, they'll make the entry like pays accounts is credited, Ram Shyam or whatever ABC company and all, to your inter-office account is debited. Okay. So inter-office is basically where we have two different like same bank, PNB, two branches. They are interacting with each other, or SBI, two branches. So one is located in Delhi, another is located in Mumbai. So these kind of activities which is generally part of this one. Reconciliation processes, inter-office entries from both participating branches are reconciled regularly. These reconciled entries do not appear in the list of outstanding or unreconciled transactions and all. Completely theoretical one. So you just have to go through this particular one once, and then with the help of question itself, like as much as you will practice this particular unit, you will get expertise, right? And you do not have to worry around this. Most of the time, the question is for half marks only, okay? And one study is more than enough for this particular one, right? Major transaction resulting from in the inter-office entries. So like remittances and instruments, issue or payment of draft at the other branch, as we discussed one example also. Clearing transactions, receipt and payment instruments, it can be check or others. Electronic transfer like NEFT, RTGS, one branch to another. ATM transactions, a non-home branch to a merchant ATM. payment gateways, ATM related interbranch settlements, instrument payments like gift check, interest, dividend, purchase warrants, etc. Nostro operations by authorized branch dealings in foreign currency, forex transaction, exchange of rupee with foreign currency handled by a nodal forex branch or main foreign branch. Okay. Then we have our cash handling, deposit and withdrawal from currency chest of other branches in case of any shortfall, cash transfer between branches and all. Okay? So these are some major transactions which are generally part of your inter office entries and all. Okay? So which is not like eventually which are not going to affect the overall portfolio of bank, but there is a movement of cash or movement of in term of money from one branch to another one. So reconciliation is apart from that also, so we have interest payable or receivables between head office and branches, profit and loss transfer by branches to head office, government transaction, receipt and payments of nodal branches or agent, like in case of any government sponsor schemes and others, benefit or direct benefit transfer, interest based transactions involving different branches, internet based transaction, credit card transactions आपका inter branches settlement of customer uses, nostro accounts of Indian branches maintained with overseas branches, capital funds with overseas, head office and overseas branches, transfer from overseas branches received by Indian branches. Okay? So this is a common list which, like when it comes to the interbank or inter office transactions, okay? Not interbank actually, it is, these all are inter office. Okay? So two branch inter branch आपका, okay? So this is something inter branch. These are the common inter branch or inter office transactions which we generally do, or like customer they generally execute their transactions, so we have to take care around these particular one, right? So the reconciliation setup and process for inter office account in banks are typically centralized at a designated office or IT department at a head office. Branches send daily statement to a central reconcile department CRD, where the computer system match the originating entries with the responding entries. Unrecognized entries may result in time lag in some entries, like in case of draft or check and others. Okay. Mistake in branch daily statements, some wrong entries and all, they can be reason for the differences or some fraud also. Okay. So bank generate report of unreconciled entries requiring artificial intelligence and human intelligence to investigate. Practices for handling unreconciled entries, which include correcting branch statement errors and ensuring proper statement preparation. Okay. So these kind of mistakes and all can be handled through this. Using ABC analysis for reconciliation. Okay. ABC analysis is something which we usually use in inventory and all. Okay. So ABC is like we are giving priority, right? Let's say the high value transaction are categorized under A, then medium value transaction are categorized among B, and then C aapka all the other transactions. So this is ABC analysis we can use for the reconciliation purpose. So we can divide, let's say there are 1000 entries, so we can further divide those particular one among the three different categories, and we can easily do the cross checking and all. Okay. Focusing on high value or fraud vulnerable items. Okay. Setting up procedures for unresponded debit entries by branches, expediting clearance of arrears or especially large value entries, special focus on reversal entries indicating a potential irregular payment or fraud also. Okay, so this is all about your unit number 10. I know this is very theoretical and you do not have to do any sort of rectification, as well as you do not have to worry around this particular. I have created some question I have included in this also. Okay, statement based question. One question will give you an idea about entire the slide or the things which is part of your curriculum, right? So once you'll come to the practice part also, so there also you'll get a set of questions and all. So unit number 11. So the basic introduction, role of audit and inspections, emergence of risk-based internal audit. This is very, very important again. So, risk-based internal audit, which get notified by RBI in 2002 and 2021, there was some changes in this particular one. And every time we have experienced one question around this particular topic. The another topic is which you'll see in your examination, that is different types of audits, right? So then various other type of cutting. So these are the three subtopics. Maximum time, 90% time, you guys will face question around these particular one, and you have to be very careful around this thing. Okay? So in this particular session, we will be covering all the like all the subtopics which are generally part of this particular one, and we will go through in detail whatever it is required for the examination, right? So guys, one thing before start this particular session, when it comes to the banking company, so banking companies, they need to prepare their final accounts as per section 29. Okay. So section 29 of BR Act, Banking Regulation Act 1949. So they need to prepare their final accounts or their final reports. And as per this particular one, basically when it comes to the final reports, so they have to prepare final reports which include profit and loss accounts and balance sheet statement. So we have Form A. This we will be discussing in detail in our Module B. So Form A, which represent to balance sheet, and the another one is Form B, which is generally comes under the which generally represent to profit and loss account, right? So in total we have 18 schedules, okay, which include note to accounts also, right? So the preparation or the format which is given by RBI in these in the section 49. So now after preparation of these particular final accounts, companies or banking companies, they need to prepare or they need to conduct audits on these particular documents. When it comes to audit, so audit is generally conducted as per the your section 30 subsection 1. Okay, so as per this, we have to conduct audit on these particular one as well as others. Okay, when it comes to special audit, okay, so when it comes to special audit, that is generally get conducted on like under section 30 subsection 1 subsection B, right? And when it comes to inspections on these particular documents and others, so that generally defined under section 35. Sometimes some banking companies, they went for liquidations as per the recommendation of governments, or when they are like RBI made some sort of decision around these particular one, that is comes under section 38. We will be discussing all these particular one in our module B, but this is something like when it comes to the audits things, it can be internal or it can be external. Okay, so now when we are conducting audit around these particular one, so this can be statutory, or this can be your internal, or even while we prepare these particular documents or on our day-to-day transactions, we have concurrent audits and others. They are generally part of the regular like we can say regular checks or the regular ticks and all, right? So we have like the motive, the ultimate motive is to prevent bank from any sort of financial risk. So their book should sounds in a right manner, right? So whatever their book show kind of the actual position of that particular bank, and we can eliminate any sort of malpractices which is going on in the branches or even at the bank level also, right? So section 29 which generally mandate the audit things, and the section 30 subsection 1, which generally comes around the your like audit related things or the special audits which is conducted by RBI, and even the expense is also borne by the bank itself, right? So sometime when RBI in some sort of spacious about any bank or any segment of that particular bank, so they can conduct inspections of that particular bank under section 35 of BR Act. So section 30 subsection 1 subsection B, section 30 subsection 1 is related to audit and inspections, which generally comes under section 35. Okay. So this is a format, like this is form A, performa balance sheet, and this is form B, performa profit and loss account. Okay. When we'll come to the final accounts of a banking company, we will be discussing these particular thing in detail. Okay. Though, like if you'll open your book, so these are not part of this particular unit, means unit 11. I'm just giving you an idea so that you guys can be familiar with this one. Okay. So this is a format of balance sheet which include 12 schedules, 5 schedules which belongs to capital and liabilities. Remaining 6 आपका sorry 6 to 12 which generally belongs to assets. When it comes to profit and loss account, so your profit, which is like income minus expenditure, income 13 and 14, expenditure 15 and 16. 17 is your the overall profit and loss account after all adjustment. After that, you will see one another documents which is generally known as note to accounts. Okay? So in that particular one, we generally provide some sort of let's say when it is capital. So the further bifurcation of that capital, or let's say if there is investment, okay, so investment related disclosures will be part of that particular one. We will be going through these particular one in detail, right? So there is nothing like we do not have any direct link, but just I just want to make a link so you can like where this audit is required in others, and even like if there is any malpractices which is like conducted by bank or by the auditors. So chapter 5 of RBI Act, they have some sort of provisioning for like it's a criminal offense. There can be a imprisonment of 3 years as well as the monetary penalties. Okay? So these are the things which we will be covering. But audit is something which is something related to our, like we also used to cross check our daily transactions. That is also named as audit, and which is internal audit. We have concurrent audits on the transactions which can be quarterly or monthly basis by the external auditors like CAs and others. We do have statutory audits which is done by the, like how we are meeting with the compliances, if is there any breaches of compliances and all, so they generally comes under this one, right? So now first we will be discussing the basics of audits and all. Again, what is audit important, then the most important part, as I told you, that internal risk based audit system, then after types of audit, then we will be practicing a set of questions. So even the banking companies, after preparation of their final reports, means these, we need signature from at least 3 directors. After their signatories and all, we generally conduct audit, and we have to submit 3 copies of balance sheet, 3 copies of profit and loss account with RBI within 3 months from the end of respective financial year. That means 31st March is the end, April, May, June. So before the end of June, you have to submit 3 copies of balance sheet and profit and loss account along with auditor's report with RBI. So this is generally mentioned here, right? So section 30, which is deal with the audit things and all. So now this is from here basic. Actually, your this unit 11 content start from this particular one. So role of audit and inspections. So when it comes to audit, like it is a kind of a verification. So like if we are if let's say we have prepared the final accounts, and if there is no audit on those particular documents by the externals, so there will be some sort of, there are chances of malpractices, right? So if we will not cross verify those particular one, there will be always some doubt in the mind of the stakeholders. So to resolve those particular one, or even by the regulatory bodies also, so to resolve those particular one, we generally conduct audits in our businesses, or it is as simple as that, as we conduct audit for a business. Similarly here also, the bank, they are generally dealing with number of customers and all, so we should have a fairness in the business and all, so that generally get tested through these particular one. So focus, like when it comes to shift in objective, earlier it was around the verifying arithmetical accuracy to ensure fair representation of financial effort. Two, now it is checking if accounts are true and fair and not just true and correct, right? So this is something which we generally change. Technological advancement, which generally provides some sort of aid. Use of computers in auditing has grown significantly. Rise in data analytics importance due to technological growth and emergence. And even like we have information audit also. So with the help of these particular one, we sometimes we like, let's say we have adopted one software to do the regular transactions and all. Okay? Like we use bankers or that Infosys one. Okay? So bankers is by TCS, Infosys one. I just missed that name. Okay? So basically, we are using these particular whatever technology we have employed that is relevant or not. That also we conduct the research and all. On all these technologies, they generally work on automations. Okay? So computer aid audit techniques, CAATs. So CAATs enhance efficiency and effectiveness of audit because, like, see, you do not have to go through each and every transactions. If you want like n number of reports around the different dimensions, so that can be generated through the computerized accounting and all. Though data is computerized, the scope and objective of audit remain unchanged. Audit procedures now include understanding internal control and working in a computerized environment. So for that one, we have information technology audit also. Okay. Limitations: auditor can only provide an opinion relying on other for the explanation. Let's say, as I gave you an example of that section like special audit. After special audit, let's say there is some report which is presented by auditors. That report will go to RBI or even the Government of India, Ministry of Finance. Based on that particular one, they can make a decision. Your bank is like you are not going to take transactions or deposit from customer for next 6 months, or we suggest a liquidation on this particular bank. But before that, we will give chance to the bank to represent their viewpoints, what is their plan, how they are going to overcome with these particular problems and all. Okay? And eventually, auditors, they are providing some sort of insights about the legalities and others. The decision maker are eventually the regulatory bodies or the government itself, right? So the interpretation parts and all. Not all transaction or non-monetary factors can be examined in this particular one, because like on daily basis we used to do number of transactions. So that's why we have kept some sort of like that loan review mechanism system, which generally mandated for the accounts or the assets which worth more than 5 crore rupees in all since 2013 itself. So purpose of audit: provide scientific view of books of accounts, ensure accurate descriptions of financial statements, confirm compliance with regulatory provisions. So these are some core objectives or purpose of your audit things. I know like this is completely theoretical and all. So now this is very important, guys. Risk-based internal audits. So risk-based internal audit, this is something which is very important, and this get asked so many times for 1 marks or half marks or 2 marks also. So traditional versus modern internal audit historically focus on transaction testing and verifying accuracy, or trying to achieve the arithmetical accuracy of debit and credits in the overall bank, reliability and compliance. Now expanded to assess the adequacy and effectiveness of risk management. Okay? So how we are going to handle any sort of risk which can be part of our banking business, and the internal control. Okay? So what type of risk we might face or we may face in the near future, and how we are going to tackle those particular ones, okay? And what compliances need to be fulfilled to handle those particular things and all. So for that one, there are so many regulatory compliances, and even by bank also they do have so many provisions and all, right? So introduction of risk-based internal audit. RBI introduced this particular one in December 27, 2002, Scheduled Commercial Bank by a circular this. So further strengthening through the another circular in January 7, 2021. Okay? Framework and objective. Risk-based internal audit is based on well-defined policy, independence, communication channels and professional compliances. Basically, we do have a proper risk management frameworks for this particular one. Emphasis the auditor's role in risk identification, prioritization, and mitigations. Aim to ensure that appropriate control are in place to manage emerging risk. Okay, so as I told you, right, we do have a risk management framework. So this framework, which includes so many things like आपका organization for risk management, which is led by board of directors. So any policy toward this particular things should be part of the board approvals policy. And apart from this, like we have risk management committee, we have asset liability management committee, we have even segment wise market risk management, liquidity risk management, your credit risk management. So these are the different committees which are generally working toward this particular one. So we can achieve a common goal and we can deal with any sort of uncertainty. Like when that uncertainty become reality, that is risk. So we can effectively handle that particular one through our risk management plans and all. So that is something which is the objective of this particular one, right? So RBI guidelines when it comes to, so internal audit must evaluate risk management and internal control system and for effectiveness and regulatory compliances. So it is something we do have so many guidelines which are given by the statutory body or the regulatory body, which is RBI. So the fulfillment of those particular compliances, as well as every bank, they do have their own system to manage these kind of risk and all. So adherence to these particular one and how our bank is meeting those particular guidelines effectively, that generally you have to make sure. And being an auditor, you have to conduct your audit should align with those particular guidelines and all. Provide assurance to the board of directors and senior management about the quality of internal system also, right? So features of this: focus on auditing the management of risk, not just the risk themselves. Move like it is not only about risk, like they are not telling about the what can be the expected uncertainties. They are also telling you, or the system is also helping you to build a plan B to mitigate those particular ones. Okay? So we have stress testing and others. There are so many tools which generally get involved in this. Move beyond just transaction level testing to strategic risk-based auditing. Involve corporate level and branch level risk assessment, monitoring and control also. So we have integrated system. If anything happening at any small branch also, so that things should get escalated through your MIS. So significance crucial for the modern banking operations. Enhance governance, control and risk response. Support informed decision making by the bank leaderships and all. So this is something which is all about your internal risk-based management, just risk-based internal audits, which are generally part of this. RBI guidelines on internal audit functions in bank under the risk-based internal audit framework. To align the internal audits functions with the international best practices, which are usually launched by the BCBS or Basel norms, RBI has issued comprehensive instructions like authority, stature, and independence. So internal audit must have adequate authority, independence, and resources to conduct these kind of activities in the branches. The head of internal audit should be a senior executive with independent judgment and full access to record and staff. So if they want to conduct research audits in any area, so they should have that much of power. They should have access to that information, so they can conduct those kind of research in a freely manner. So HIA and the audit team, HIA means head of internal audits, and the audit teams must operate with complete objectivity. What they want to what they want to achieve from that particular audit, that should be properly defined and documented. Competence. So internal auditors must possess professional competence and relevant experience. Let's say if a person is conducting research on our trading book. So they must have some sort of knowledge around that particular trading book, which is like where basically bank deal in forex or the other different securities, buy and selling. Skill should include knowledge of banking operation, IT data analytics, and fraud detections. So audit staff must be capable of auditing all areas of the bank itself. Next one, staff rotation. Okay, so this is something which help auditors to develop their different expertise. If a person, let's say, they were working on one project, after completion, it is generally suggested to move them to other project, and also they can build their expertise and they can know the things at ground level. So they can make sound decision in the while they are conducting those kind of activities. Staff in internal audit should serve minimum period as prescribed by the board itself. Career auditors should manage the functions. Lateral staff may be rotated only if suitability skills and all. So dedicated peoples, they should move frequently, and like a normal staff, that is depend on their skills and choices. Tenure of appointment of head of internal auditors should be appointed for reasonably long term, then preferably minimum for 3 years to ensure stability. Reporting line, HIA should report directly to your audit committee of the board or MD or CEO or WTD. Okay, so this is something like as their role is very important. So that's why we are aligning their reporting to the head of that particular bank. So like they can easily escalate the things if anything going wrong in the bank itself. If MD and CEO or WTD is reporting authority, appraisal and review should be should still with the ACB and the board itself. Okay? Audit committee of the board or the entire board itself. All right. Remuneration, if it comes to the remuneration, compensation must not be linked with to the performance of business audit. Like see, if you link their compensation or their remuneration with the business audit, how many times they are conducting audits, or how quickly they are doing that particular one. So there will be some personal interest in that particular one. So they have clearly defined this, key their remuneration should be fixed, like you will get this much of things. You do one audit or 100 audits. Okay? So that is something. Otherwise, like if you give them target and all to achieve those targets to earn more, there are some chances of loopholes. So remuneration should avoid conflict of interest and ensure independence and objectivity. Outsourcing, internal audit cannot be outsourced, but for concurrent and IT audit, we can outsource these ones. Okay? External expert can be hired contractually with ABC's assurance of independence. Ownership of audit report stay with the bank itself. Okay? So you do not have to like share in the public and others. So that is something this. Okay? So this is something which is all about your internal risk-based approach, and which is like nowadays like most of the time you'll see question around this particular. What type of question they have been asked in the past, that I'll show you. But before that, the second most important thing from this one is type of bank audit. Okay? So many times you'll see question around this, especially around these three areas: concurrent audits, internal audit or information system audit, and statutory audit, right? So these three type of audits, maximum time you'll see. Apart from this also, we have some other type of audit like forensic audits and others that we'll also discuss, right? So concurrent, internal audit, and statutory audit. So first, let's start with the concurrent audit. So concurrent audit is basically, it is something or somewhere around the regular activities of that particular bank. Let's say we are doing on regular basis, we are accepting deposit, we are granting loans, we are entering in some forward contracts and others, the day-to-day activities of the business itself. Okay. So now with the help of some external auditors, we conduct some sort of audit on those particular transactions. It is not necessarily that we are conducting transaction on all the activities, but like somewhere like where the value is high or where the risk probability is high. So in those particular cases, with the help of CAs and others, we are generally going to conduct audits on these particular one. So concurrent audit is a real-time or near real-time examination of transactions as they occur, and it is something like it can be internal or external. Okay, so like it is that your daily review of your transaction is also part of internal. Like let's say 10 a.m. to 4 p.m. we did so many transactions. At the back end, we are like after 4 p.m. we are verifying those particular transactions. That is also part of your concurrent audit. So we are making some transaction, then we are checking that particular one. So purpose to reduce the gap between the transaction and its review, enhancing timely detection of issues. Nature, it is continuous year-bound audit, usually performed monthly by the external auditors, and they are mostly आपका CA or anyone who is designated to conduct the audit itself. Focus areas, daily basic transactions are checked. Emphasis on the substantive checking in key areas rather than mere test checking. So it is something like if it is done by the internal person or a branch person or staff, they generally cross checking their daily transactions and not again, or that maker checker relationship. And when in some cases where transaction value is high or the risk involvement is high, so that is done by the like on monthly or quarterly basis, done by the external auditors also. Benefit, early identification and rectification of irregularities or non conformities, prevent accumulation of issues that could be problematic during the year end audits and all. So let's say we are like if there are some small or if there are lag in some business activities, so we can fix those particular problems on concurrent basis or on daily basis and all, right? Scope, auditor ensure compliance with cash balances limit, KYC norms, loan documentations and RBI instructions. So these are some major areas. They also export expectations in the concurrent audit reports. So this is the one. They give some notes. These are the expectations, or this is the way which by which we can improvise those particular areas, or we can enhance the utilization of resources or anything else, right? So this is something which is generally comes under this one. Objective, help the branch function smoothly by minimizing and correcting the errors, prevent cascading issues due to unresolved inequalities and all. Okay? So irregularities and all. So this is something the primary objective of this particular one, right? So concurrent audits आपका. So RBI guidelines on concurrent audit system in commercial bank. So RBI has revised the guidelines on concurrent audit system bank by a notification, which is this is the number dated 18th of September 2019. Concurrent audit aim at shortening the interval between transaction and its independent examination. It is therefore integral to the establishment of sound internal accounting function and effective control, and regarded as a part of bank early warning system to ensure timely detection of serious errors and irregularities. It is something like let's say while let's say there are some new employees in the organization. While they are doing some sort of documentation, they are missing one important documents. So we can like we can correct these kind of irregularities while they are doing some sort of transactions. If there is some problems or loopholes, so we can fix those particular problems as well. Okay? The revised guidelines cover coverage of this internal audit, appointment of auditors, accountability, tenure, remuneration, and review of effectiveness of concurrent audits and reporting system. So these are generally part of this particular one. And they did not have explained this particular one. So internal audit. So basically conducted the another second type of audit. It is done by the internal staff only, right? Internal audit, which is done by the internal staff. So conducted mostly by bank staff and sometimes by the chartered accountants. Aim to ensure accuracy and correctness of the bank financial records. Importance, build public trust by ensuring that bank handle depositors funds responsibly. A key function is fraud detection along with the identifying errors, omission and irregularities. Relevance due to widespread fraud in the banking sector, public, private, foreign. Internal audits must focus heavily on fraud detections. So this is their core area of the working. Liberalized economic policies and evolving banking dynamics have made internal audit a critical tool for the bank itself. So uses many banks now conduct internal audit along with or instead of concurrent audits to strengthen the overall control. So key aspect which include these many areas. Pehla, role in bank governance, contribution to risk management effectiveness, which is linked with your risk-based internal audit. Execution of risk-based internal audit procedures, importance in overall risk management, use of non-financial data analysis for evaluation, adherence to auditing and assurance standards. They generally comes under this one. Okay? Information system, the final audit आपका, ठीक है. So need of information system audit. So we are like nowadays we are working on the technology. So how effectively we are using that particular one and how much you can rely on that particular technology or how much that technology is reliable. Okay? So these kind of things we generally get covered under this particular one. Okay? So with increased technology adoption in banking, IT related risks have grown, cyber frauds and others. Okay? So complex IT environment demand effective risk management. So to provide assurance to RBI and bank management on the effectiveness of internal IT control, offer independent and objective evaluation of how well risks are managed. So scope of IS audit, which include आपका safeguard assets, ठीक है, hardware, softwares, data using appropriate security measures, ठीक है, which is your password or the authority to access those particular one and all. Maintain data integrity. So we can use that particular one for the decision making. Help achieve organizational goal. Utilize system resources effectively. ठीक है, what like the uses of those particular resources and all that generally comes under this. So IS audit impact on internal audit functions. It also support the overall internal audit as well. So internal audit department are evolving due to automation and tech-enabled processes. IS audit have become increasingly important in modern audit framework because, like, let's say if they need any sort of report, so by this automation things or by this computerization or electronic things, so we can easily generate those particular report as well, right? Regulatory direction, RBI, 30th April 2004 guidelines. So there should be a periodic system audits of hardware, software effectiveness, required operational आपका changes and security compliances standards should be fulfilled by the bank itself under this particular audit. Okay? So Reserve Bank of India guidelines on information system audits. Okay? So where we have RBI has been taking many initiative in sensitizing bank to the risk and concern that emergence from the adoption of information audits. Various committees report instructions and circulars have been just like this. So basically when it comes to 2001 report, it is the guidelines cover the following areas: information technology governance, information security, information system audit, information technology operation, information technology services, outsourcing, cyber fraud, business continuity planning or your plan B in case of any sort of failures and all, customer awareness programs and legal aspect. So these are some major dimensions around which we have to conduct our IT audits and all. Okay, so scope of IS आपका information system audit, ठीक है, determining effectiveness of planning and oversight of IT activities, evaluating adequacy of operation process and internal control, determining the adequacy of enterprise-wide compliances effort related to IT policies and internal control procedures, identifying deficient control, recommend corrective actions to address deficiencies and follow up, and to ensure that management effectively implement the required action. So these are some goal or objectives of IAS audits and all. So which you have to remember. Okay. The apart from this, the next one is statutory audit. Statutory audit, which is generally used like, which is like something related to compliances, or they can be used as a like forensic evidence and all. Okay. So let's say if there are some guidelines from the RBI, so how that bank is meeting with those particular guidelines or by any other regulatory authority. So this is something related to legality of that particular one. So mandated under Banking Regulation Act 1949, require annual financial statement, which is profit and loss, and your balance sheet to be audited as per the legal status. This I have told you in the beginning also. Again, Section 29 of BR Act 1949. So you have to prepare your accounts as per this, and as per the section 13 subsection 1, you have to conduct audit on these particular final reports. Okay? So basically they are kind of a must thing. Okay? So bank, they need to before publishing those particular document, they have to conduct this particular one, so they can make sure that everything is aligned with the laws. So silent feature, mandated by law, conducted by statutory auditors, meaning it is compulsory under law. Section 30 of BR Act, Banking Regulation Act 1949, make it mandatory for bank to get their profit and loss account and balance sheet audited. Importance, independence audit support a safe and sound banking system. Does not go into detailed banking transactions. We'll use our previous audit reports and all, internal, concurrents and other reports. We will use IT reports. Then based on those particular one, we'll do this. Okay? Concurrent and internal audits relies on their report and perform test check. Okay? Focus areas, loan and advances or the major assets which are generally created by bank, or even the KYC and other guidelines also. So stages in statutory audit. So there are 17 stages which is mentioned in your book itself. So these are the stages, right? Initial consideration by the auditors, identifying and assessing material misstatements. Material misstatement means, let's say there is a debit of 1 lakh and credit of 50,000. So there is a gap. Okay? So why this gap? Or even the other things also. Okay? Anything which is related to money. So understanding risk management process of the bank, team engagement and discussion, establishing overall audit strategy, developing the audit plan, preparing audit planning memorandum, determining audit materiality, assessing going concern assumptions, assessing fraud risk, including money laundering, evaluating specific risk, reviewing outsourcing risk, responding to risk, checking conformity with the Basel III guidelines, reliance on other reports, classification of NPAs based on recovery record, asset classification should borrower wise, not the facility wise, because these are the areas. You do not have to remember all these particular one. This is just generally, this is the entire process of which generally comes under your auditors, statutory audit reports and all. Okay? These are the areas, or this is the flow by which they generally conduct the different research in our bank itself, right? Other, apart from these, some other type of audits which are also given in this, like revenue audit. They are very simple. Yeah. So focus on identifying interest and charges leakage in large to medium branches. Let's say there is a huge gap. Earlier there was the earning was, let's say, 50 crores per month. Now it came to 30 crores. So what is the reason? Or even like what are the areas where we are lacking in others, these kind of things. Stock and receivable audit, again, so it is about around the inventory. Involve periodic check by the professionals on stock and debt statements of large borrowers. Forensic audit, examining financial information for evidence of fraud, and which we can present to the court in case of any default and all. Management audit, assessing management methods, policies and efficiency to ensure objectives are met. So how effectively we are using resources and all. Tax audit, analyze tax return to validate tax payments and compliances. Okay? So these are some additional kind of audits which are generally get conducted in the banking business. So when it comes to entire audit things, so we have two different areas. One is statutory audit, which is something around the where we have the defined rules regulation about the presentation and about the audit things and all, which is the final one. But before that, on our day-to-day basis activities in our branch level or at the bank level, we do have concurrent internal or this, like nowadays banking businesses IT driven. So we also checking that particular area, so we can have some sort of reliance on the business or on the system itself, right? All right. So this is it. Bye bye. Take care all. Have a nice day. Thank you.